Insurance. A contract where one party, the insurer, agrees to compensate another party, the insured, for specified losses in exchange for premium payments. It provides financial protection against unexpected events by transferring risk from individuals to insurance companies. Risk transfer, the process of shifting the financial burden of potential losses from one party to another, typically from an individual or business to an insurance company. This is the fundamental mechanism that allows insurance to function. Risk pooling, the practice of combining the premiums and losses of many insureds so that the costs of losses are spread across the entire group. This allows insurers to predict losses more accurately and charge appropriate premiums based on the law of large numbers. Exposure. Any condition or situation that presents a possibility of loss, whether or not an actual loss occurs. It represents the state of being subject to the possibility of loss or damage. Loss, the reduction in value of insured property due to a covered peril, or the legal liability imposed on an insured. It represents the actual financial harm suffered that triggers an insurance claim. Loss reserve, funds that an insurer sets aside to pay future claims that have already occurred but have not yet been fully settled. This includes both reported claims being processed and incurred but not reported IBNR claims. Loss ratio, a percentage calculated by dividing incurred losses by earned premiums, showing what portion of premium income is paid out in claims. A loss ratio of 70% means the insurer pays 70 cents in claims for every dollar of premium earned. Expense ratio, a percentage calculated by dividing an insurer's underwriting expenses by written premiums, showing the cost of acquiring and servicing policies. It includes commissions, salaries, advertising, and other operational costs. Combined ratio, the sum of the loss ratio and expense ratio, indicating an insurer's overall underwriting profitability. A combined ratio below 100% indicates an underwriting profit, while above 100% indicates an underwriting loss. Rate, the cost of insurance per unit of exposure, such as per $100 of property value or per vehicle. The rate is multiplied by the number of exposure units to determine the premium. Premium, the amount of money an insured pays to the insurer for insurance coverage. It is calculated by multiplying the rate by the number of exposure units and may be adjusted by discounts or surcharges. Earned premium, the portion of the premium that corresponds to the coverage period that has already elapsed. For example, a $1,200 annual policy has earned $600 after 6 months of coverage. Unearned premium, the portion of the premium that corresponds to the unexpired coverage period and represents the insurer's liability to provide future coverage. It must be returned to the policyholder if the policy is canceled before expiration. Underwriting, the process of evaluating, selecting, and pricing insurance risks to determine whether to accept or reject an application and at what premium. Underwriters assess the likelihood and potential severity of losses to ensure profitable and sustainable operations. Underwriting criteria, the specific standards, guidelines, and rules that underwriters use to evaluate and select risks. These criteria help ensure consistency in decision-making and maintain the insurer's desired risk profile. Adverse selection, the tendency for individuals with higher than average risk to seek or continue insurance coverage more often than those with lower risk. This can occur when insureds know more about their own risk than the insurer does, leading to unprofitable business. Reinsurance, insurance purchased by insurance companies to transfer portions of their risk portfolios to other insurers, thereby reducing the likelihood of large payouts from catastrophic events. It allows insurers to write more business and stabilize their operations. Ceding insurer, the insurance company that transfers, cedes, all or part of its risk to another insurer through a reinsurance agreement. The ceding insurer remains responsible to the policyholder but shares the financial burden with the reinsurer. Reinsurer, the insurance company that accepts, assumes, risk transferred from a ceding insurer in a reinsurance agreement. the reinsurer agrees to pay the ceding insurer for covered losses in exchange for a portion of the premium. Retention, self-insured retention. The amount of risk or loss that an insured or insurer keeps rather than transferring to another party through insurance or reinsurance. For insureds, it's similar to a deductible. For insurers, it's the portion of losses they retain before reinsurance applies. Self-insurance, the practice of setting aside funds to pay for potential losses rather than purchasing insurance from a third party. Organizations assume their own risk and bear the financial consequences of losses directly. Mutual insurer, an insurance company owned by its policyholders rather than shareholders, where profits may be returned to policyholders as dividends. Policyholders elect the board of directors and share in the company's financial results. Stock insurer, an insurance company owned by shareholders who have invested capital in the company and expect profits and dividends. Management's primary obligation is to maximize shareholder value rather than return profits to policyholders. Reciprocal insurer, an unincorporated group of individuals or organizations, subscribers, who exchange insurance contracts and share risks among themselves. Each subscriber is both an insurer and an insured, with policies typically managed by an attorney-in-fact. Lloyd's Association, a group of individual underwriters who join together to underwrite insurance risks, with each member accepting a specified portion of the total risk. This is not the same as Lloyd's of London, though the concept is similar. Fraternal insurer, an insurance organization that operates as a fraternal benefit society, providing insurance primarily to members of a specific social, religious, or charitable organization. These insurers typically have lodge systems and focus on member welfare. Risk Retention Group, RRG, a liability insurance company owned by its members who share similar business characteristics and risks, created under federal law to provide liability coverage to its member owners. RRGs can operate in multiple states, but can only write liability coverage, not property insurance. Captive insurer, an insurance company established and owned by a parent company or group of companies to insure the risks of its owner. Captives allow businesses to retain more risk, customize coverage, and potentially reduce insurance costs. Domicile, the state or jurisdiction where an insurance company is incorporated and maintains its principal place of business. The domiciliary state has primary regulatory authority over the insurer's operations and financial solvency. Domestic insurer, an insurance company incorporated and licensed in the state where it is currently operating or being discussed. For example, a company incorporated in California is a domestic insurer when operating in California. Foreign insurer, an insurance company incorporated in one U.S. state but operating in another U.S. state. For example, a company incorporated in New York is a foreign insurer when operating in Texas. Alien insurer, an insurance company incorporated in a country outside the United States but operating within the U.S. These companies must comply with U.S. state insurance regulations to conduct business domestically. Admitted insurer, an insurance company that has been licensed and authorized by a state's insurance department to conduct business in that state. Admitted insurers must comply with all state regulations and contribute to state guarantee funds. Non-admitted insurer, an insurance company that has not been licensed to do business in a particular state, but may still write surplus lines coverage for hard-to-place risks. Also called unauthorized or excess and surplus lines insurers, they are not subject to the same rate and form regulations as admitted insurers. Surplus lines, insurance coverage placed with non-admitted insurers when coverage cannot be obtained from admitted insurers in the standard market. Surplus lines are used for unusual, high-risk, or hard-to-place exposures and are subject to special taxes and regulations. Insurance producer, a licensed individual or entity authorized to sell, solicit, or negotiate insurance on behalf of insurers or insureds. This is a broad term encompassing agents, brokers, and other insurance sales professionals. Agent, a licensed insurance professional who represents one or more insurance companies and has the authority to bind coverage on their behalf. Agents owe a primary duty of loyalty to the insurer they represent, though they must also act in the insured's interest. Broker, a licensed insurance professional who represents the insurance buyer, the insured, rather than the insurance company. Brokers search the market to find appropriate coverage for their clients and place business with insurers, but typically cannot bind coverage without insurer approval. Independent agent, an insurance agent who represents multiple insurance companies and is not obligated to place business with any single insurer. Independent agents own their client relationships and can move business between insurers to serve client needs. Exclusive agent, an insurance agent who represents only one insurance company or group of affiliated companies. Also called captive agents, they are often restricted from selling competitors' products, and the insurer typically owns the book of business. Direct response marketing, a method of selling insurance directly to consumers without the use of agents or brokers, typically through mail, telephone, internet, or television advertising. This distribution model reduces costs by eliminating agent commissions. Insurer, the insurance company or entity that provides insurance coverage, assumes the risk and agrees to pay for covered losses. The insurer collects premiums and has the financial responsibility to honor policy obligations. Policyholder, the person or entity who owns an insurance policy and is covered by the insurance contract. The policyholder pays premiums and has the right to file claims for covered losses, though additional parties may also be insured under the policy. Risk, the uncertainty concerning the possibility of loss or the chance that a loss will occur. In insurance, risk represents the potential for financial harm or loss due to unpredictable events. Pure risk, a situation where there are only two possible outcomes, loss or no loss, with no opportunity for gain. Examples include the risk of fire, theft, or accident, which are insurable because they only present the possibility of loss. Speculative risk, a situation where there are three possible outcomes, loss, no loss, or gain. Business ventures, gambling, and stock market investments are examples of speculative risk, which is generally not insurable. Exposure, any condition or situation that presents a possibility of loss, whether or not an actual loss occurs. It represents the state of being subject to the possibility of loss or damage. Hazard, any condition or circumstance that increases the likelihood or potential severity of a loss. Hazards do not cause losses themselves, but make losses more likely to occur or more severe when they do occur. Physical hazard, a tangible characteristic of the property, person, or operation being insured that increases the chance of loss. Examples include icy steps, faulty wiring, or a building's proximity to a fire station. Moral hazard, a condition that exists when a person may intentionally cause or exaggerate a loss to collect insurance proceeds. This involves dishonesty or character defects that increase the probability of loss through fraud or intentional actions. Moral hazard, a condition of carelessness or indifference to loss that arises because insurance protection exists. When people become less careful about protecting their property because they know insurance will pay for losses, moral hazard is present. Legal hazard, the increased likelihood of loss or increased severity of loss due to court actions, legislative changes, or the legal environment. Examples include jury awards that exceed policy limits or laws that expand insurer liability. Peril, the immediate specific cause of loss, such as fire, windstorm, theft, or collision. Perils are the events that insurance policies either cover or exclude, representing the actual cause of damage or loss. Proximate cause, the dominant or most important cause of a loss when multiple factors contribute to the damage. In insurance, the proximate cause determines whether a loss is covered, as policies respond to the peril that sets in motion the chain of events leading to loss. Direct loss, physical damage to property caused directly by a covered peril. For example, when fire burns a building, the cost to repair or replace the damaged structure is a direct loss. Indirect loss, consequential loss, a loss that results as a consequence of a direct loss rather than from the peril itself. Examples include lost business income due to fire damage or increased living expenses when a home is uninhabitable after a covered loss. Law of large numbers, a statistical principle stating that as the number of similar but independent exposure units increases, the ability to predict future losses improves. This allows insurers to accurately estimate expected losses and set appropriate premiums for large groups of insureds. Indemnity. The principle that insurance will restore an insured to their approximate financial position before a loss occurred, without allowing profit from the loss. Insurance contracts are designed to compensate for actual losses up to policy limits, not to enrich the insured. Insurable interest, a financial or legal relationship between the insured and the subject of insurance, where the insured would suffer financial harm from a loss. Without insurable interest, the insurance contract would be invalid because it would essentially become a gambling contract. Actual cash value, ACV, the cost to replace damaged property with new property of like kind and quality, minus depreciation. ACV accounts for the age, condition, and useful life remaining in the property at the time of loss. Replacement cost, the cost to repair or replace damaged property with new property of like kind and quality, without any deduction for depreciation. This valuation method typically results in higher claim payments than actual cash value. Market value, the price that property would likely sell for in a normal transaction between a willing buyer and willing seller. Market value may be higher or lower than replacement cost, depending on factors like location, demand, and economic conditions. Stated amount, a specified dollar amount of insurance coverage that is stated in the policy but does not necessarily represent the property's actual value. The insurer will pay the stated amount or the actual cash value, whichever is less, unless agreed value provisions apply. Agreed value, a coverage provision where the insurer and insured agree in advance on the value of the insured property, and this amount is paid in the event of a total loss. This eliminates disputes over valuation at the time of loss and typically suspends coinsurance requirements. Salvage, property that remains after a loss and retains some value, which the insurer may take possession of after paying a claim. Salvage can be sold to offset the insurer's claim payment, reducing the net loss. Subrogation, the legal right of an insurer to recover claim payments from a third party who was responsible for the loss. After paying a claim, the insurer steps into the shoes of the insured to pursue recovery from the at-fault party. Abandonment, the act of relinquishing all rights and interest in damaged property to the insurer. Property insurance policies generally prohibit abandonment, meaning the insured cannot simply walk away from damaged property and force the insurer to take it. Occurrence, an accident, including continuous or repeated exposure to substantially the same general harmful conditions that results in bodily injury or property damage. In liability policies, occurrence-based coverage responds to events that happen during the policy period, regardless of when the claim is made. Accident, a sudden, unintended, and unexpected event that causes loss or injury. Accidents are fortuitous events, meaning they happen by chance rather than being planned or expected. Negligence, the failure to exercise the degree of care that a reasonable person would exercise under similar circumstances, resulting in harm to another party. To establish negligence, there must be a duty of care, breach of that duty, proximate cause, and actual damages. Loss frequency, the number of losses that occur within a specified time period. High-frequency losses occur often, but are typically less severe, such as minor auto accidents or small theft claims. Loss severity, the dollar amount or magnitude of individual losses when they occur. High-severity losses are catastrophic events that result in large claim payments, such as total destruction of property or serious liability claims. Risk avoidance, a risk management technique where a person or organization chooses not to engage in an activity that presents risk. For example, A business might avoid products' liability risk by choosing not to manufacture certain products. Risk reduction, loss control, actions taken to decrease either the frequency or severity of losses. Examples include installing fire sprinklers, implementing safety programs, or building in areas less prone to natural disasters. Risk retention, the decision to accept financial responsibility for losses rather than transferring them through insurance. This can be intentional, self-insurance with a funded reserve, or unintentional, inadequate insurance or gaps in coverage. Risk sharing, a method of handling risk where multiple parties agree to share the potential losses. Examples include coinsurance arrangements, where multiple insurers share a risk, or risk retention groups, where similar businesses pool their exposures. Risk transfer, the process of shifting the financial burden of potential losses from one party to another, typically from an individual or business to an insurance company. This is the fundamental mechanism that allows insurance to function. Policy, the written contract between the insurer and the insured that outlines the terms, conditions, coverages, exclusions, and obligations of both parties. It serves as legal evidence of the insurance agreement and defines what is and is not covered. Declarations page, the section of an insurance policy that provides specific information about the insured, including the policyholder's name, address, property location, coverage amounts, policy period, premium, and deductibles. This page declares the particular details unique to that specific policy and insured. Insuring agreement, the section of the policy where the insurer's promise to pay for covered losses is stated, describing what the insurer will do in exchange for premium payment. It outlines the scope of coverage and the insurer's basic obligations under the contract. Conditions, policy provisions that qualify or limit the insurer's promise to pay by establishing the duties and obligations of both the insured and insurer. Failure to comply with policy conditions may result in claim denial or policy cancellation. Exclusions, policy provisions that eliminate coverage for specific perils, types of property, locations, or circumstances. Exclusions clarify what the policy does not cover and help insurers manage exposure to uninsurable or catastrophic risks. Endorsements, written amendments attached to an insurance policy that modify, add to, or delete coverage provisions in the original contract. Endorsements can broaden or restrict coverage and become part of the legal policy contract. Riders, amendments to insurance policies that add coverage or modify policy terms, similar to endorsements. The term rider is used more commonly in life and health insurance, while endorsement is typical in property and casualty insurance. Policy period, the length of time for which the insurance coverage is in effect, specified by the inception date and expiration date in the declarations. Coverage applies only to losses that occur during this period, for occurrence policies, or claims made during this period, for claims-made policies. Policy limits, the maximum amount an insurer will pay for a covered loss under the policy. Limits can be expressed per occurrence, per person, per accident, or as an aggregate for all losses during the policy period. Limit of liability, the maximum dollar amount the insurer is obligated to pay for a covered loss, claim, or series of claims. This represents the insurer's maximum exposure under the policy terms. Aggregate limit, the maximum amount an insurer will pay for all covered losses during the entire policy period, regardless of the number of separate occurrences. Once the aggregate limit is exhausted, no further coverage is available until the policy renews. Split limit, a liability limit structure that specifies separate maximum amounts for different types of coverage, typically expressed as three numbers, such as 100/300/50. For example, in auto insurance, this might represent $100,000 per person for bodily injury, $300,000 per accident for bodily injury, and $50,000 per accident for property damage. Combined single limit, a liability limit that provides one total amount of coverage that applies to any combination of bodily injury and property damage claims from a single occurrence. This offers more flexibility than split limits because the full amount is available regardless of how damages are distributed. Deductible. The amount the insured must pay out of pocket before the insurer's obligation to pay begins. Deductibles reduce the cost of insurance by eliminating small claims and encouraging loss prevention, with higher deductibles resulting in lower premiums. Coinsurance, a property insurance provision requiring the insured to maintain coverage equal to a specified percentage of the property's value, commonly 80%, 90%, or 100%, or suffer a penalty at the time of loss. If the insured carries less than the required amount, they become a co-insurer and share in the loss proportionally. Provisions, the general term for all clauses, conditions, stipulations, and requirements contained within an insurance policy. Provisions establish the rights, duties, and obligations of both parties to the contract. Definitions section. The part of an insurance policy that provides specific meanings for key terms used throughout the policy. These definitions clarify ambiguous words and establish precise meanings that may differ from common usage, ensuring consistent interpretation. Renewal, the continuation of coverage under an existing policy for a new policy period, typically with updated terms, conditions, or premiums. Renewal creates a new contract for the subsequent period based on current conditions and loss experience. Non-renewal. The insurer's decision not to continue a policy beyond its expiration date, effectively terminating the relationship at policy expiration. State laws typically require advance written notice to the insured, often 30 to 60 days, before non-renewal takes effect. Cancellation. The termination of an insurance policy before its scheduled expiration date by either the insurer or the insured. State laws regulate when and how insurers can cancel policies, often requiring specific reasons and advance notice. Flat cancellation. Cancellation of a policy as if it never existed, typically done soon after inception with a full refund of premium. This occurs when a policy is canceled before coverage takes effect or immediately after inception with no claims filed. Pro rata refund, a premium refund method where the insured receives back the exact proportion of premium for the unexpired portion of the policy period. This method is used when the insurer cancels the policy and is calculated by dividing unearned premium by the total premium. Short rate cancellation, a premium refund method that returns less than the pro rata amount when the insured cancels the policy before expiration. The insurer keeps a penalty, typically 10% of the unearned premium, to cover administrative costs and compensate for the abbreviated policy period. Policy territory. The geographic area where coverage applies, as defined in the policy. Most policies specify coverage in the United States, its territories and possessions, Puerto Rico, and Canada. Those specific territories vary by policy type. Binder, a temporary insurance contract that provides proof of coverage until the formal policy is issued. Binders are legally binding and provide immediate coverage, typically for 30 to 90 days, containing the basic terms of coverage that will be included in the final policy. Certificate of Insurance, a document that provides evidence that an insurance policy exists and summarizes key information such as coverages, limits, and policy period. Certificates do not confer coverage rights and are commonly required by landlords, lenders, or parties requiring proof of insurance. Consideration, something of value exchanged between parties to make a contract legally binding. In insurance, the insured's consideration is the premium payment and application statements, while the insurer's consideration is the promise to pay covered losses. Without consideration, no valid contract exists. Insuring clause, the provision in an insurance policy that establishes the basic scope of coverage and the insurer's promise to pay for specified losses. This is the core promise of the insurance contract, stating what the insurer agrees to cover. Supplemental payments, amounts the insurer pays in addition to policy limits for specific expenses related to a covered claim, such as defense costs, court costs, bail bonds, or loss of earnings for court attendance. These payments typically do not reduce the policy limits available for damages. Additional coverages, specific types of coverage automatically included in a policy that provide limited protection for certain exposures, often with separate sublimits. Examples include debris removal, fire department service charges, or coverage for damage to trees and shrubs in homeowners' policies. First named insured. The first person or entity listed on the declarations page when multiple parties are named insureds, who typically has additional rights and responsibilities. The first named insured usually receives policy notices, has the right to make policy changes, and is responsible for premium payment. Named insured, the person, SAHI as, or organization, I as, specifically identified by name in the declarations as the insured party. Named insureds have the broadest coverage under the policy and typically include spouses and household members in personal lines policies. Additional insured, a person or organization not automatically covered by the policy but added through endorsement to receive coverage under specific circumstances. Additional insureds have more limited coverage than named insureds and are often added to satisfy contractual requirements. Assignment, the transfer of policy rights or benefits from one party to another. Property insurance policies typically prohibit assignment without the insurer's written consent because insurance is a personal contract based on the relationship between specific parties. Liberalization clause. A policy provision stating that if the insurer adopts broader coverage provisions during the policy period without additional premium, the current policy will automatically include those improvements. This ensures existing policyholders benefit from coverage enhancements without waiting for renewal. Appraisal clause, a policy provision that provides a dispute resolution mechanism when the insured and insurer cannot agree on the value of property or the amount of loss. Each party selects an appraiser. These two appraisers select an umpire, and a decision by any two of the three is binding. Arbitration clause, a provision requiring that certain disputes between the insured and insurer be resolved through arbitration rather than litigation. Arbitration is typically faster and less expensive than court proceedings, with decisions made by neutral arbitrators. Warranty, as part of contract conditions, a statement or promise made by the insured that specific facts are true, or that certain conditions will be maintained throughout the policy period. In insurance contracts, breach of a warranty can void coverage even if the warranty is unrelated to the loss. Certificate of authority, a license issued by a state insurance department authorizing an insurance company to conduct business in that state. Without this certificate, an insurer cannot legally sell policies or transact insurance business in the state. Waiver, the voluntary and intentional relinquishment of a known right, such as when an insurer knowingly gives up its right to enforce a policy provision. Once a right is waived, the insurer cannot later try to enforce that provision. Estoppel, a legal doctrine that prevents a party from asserting rights or facts that contradict previous statements or actions upon which another party has reasonably relied. In insurance, if an insurer's actions lead an insured to believe coverage exists, the insurer may be estopped from later denying coverage. Insurer, the insurance company or entity that provides insurance coverage, assumes the risk and agrees to pay for covered losses. The insurer collects premiums and has the financial responsibility to honor policy obligations. Insured, the person or entity who owns an insurance policy and is covered by the insurance contract. The policyholder pays premiums and has the right to file claims for covered losses, though additional parties may also be insured under the policy. Applicant, the person or entity requesting insurance coverage by submitting an application to an insurance company. The applicant provides information about the risk to be insured, which the insurer uses to determine whether to issue a policy and at what premium. First named insured, the first person or entity listed on the declarations page when multiple parties are named insureds, who typically has additional rights and responsibilities. The first named insured usually receives policy notices, has the right to make policy changes, and is responsible for premium payment. Named insured, the person, or organizations and specifically identified by name in the declarations as the insured party. Named insureds have the broadest coverage under the policy and typically include spouses and household members in personal lines policies. Additional insured, a person or organization not automatically covered by the policy but added through endorsement to receive coverage under specific circumstances. Additional insureds have more limited coverage than named insureds and are often added to satisfy contractual requirements. Third party, a person or entity other than the insured or insurer who may make a claim against the insured for injury or damage. In liability insurance, third parties are those who suffer harm caused by the insured and seek compensation. Beneficiary, the person or entity designated to receive payment or benefits from an insurance policy, particularly common in life insurance, but also used in some property and casualty contexts. The beneficiary has a legal right to claim proceeds when coverage is triggered. Producer, a licensed individual or entity authorized to sell, solicit, or negotiate insurance on behalf of insurers or insureds. This is a broad term encompassing agents, brokers, and other insurance sales professionals. Agent, a licensed insurance professional who represents one or more insurance companies and has the authority to bind coverage on their behalf. Agents owe a primary duty of loyalty to the insurers they represent, though they must also act in the insured's interest. Broker, a licensed insurance professional who represents the insurance buyer, the insured, rather than the insurance company. Brokers search the market to find appropriate coverage for their clients and place business with insurers, but typically cannot bind coverage without insurer approval. Principal, in an agency relationship, the party, usually the insurance company, that authorizes an agent to act on its behalf. The principal grants authority to the agent and is legally bound by the agent's actions within the scope of that authority. Fiduciary, a person or entity in a position of trust who is legally obligated to act in the best interest of another party, handling funds or responsibilities with the highest standard of care. Insurance agents and brokers act as fiduciaries when they handle client premiums and must keep these funds separate from their own. Adjuster, a professional who investigates, evaluates, and settles insurance claims on behalf of the insurer or insured. Adjusters determine coverage, assess damages, verify losses, and negotiate claim settlements according to policy terms. Claims representative, an insurance company employee or contractor responsible for handling claims from initial report through final settlement. Claims representatives investigate losses, determine coverage, evaluate damages, and authorize claim payments. Public adjuster, an independent adjuster hired by the insured, not the insurance company, to represent their interests in the claim process and negotiate with the insurer. Public adjusters work for a percentage of the claim settlement and advocate for maximum payment to the policyholder. Loss payee, a person or entity with an insurable interest in covered property who is designated to receive claim payments, either in addition to or instead of the named insured. Loss payees are commonly lenders or lessors who have a financial interest in protecting the property. Mortgagee, a lender, typically a bank or mortgage company, that holds a mortgage on insured property and is named on the insurance policy to protect its financial interest. The mortgagee receives claim payments for property damage to ensure the collateral securing the loan is repaired or the debt is satisfied. Lion holder, a party that has a legal claim or lien against property as security for a debt, similar to a mortgagee but typically used for personal property like vehicles. The lion holder is named on the insurance policy to ensure they are paid if the property is damaged or destroyed before the debt is satisfied. Contract, a legally enforceable agreement between two or more parties that creates mutual obligations. For a contract to be valid, it must include offer and acceptance, consideration, competent parties, and legal purpose. Legal purpose, one of the essential elements of a valid contract, requiring that the agreement's objective must be lawful and not against public policy. Insurance contracts must insure against legitimate risks and cannot be used for illegal activities or wagering on events where no insurable interest exists. Competent parties, individuals or entities who have the legal capacity to enter into a binding contract, meaning they are of legal age, mentally capable, and not under duress or undue influence. Parties lacking competence, such as minors or those declared legally incompetent, generally cannot enter into enforceable contracts. Consideration: something of value exchanged between parties to make a contract legally binding. In insurance, the insured's consideration is the premium payment and application statements, while the insurer's consideration is the promise to pay covered losses. Without consideration, no valid contract exists. Agreement, offer, and acceptance. The mutual assent of parties to contract terms, where one party makes an offer and the other party accepts it without modification. In insurance, the applicant typically makes an offer by submitting an application and premium, and the insurer accepts by issuing a policy. Representations: statements made by an applicant on an insurance application that are believed to be true to the best of the applicant's knowledge. Representations are used by the insurer to evaluate the risk, and while they must be substantially true, minor inaccuracies generally do not void coverage unless material to the risk. Misrepresentations: false or misleading statements made by an applicant on an insurance application, either intentionally or unintentionally. If misrepresentations are material to the risk, the insurer may have grounds to void the policy or deny a claim. Material misrepresentation: a false statement on an insurance application that is significant enough that it would have caused the insurer to decline coverage, charge a higher premium, or alter policy terms had the truth been known. Material misrepresentations give the insurer the right to void the contract from inception. Concealment: the intentional failure to disclose a material fact that the applicant knows would affect the insurer's decision to provide coverage or set premium rates. Concealment differs from misrepresentation in that it involves hiding information rather than providing false information. Fraud: an intentional act of deception made for personal gain or to damage another party, involving a material misrepresentation or concealment of fact. In insurance, fraud can occur during application to obtain coverage or during claims to receive undeserved benefits, and it voids coverage. Warranty: a statement or promise made by the insured that specific facts are true or that certain conditions will be maintained throughout the policy period. In insurance contracts, breach of a warranty can void coverage even if the warranty is unrelated to the loss, making warranties stricter than representations. Breach of warranty: the failure to fulfill the exact terms of a warranty made in an insurance contract. Unlike a misrepresentation, any breach of warranty, regardless of its materiality, traditionally gives the insurer grounds to deny coverage or void the policy. Conditional contract: a contract where the insurer's obligation to perform, pay claims, depends on the insured fulfilling certain conditions, such as paying premiums, providing timely notice of loss, and cooperating in claim investigations. If the insured fails to meet these conditions, the insurer may not be obligated to pay. Adhesion contract: a contract prepared by one party, the insurer, with standard terms that the other party, the insured, must accept or reject without negotiation. Because the insured cannot modify the terms, courts interpret ambiguities in favor of the insured under the doctrine of contra proferentem. Personal contract: a contract based on the unique characteristics, trustworthiness, and circumstances of the individual insured, rather than just the property or interest being insured. Personal contracts generally cannot be transferred or assigned without the insurer's consent, because the insurer has selected the specific risk. Aleatory contract: a contract where the performance of one or both parties depends on an uncertain event, and the exchange of value may be unequal. In insurance, the insured pays a relatively small premium, while the insurer might pay nothing, no loss, or a very large sum, major loss. Unilateral contract: a contract where only one party, the insurer, makes a legally enforceable promise, while the other party, the insured, is not legally required to perform. The insured is not obligated to pay premiums or renew the policy, but the insurer must fulfill its promise to pay covered claims if the insured does pay premiums. Utmost good faith, a principle requiring both parties to an insurance contract to act honestly and disclose all material facts relevant to the insurance transaction. Both the insurer and insured must deal with each other in complete honesty, with the insured disclosing all material information, and the insurer dealing fairly in underwriting and claims. Reasonable expectations doctrine, a legal principle stating that insureds are entitled to coverage that a reasonable person would expect based on the policy language, marketing materials, and agent representations, even if technical policy language might suggest otherwise. Courts may interpret policies to provide coverage consistent with the insured's reasonable expectations, particularly when policy language is ambiguous. Waiver, the voluntary and intentional relinquishment of a known right, such as when an insurer knowingly gives up its right to enforce a policy provision. Once a right is waived, the insurer cannot later try to enforce that provision. Estoppel, a legal doctrine that prevents a party from asserting rights or facts that contradict previous statements or actions upon which another party has reasonably relied. In insurance, if an insurer's actions lead an insured to believe coverage exists, the insurer may be estopped from later denying coverage. Tort, a civil wrong or injury, other than breach of contract, for which the law provides a remedy, typically in the form of monetary damages. Torts include negligence, intentional acts, and strict liability, forming the basis for most liability insurance claims. Liability, legal responsibility for one's actions or omissions that cause harm or injury to another person or their property. When found liable, a party is legally obligated to compensate the injured party for damages, which is why liability insurance is essential. Vicarious liability, legal responsibility imposed on one party for the negligent or wrongful acts of another party based on a special relationship between them. Common examples include employers being liable for employees' actions within the scope of employment, or parents being liable for their minor children's acts. Strict liability, legal responsibility for damages or injury, even without fault, negligence, or intent to harm, typically imposed for inherently dangerous activities or defective products. Under strict liability, the injured party need only prove the defendant's action caused the harm, not that the defendant was negligent. Real property, land and anything permanently attached to it, including buildings, structures, and fixtures that cannot be removed without damaging the property. Real property is immovable and includes both the physical land and improvements constructed on it. Personal property, movable property that is not permanently attached to land or buildings, including furniture, clothing, electronics, and other belongings. In insurance, personal property can include household contents, business equipment, inventory, and other tangible items that can be relocated. Business personal property, BPP, movable property owned by a business and used in its operations, including furniture, equipment, machinery, inventory, and supplies. BPP coverage is a standard part of commercial property policies and excludes real property, vehicles, and property of others. Contents, personal property contained within a building or dwelling, such as furniture, appliances, clothing, and other movable items. In homeowners insurance, contents coverage, Coverage C, protects the insured's personal belongings, while in commercial policies, it refers to business personal property. Improvements and betterments, additions, alterations, or improvements made to a building by a tenant at their own expense that become part of the building. These improvements belong to the building owner but represent a financial loss to the tenant if destroyed, making them insurable by the tenant. Fixtures, personal property that has been permanently attached to real property and is considered part of the building, such as built-in cabinets, lighting fixtures, or plumbing. Fixtures typically transfer with the property when it is sold and are covered as part of the building rather than as contents. Appurtenant structures, buildings or structures on the insured premises that are used in connection with the main building, such as detached garages, sheds, or fences attached to the main dwelling. These structures are typically covered under Coverage B in homeowners' policies. Detached structures, buildings or structures on the insured premises that are separated from the main building by clear space, such as detached garages, tool sheds, or guest houses. Coverage for detached structures is usually a percentage of the dwelling coverage amount in homeowners' policies. Premises, the specific location or property described in the insurance policy, including the land, buildings, and structures at a defined address. The term defines the physical boundaries where coverage applies and is fundamental to determining what property is insured. Location, a specific site or address where insured property is situated, used in commercial policies to identify where coverage applies. Multiple locations may be covered under a single policy, with separate limits and premiums for each. Buildings, permanent structures with walls and a roof that are used for shelter, storage, or conducting business, including permanently attached fixtures and equipment. Building coverage typically includes the structure itself and materials on premises intended for construction or repair. Structures, constructed improvements on premises that may or may not have walls or roofs, including fences, swimming pools, driveways, and retaining walls. The term is broader than buildings and encompasses various permanent improvements to property. Mobile property, property designed to be moved from place to place, such as construction equipment, trailers, or portable tools and machinery. Mobile property may require special coverage or endorsements because it travels beyond the fixed location premises. Inland marine property, movable property or specialized property that requires broader coverage than standard property policies provide, originally developed for goods in transit, but now covering items like jewelry, fine arts, contractor equipment, and property at multiple locations. Inland marine insurance provides coverage for property that moves from place to place or requires special valuation methods. Friendly fire, a fire that is contained in its intended location, such as a fire in a fireplace, furnace, stove, or candle holder where it is meant to burn. Damage caused by friendly fires is typically excluded from property insurance coverage because the fire is behaving as expected. Hostile fire, a fire that escapes its intended confines or occurs in a place where it was not intended to be, such as a fire that spreads from a fireplace to a carpet or a fire caused by faulty wiring. Hostile fires are covered perils under most property insurance policies. Smoke damage, harm or discoloration to property caused by smoke from a hostile fire or other sudden and accidental events. Most property policies cover sudden and accidental smoke damage, but exclude damage from agricultural smudging, industrial operations, or fireplace smoke that escapes gradually. Water damage, non-flood, damage to property caused by water from sources other than natural flooding, such as burst pipes, plumbing leaks, accidental discharge from appliances, or fire sprinkler activation. This is typically a covered peril, though surface water and groundwater infiltration may be excluded. Flood, the overflow of inland or tidal waters, unusual and rapid accumulation of runoff or surface waters, mud flow, or the collapse of land along a body of water that causes flooding. Standard property policies exclude flood damage, which must be covered through the National Flood Insurance Program (NFIP) or private flood insurance. Catastrophic loss, an extremely large loss event, often affecting multiple insureds simultaneously, such as a hurricane, earthquake, wildfire, or tornado that causes widespread destruction. Catastrophic losses can threaten insurer solvency and often trigger reinsurance, making them a major concern in risk management. Total loss, complete destruction of insured property or damage so extensive that repair costs equal or exceed the property's actual cash value or policy limits. In a total loss, the insurer typically pays the full insured value up to policy limits and may take salvage rights to any remaining property. Partial loss, damage to property where the cost to repair or restore is less than the total value or policy limit, meaning the property can be economically repaired. The insurer pays for the repair or replacement of the damaged portion, and the property remains in service. Constructive total loss, a situation where property is not completely destroyed, but the cost to repair or recover it would exceed its actual cash value or insured value, making repair economically impractical. The insurer treats it as a total loss and pays the full insured value rather than repair costs. Pair and set clause, a policy provision that limits the insurer's liability when one item from a matched pair or set is lost or damaged, paying only for the loss of that individual item rather than the reduced value of the entire set. The insurer may pay the difference in value before and after the loss or offer to replace the lost item, but is not obligated to pay for the full set. Inherent vice, a defect or quality within property itself that causes it to deteriorate, decay, or self-destruct without external influence, such as rust, mold, decomposition, or spontaneous combustion. Property insurance policies exclude losses caused by inherent vice because these are not fortuitous events, but predictable outcomes of the property's nature. Latent defect, a hidden flaw or defect in property that is not discoverable through reasonable inspection and may cause damage later. While standard property policies typically exclude damage from latent defects that cause gradual deterioration, sudden and accidental damage resulting from a latent defect may be covered depending on policy language. Mechanical breakdown, failure of machinery, equipment, or systems due to mechanical causes such as wear and tear, lack of maintenance, or internal malfunction rather than external physical damage. Standard property policies exclude mechanical breakdown, which requires separate equipment breakdown, boiler and machinery coverage. Boiler explosion, the sudden and violent rupture of a steam boiler, pressure vessel, or similar equipment due to internal steam or fluid pressure. While fire-related explosions are typically covered under standard property policies, comprehensive boiler and machinery coverage provides broader protection for equipment breakdown and explosion. Collapse, the sudden falling down or caving in of a building or structure or any part thereof, with the result that the structure cannot be occupied for its intended purpose. Property policies provide limited coverage for collapse only from specified causes, such as hidden decay, weight of contents, or covered perils, but exclude settling, cracking, or gradual deterioration. Named peril, a coverage approach where the policy specifically lists and covers only those perils explicitly named in the policy, with all other causes of loss excluded. If a loss is caused by a peril not listed, there is no coverage, making this the most restrictive form of coverage. Open peril, special form, a coverage approach that protects against all causes of loss, except those specifically excluded in the policy, providing the broadest form of coverage available. Also called all-risk coverage, this shifts the burden to the insurer to prove an exclusion applies, rather than requiring the insured to prove a peril is covered. Broad form perils, a middle ground coverage approach that includes all basic form perils, plus additional named perils such as falling objects, weight of ice/snow/sleet, and water damage from plumbing or appliances. Broad form provides more coverage than basic form, but less than special, open peril form. Basic form perils, the most limited named perils coverage, typically including fire, lightning, explosion, windstorm, hail, smoke, vandalism, theft, vehicles, aircraft, and riot or civil commotion. This represents the minimum standard coverage in most property insurance forms. Fire, the rapid oxidation of combustible material producing heat, light, and flame, which must be a hostile fire outside its intended location to be covered. Fire is one of the most fundamental covered perils in virtually all property insurance policies. Lightning, a natural electrical discharge from the atmosphere that strikes and damages property directly or causes fire, power surges, or other damage. Lightning coverage typically includes both direct strikes and resultant damage from electrical current. Internal explosion, a sudden and violent bursting or rupturing of equipment or containers within a building due to internal pressure, such as a furnace explosion or steam pipe rupture. This excludes explosions caused by certain excluded perils, but covers accidental internal pressure-related damage. Windstorm, damage caused by strong winds, including straight-line winds, tornadoes, and hurricanes, but typically excluding damage to property inside a building unless the wind first damages the building's exterior. Coverage may exclude or limit wind-driven rain unless the wind first creates an opening in the roof or walls. Hail, precipitation in the form of solid ice that falls from clouds and causes impact damage to property. Hail damage is a covered peril under most property policies, commonly affecting roofs, siding, and vehicles. Riot or civil commotion, damage caused by violent public disturbances involving 3 or more people, including looting, vandalism, and destruction during protests or uprisings. This peril covers both direct damage from rioters and indirect damage, such as fires set during civil unrest. Aircraft, damage caused by aircraft, spacecraft, or objects falling from them, including direct impact, explosions, and falling debris. Coverage applies whether the aircraft is manned or unmanned, such as drones, and includes damage from crashes or dropped cargo. Vehicles, damage caused by land vehicles or watercraft striking or colliding with buildings or other insured property. This typically excludes damage caused by vehicles owned or operated by the insured or residents of the household. Smoke, sudden and accidental damage caused by smoke from a hostile fire or from a faulty heating or cooking unit. Policies typically exclude smoke from agricultural smudging, industrial operations, or smoke that escapes from fireplaces gradually over time. Volcanic action, direct loss caused by volcanic eruption, explosion, or lava flow, as well as airborne volcanic blast, ash, dust, or particulate matter. Multiple volcanic eruptions within a 72-hour period are typically considered a single occurrence for deductible purposes. Vandalism, intentional and malicious damage to or destruction of property by unauthorized persons. Coverage typically applies to willful acts of destruction but may be limited or excluded if the building has been vacant beyond a specified period, often 60 days. Malicious mischief, VMM, willful and intentional damage to property similar to vandalism, often grouped together as vandalism and malicious mischief. The terms are largely interchangeable in insurance contexts, and both refer to intentional destructive acts by third parties. Theft, the unlawful taking of property belonging to another with the intent to deprive the owner of it permanently. Property policies vary in theft coverage, with some forms including it as a basic peril and others requiring it as an optional endorsement, particularly for dwelling policies. Sprinkler leakage, damage caused by accidental discharge or leakage of water or other substances from automatic fire protective systems, including sprinkler systems, standpipes, and fire detection systems. This covers both water damage and the cost to repair or replace damaged parts of the system. Sinkhole collapse, the sudden sinking or collapse of land into underground voids or cavities created by the dissolving of limestone or similar rock formations. This peril is distinguished from general earth movement, which is excluded, and is particularly relevant in states like Florida, with significant karst geology. Weight of ice, snow, or sleet, damage caused by the accumulation of frozen precipitation that becomes too heavy for structures to support, causing roofs to collapse or sag. This peril covers sudden damage from excessive weight, but typically excludes damage to outdoor property like fences or awnings. Falling objects, damage caused by objects that fall and strike the exterior of a building or structure, with interior damage covered only if the falling object first damages the roof or exterior wall. This excludes damage to objects that fall within a building unless the building's exterior is damaged first. Accidental discharge or overflow of water, steam, sudden and accidental release of water or steam from within plumbing, heating, air conditioning systems, or household appliances, including bursting pipes and washing machine overflows. This typically excludes damage from continuous or repeated seepage, slow leaks, or freezing while the building is vacant. Sudden and accidental damage from artificially generated electrical current, Coverage for damage to electrical devices, appliances, and wiring caused by power surges, short circuits, or other electrical disturbances from artificially generated sources. This typically excludes damage from natural electrical events like lightning, which is covered separately, and may exclude wear and tear or mechanical breakdown. Ordinance or law, as a cause of increased cost, the additional expense incurred when repairing or rebuilding damaged property to comply with current building codes, zoning laws, or ordinances that require upgrades beyond simple restoration. Standard policies typically exclude or limit this coverage, requiring a separate endorsement to cover the increased costs of code compliance. Basic Form, DP1, CP 1010, the most restrictive property insurance form that provides named peril coverage for a limited list of perils, typically including fire, lightning, explosion, windstorm, hail, smoke, vandalism, theft, vehicles, aircraft, and riot or civil commotion. Indwelling policies DP1 and commercial property policies CP 1010, this form offers the least comprehensive protection at the lowest premium. Broad Form DP2 CP 1020, a property insurance form that covers all basic form perils plus additional named perils such as falling objects, weight of ice, snow, sleet, freezing of plumbing, and accidental water damage from household systems. This middle-tier coverage provides more protection than basic form, but less than special form, offering a balance between coverage, breadth, and cost. Special Form DP3 CP 1030, the broadest property insurance form providing open peril, all-risk coverage that protects against all causes of loss except those specifically excluded. Indwelling policies DP3 and commercial property policies CP 1030. This form covers the building on an open peril basis, while personal property may be covered on a named peril basis. Dwelling policy DP forms, a package of property insurance forms DP1, DP2, DP3, designed to insure residential buildings that don't qualify for homeowners' policies, such as rental properties, vacant homes, or properties under renovation. Dwelling policies provide more limited coverage than homeowners' policies and typically exclude liability coverage unless added by endorsement. Homeowners' forms H01 to H08, a series of standardized property and liability insurance policies designed for owner-occupied residences, ranging from H01, basic coverage, rarely used, to H08, modified coverage for older homes. Common forms include H02, broad form, H03, special form, most popular, H04, renters, H05, comprehensive, and H06, condominium unit owners. Scheduled property, valuable items that are specifically listed, scheduled, on a policy or endorsement with individual descriptions and agreed values for each item. Scheduling provides broader coverage without deductibles and establishes values in advance for items like jewelry, fine arts, cameras, or furs. Blanket property coverage, insurance coverage that applies a single limit to multiple items, categories of property, or locations without specifying individual values for each. Blanket coverage provides flexibility by allowing the full limit to apply wherever the loss occurs, rather than being restricted to separate limits per item or location. Specific coverage, insurance that applies a separate, designated limit to a particular item, category, or location, as opposed to blanket coverage. Each specifically insured item or location has its own limit, and the full policy limit cannot be applied to any single item beyond its specified amount. Coverage A, dwelling. The portion of a property policy that covers the physical structure of the residence, including attached structures, permanently installed fixtures, and materials on premises for construction or repair. This is the primary coverage in homeowners and dwelling policies and typically serves as the base amount from which other coverage limits are calculated. Coverage B, other structures. Coverage for structures on the insured premises that are separated from the dwelling by clear space, such as detached garages, sheds, fences, or swimming pools. This coverage is typically 10% of the Coverage A dwelling limit and does not cover structures used for business purposes or rented to non-residents. Coverage C, personal property. Coverage for the insured's movable belongings, including furniture, clothing, electronics, and other contents, whether at the insured location or temporarily away from premises. In homeowners' policies, this coverage is typically 50 to 75% of the Coverage A dwelling limit and may include property of household members and guests. Coverage D, fair rental value. Coverage in dwelling policies that reimburses the insured for lost rental income when a covered loss makes the dwelling uninhabitable and rental income is lost. This covers the fair rental value of the portion of the premises rented to others or held for rental, minus expenses that do not continue. Coverage E, additional living expense. Coverage that pays for the reasonable increase in living expenses when a covered loss makes the residence uninhabitable, requiring the insured to live elsewhere temporarily. This includes costs such as hotel bills, restaurant meals, and temporary storage that exceed the insured's normal living expenses. Coverage F, medical payments, homeowners, Section 2, no-fault coverage that pays medical expenses for persons injured on the insured's premises or by the insured's activities, regardless of legal liability. This coverage applies to guests and others, not household members, and typically has a per-person limit of $1,000 to $5,000. Extensions of coverage. Additional amounts of insurance automatically provided beyond the basic policy limits for specific types of property or situations, such as property off-premises or newly acquired property. These extensions provide small additional limits without requiring endorsements and typically have conditions or sublimits attached. Additional coverages. Specific types of coverage automatically included in a policy that provide protection for certain expenses or property, often with separate sublimits. Examples include debris removal, fire department service charges, reasonable repairs, and tree/shrub/plant coverage in homeowners' policies. Vacancy, the condition where a building has no people or contents present, typically for a continuous period exceeding 60 days. Vacancy clauses in property policies may suspend or reduce coverage for certain perils like vandalism, theft, glass breakage, and water damage because vacant properties face increased risk. Unoccupancy, the condition where a building contains property but has no people present, such as when occupants are temporarily away on vacation. Unoccupancy generally does not trigger the same coverage restrictions as vacancy because the property remains furnished and maintained. Inflation guard, an endorsement or automatic policy feature that periodically increases property coverage limits to keep pace with inflation and rising construction costs. The coverage typically increases by a specified percentage, such as 2 to 4% annually, on a quarterly or annual basis to prevent underinsurance. Newly acquired property, automatic extension of coverage to property acquired during the policy period, subject to time limits and conditions for reporting to the insurer. In homeowners' policies, this may include coverage for newly purchased residences or additional properties for a limited time before they must be specifically added to the policy. Debris removal, additional coverage that pays the cost of removing debris of covered property following a covered loss, including the expense of hauling away damaged materials. This is typically included as an additional coverage with a limit, often 25% of the loss payment plus the policy limit, or a fixed dollar amount. Fire department service charge, coverage for fees charged by a fire department for responding to a fire or emergency at the insured location, up to a specified limit, typically $500 to $1,000. This applies regardless of whether fire actually damages the property, and is an additional coverage in most property policies. Property in transit, coverage extension that protects personal property while being moved from one location to another, typically limited to a percentage of the personal property coverage, often 10%. This provides temporary coverage during moves, but is subject to specific conditions and time limitations. Seasonal increase provisions, a provision that automatically increases coverage limits during specific times of the year, when property values or inventory levels are higher than normal. This is particularly useful for businesses with seasonal fluctuations in inventory, allowing higher limits without year-round premium increases. Ordinance or law coverage. Additional coverage for the increased costs of rebuilding or repairing damaged property to comply with current building codes, zoning ordinances, or laws. Standard policies provide limited or no coverage for these additional expenses, making this endorsement important when codes have changed since construction. Builders' risk coverage, specialized property insurance that covers buildings under construction, including materials, supplies, and equipment at the job site. Coverage applies during the construction period and typically protects against most perils, with the policy automatically terminating when construction is complete or the building is occupied. Reporting form, a commercial property coverage form where the insured regularly reports property values to the insurer, monthly or quarterly, and the premium is adjusted based on these reports. This is ideal for businesses with fluctuating inventory levels, as it ensures adequate coverage while avoiding overpayment for coverage during low inventory periods. Peak season endorsement. An endorsement that temporarily increases property coverage limits during predictable periods when inventory or property values are higher than normal. This allows businesses to increase coverage during busy seasons, like holidays for retailers, without maintaining higher limits and premiums year-round. Condominium coverage forms, HO6 concept, a specialized homeowners policy designed for condominium unit owners that covers personal property, improvements, and betterments to the unit, loss assessment, and personal liability. HO6 policies coordinate with the Condominium Association's master policy, which typically covers the building structure and common areas. Replacement cost endorsement, a policy provision or endorsement that pays to replace damaged property with new property of like kind and quality without deducting for depreciation. This provides more favorable claim payments than actual cash value, but may require the insured to actually repair or replace the property to receive the full replacement cost benefit. Functional replacement cost, a valuation method that pays to replace damaged property with less expensive but functionally equivalent materials or construction used primarily for older or obsolete buildings. This allows reconstruction using modern materials and methods that serve the same purpose as the original, even if not identical in quality or appearance. Landlord furnishings, coverage for furniture, appliances, and other personal property owned by a landlord and provided for tenants' use in rental properties. This is typically added by endorsement to homeowners or dwelling policies and covers items like refrigerators, stoves, washers, and dryers. Loss assessment coverage, coverage that pays the insured's share of assessments charged by a homeowners association or condominium association for covered losses to common property. This applies when the association's master policy limits are exhausted or when the association levies a special assessment to cover a loss or deductible. Scheduled personal property endorsement, an endorsement that provides broader, open peril coverage for specifically listed valuable items with agreed values, such as jewelry, furs, fine arts, cameras, or musical instruments. Scheduled items receive higher limits, no deductibles, and coverage for perils typically excluded under the base policy, such as mysterious disappearance. Functional replacement cost, a valuation method that pays to replace damaged property with less expensive but functionally equivalent materials or construction used primarily for older or obsolete buildings. This allows reconstruction using modern materials and methods that serve the same purpose as the original, even if not identical in quality or appearance. Broad evidence rule, a legal doctrine that allows consideration of multiple types of evidence to determine property value rather than relying solely on actual cash value or replacement cost formulas. This rule permits use of various valuation methods, including market value, tax assessments, original cost, reproduction cost, and expert opinions to establish the most accurate value. Guaranteed replacement cost, a coverage provision that pays the full cost to rebuild or replace damaged property, even if it exceeds the policy limit, with no cap on the amount the insurer will pay. This provides the most comprehensive protection, but typically requires the insured to insure the property to 100% of estimated replacement cost, and may have restrictions on eligibility. Extended replacement cost, a coverage enhancement that pays a specified percentage, typically 25% or 50%, above the policy limit to rebuild or replace damaged property when costs exceed the coverage amount. This provides a cushion for underinsurance or unexpected cost increases, but has a defined maximum, unlike guaranteed replacement cost, which has no limit. Inflation protection, coverage that automatically increases policy limits over time to keep pace with rising construction costs and inflation, similar to Inflation Guard. This ensures the insured maintains adequate coverage as building costs increase, typically through periodic automatic increases based on a specified percentage or construction cost index. Depreciation, the decrease in property value over time due to age, wear and tear, and obsolescence, calculated when determining actual cash value. Depreciation is deducted from replacement cost to arrive at actual cash value, representing the loss of value between new property and property in its current condition. Repair cost, the actual expense required to restore damaged property to its condition before the loss, including labor, materials, and contractor fees. Repair cost may be less than replacement cost if the property can be fixed rather than completely replaced, and insurers typically pay the lesser of repair or replacement cost. Value reporting, a requirement in reporting form policies where the insured must periodically submit statements to the insurer showing the current value of insured property, typically inventory or stock. Premium is adjusted based on these reports, and failure to report accurately can result in penalties or reduced claim payments. Coinsurance penalty, a reduction in claim payment that occurs when the insured fails to maintain insurance equal to the required percentage of property value, typically 80%, 90%, or 100%. The penalty formula pays the proportion of the loss that the amount of insurance carried bears to the amount required, meaning underinsurance results in proportionally reduced claim payments even for partial losses. Ordinance or law increased cost of construction. The additional expense incurred when building codes or ordinances require upgrades, improvements, or different construction methods when repairing or rebuilding damaged property beyond what existed before the loss. This can include costs to bring undamaged portions of the building into compliance when a certain percentage is damaged, demolition of undamaged portions, and increased construction costs due to current code requirements. Appraisal, a dispute resolution process specified in property insurance policies where each party selects an appraiser, the two appraisers select an umpire, and they jointly determine the amount of loss when the insured and insurer cannot agree on value. A decision agreed to by any two of the three is binding, providing a faster and less expensive alternative to litigation while the coverage question remains with the insurer. Valuation clause, the policy provision that specifies how the value of covered property will be determined in the event of a loss, such as actual cash value, replacement cost, agreed value, or market value. This clause establishes the method for calculating claim payments and prevents disputes by setting clear valuation standards at policy inception. Special limits, specific maximum dollar amounts that apply to certain categories of personal property, which are lower than the overall personal property coverage limit. These limits restrict coverage for high-value or theft-prone items like jewelry, money, firearms, and silverware, requiring separate scheduling or endorsements for full protection. Money and securities limit, a special limit, typically $200 to $500, that applies to currency, banknotes, coins, precious metals, securities, stamps, and similar property. This low limit reflects the difficulty in proving loss and high risk of theft, requiring separate coverage or scheduling for substantial amounts. Jewelry limit, a special limit, typically $1,000 to $2,500, that applies to the theft of jewelry, watches, furs, and precious stones under the personal property coverage. This limit applies per occurrence, not per item, and higher value jewelry should be scheduled separately to receive full coverage without a deductible. Firearms limit, a special limit, typically $2,000 to $2,500, that applies to the theft of firearms and related equipment. While fire and other covered perils may provide full coverage up to the personal property limit, theft coverage for guns is restricted unless items are specifically scheduled. Silverware, goldware limit, a special limit, typically $2,500, that applies to the theft of silverware, silver-plated ware, goldware, gold-plated ware, and pewterware. This sublimit protects insurers from large losses on valuable metal items while still providing basic coverage for typical household silverware. Business personal property limit, a special limit, typically $2,500, that applies to property used for business purposes on the insured premises or away from premises. This recognizes that homeowners' policies are not designed for business exposures, and substantial business property requires separate commercial coverage. Electric appliances limit, a special limit that may apply to portable electronic equipment, tools, and appliances, particularly for certain causes of loss or when away from premises. Some policies have sublimits for items like laptops, tablets, and tools to manage exposure to theft and damage. Watercraft limit, a special limit, typically $1,000 to $1,500, that applies to watercraft, including boats, motors, trailers, furnishings, equipment, and outboard engines. Larger or more valuable watercraft require separate boat insurance policies for adequate protection. Trailers limit, a special limit, typically $1,000 to $1,500, that applies to trailers not used with watercraft, such as utility trailers, cargo trailers, or campers. This provides basic coverage for small trailers while requiring separate policies for valuable recreational vehicles or commercial trailers. Property away from premises limit, a special limit, typically 10% of personal property coverage, that applies to personal property temporarily away from the insured premises, anywhere in the world. This extension provides some coverage for belongings taken on trips or stored elsewhere, but has percentage-based restrictions. Property of guests or residence employees, a special limit, typically $500, that applies to personal property belonging to guests, social visitors, or residence employees while at the insured's premises. This provides limited goodwill coverage for others' belongings, but is not intended to replace their own insurance. Electronic data limit, a special limit, typically $2,500, that applies to the cost to research, replace, or restore electronic data, including software, programs, and electronically stored information. Standard homeowners' policies provide minimal coverage for data loss, as this exposure is better addressed through backups and cyber insurance. Theft limitations, reduced coverage limits that apply specifically when certain high-value categories of property are stolen, even though the same items might be covered for their full value under other covered perils like fire. These limitations prevent adverse selection and large theft claims on easily stolen, high-value items that should be scheduled for full coverage. Loss settlement condition, a policy provision that specifies how the insurer will calculate and pay claims, including the valuation method, actual cash value or replacement cost, and any requirements the insured must meet to receive payment. This condition establishes whether depreciation will be deducted and may require actual repair or replacement before full replacement cost is paid. Loss payment condition, the policy provision that specifies when and how the insurer will pay claims, including the time frame for payment after proof of loss, is submitted and any conditions that must be satisfied. This establishes the insurer's obligation to pay within a reasonable time, often 30 to 60 days, after agreement on the loss amount or receipt of proper documentation. Recovered property condition, a policy provision addressing what happens if stolen property is recovered after a claim has been paid, giving the insured the option to keep the property and return the claim payment or allow the insurer to keep the recovered property. If property is recovered before settlement, The insurer typically takes possession and pays for any damage that occurred. Pair and set condition. A policy provision that limits the insurer's liability when one item from a matched pair or set is lost or damaged, paying only for the loss of that individual item rather than the reduced value of the entire set. The insurer may pay the difference in value before and after the loss or offer to replace the lost item, but is not obligated to pay for the full set. Mortgage clause. A policy provision that protects a mortgagee's, lender's, financial interest in insured property, ensuring the lender receives claim payments for property damage even if the insured's coverage is void or denied. The standard mortgage clause makes the mortgagee an additional party to the insurance contract with independent rights. Standard mortgagee clause. A specific type of mortgage clause that gives the mortgagee rights that are not affected by the acts, omissions, or negligence of the property owner, creating a separate contract between the insurer and lender. Even if the insured violates policy conditions that would void coverage, the mortgagee still has a valid claim for their interest in the property. Loss payable clause, a provision that designates a third party, such as a lien holder or secured creditor, to receive claim payments. But unlike a standard mortgagee clause, this party's rights are dependent on the insured maintaining valid coverage. If the insured breaches policy conditions and voids coverage, the loss payee has no independent claim against the insurer. Bailee, a person or business that temporarily holds another's property for a specific purpose, such as repair, storage, or transportation, without taking ownership. Bailees may have liability for property in their care, custody, or control, and can obtain Bailee's customer insurance to protect clients' property. Control of property. A policy condition reserving the insurer's right to take charge of damaged property, direct repairs, and make decisions about salvage after a covered loss. This allows the insurer to minimize losses, prevent further damage, and manage the claims process effectively while protecting the insured's interests. No benefit to bailee. A policy condition stating that bailees or other parties holding the insured's property do not receive any rights or benefits under the policy. This prevents bailees from claiming under the policy and ensures they must maintain their own insurance for legal liability for property in their care. Duties after loss. Policy conditions requiring the insured to take specific actions following a loss, including giving prompt notice to the insurer, protecting property from further damage, preparing an inventory of damaged property, providing documentation, submitting to examination under oath, and cooperating with the investigation. Failure to fulfill these duties can jeopardize coverage or delay claim payment. Neglect. A policy provision that excludes coverage for loss or increased damage resulting from the insured's neglect to use reasonable means to save and preserve property after a loss. This requires the insured to take reasonable steps to protect property from further damage, such as covering a roof hole or shutting off water after a pipe bursts. Protective safeguards endorsement. An endorsement requiring the insured to maintain specific protective devices or systems, such as fire alarms, sprinkler systems, or security systems, in working order as a condition of coverage. Failure to maintain these required safeguards can result in claim denial or policy cancellation, and the endorsement may specify penalties for non-compliance. Vacancy permit. An endorsement that modifies or removes standard vacancy restrictions, allowing coverage to continue when a building is vacant beyond the normal 60-day limit. This endorsement is essential for buildings undergoing renovation, held for sale, or otherwise legitimately vacant for extended periods, though coverage may be modified and premium increased. Concealment or fraud. A policy condition stating that the entire policy is void if the insured has intentionally concealed or misrepresented any material fact or committed fraud relating to the insurance before or after a loss. This gives the insurer the right to deny all claims and cancel the policy if the insured has acted dishonestly. Severability of insurance. A policy provision stating that the insurance applies separately to each insured, treating each as if separately insured, except with respect to policy limits. This means one insured's violations or knowledge don't necessarily affect another insured's coverage, though all insureds share the same policy limits. Earth movement exclusion. A policy exclusion that eliminates coverage for damage caused by earthquakes, landslides, mudslides, sinkholes, in some states, earth sinking, rising or shifting, and other movement of the earth. This exclusion applies regardless of the cause of the earth movement, and earthquake coverage must be purchased separately through endorsements or standalone policies. Water flood exclusion. An exclusion that eliminates coverage for damage caused by surface water, waves, tidal water, overflow of bodies of water, or water that backs up through sewers or drains. This applies to natural flooding from external water sources, and flood coverage must be obtained through the National Flood Insurance Program (NFIP) or private flood insurance. Power failure off-premises. An exclusion for loss caused by failure of power or other utility service if the failure occurs away from the insured premises. Coverage applies only if the off-premises power failure results from direct physical damage to the power source by a covered peril, such as a tree falling on power lines during a windstorm. Governmental action. An exclusion for loss resulting from seizure, confiscation, destruction, or damage to property by order of governmental or civil authority. This includes property condemned, quarantined, or destroyed by government order, though coverage may apply if the government action results from efforts to control a covered peril like fire. Nuclear hazard. An exclusion that eliminates coverage for loss caused by nuclear reaction, radiation, or radioactive contamination, whether controlled or uncontrolled, and whether resulting from natural, accidental, or deliberate causes. This broad exclusion applies to nuclear weapons, power plant accidents, and radioactive materials exposure. Intentional loss. An exclusion that eliminates coverage for damage that the insured intentionally causes or directs someone else to cause. This prevents insurance from being used to profit from deliberate acts of destruction, though intentional acts by others, like vandalism, remain covered if the insured was not involved. Wear and tear. An exclusion for damage resulting from normal, gradual deterioration that occurs through regular use of property over time. This includes natural aging, routine degradation, and expected breakdown of materials, which are considered maintenance issues rather than fortuitous insurable events. Deterioration. An exclusion for gradual decline in property condition caused by time, weather exposure, lack of maintenance, or inherent defects. Deterioration is considered a predictable, preventable loss that property owners should address through regular upkeep rather than through insurance. Rust or corrosion. An exclusion for damage caused by oxidation of metal or gradual chemical decomposition of materials over time. This is considered a maintenance issue and natural consequence of age and exposure rather than a sudden, fortuitous event that insurance is designed to cover. Smog. An exclusion for damage caused by smoke or chemical fumes that occur gradually or repeatedly over time, typically from industrial pollution or environmental conditions. This differs from sudden and accidental smoke damage, which is covered, and addresses chronic air pollution exposure. Settling, cracking, shrinking, bulging. An exclusion for damage caused by natural movement or structural changes in buildings, including foundation settling, wall cracking, expansion and contraction of materials, or bulging of walls and floors. These are considered inherent building characteristics or maintenance issues unless caused by a covered peril. Infestation. An exclusion for damage caused by birds, rodents, insects, vermin, or other animals, including nesting, chewing, contamination, and destruction. This is considered a preventable maintenance and pest control issue, though ensuing covered losses, like fire from rodents chewing wiring, may be covered. Mold/fungus rot. An exclusion for damage caused by mold, mildew, fungus, wet or dry rot, and bacteria growth, which typically results from moisture, humidity, or water intrusion over time. Limited coverage may be provided for mold resulting from a sudden covered water loss, but chronic or long-term mold conditions are excluded. Mechanical breakdown, an exclusion for loss caused by mechanical failure, breakdown, or malfunction of equipment, machinery, or systems due to wear, aging, or lack of maintenance. This includes failures of heating, cooling, electrical, or plumbing systems unless caused by a covered peril, and requires separate equipment breakdown coverage for protection. Pollution exclusion, an exclusion that eliminates coverage for contamination, pollution, or environmental damage caused by discharge, release, or escape of pollutants, including chemicals, waste, or hazardous materials. This broad exclusion protects insurers from potentially catastrophic environmental cleanup costs, though some sudden and accidental pollution events may have limited coverage. Neglect exclusion, an exclusion for loss or increased damage that results from the insured's failure to use reasonable means to save and preserve property at and after the time of loss. This requires insureds to take protective action, like covering broken windows, turning off water, or securing the property to prevent additional damage after a covered loss occurs. Ordinance or law exclusion applies without endorsement, a standard policy exclusion that eliminates coverage for increased costs of construction required by building codes, zoning ordinances, or laws when repairing or rebuilding damaged property. This includes costs to upgrade undamaged portions of buildings, demolish portions not damaged by the covered peril, and meet current code requirements that exceed pre-loss construction standards, requiring a separate ordinance or law endorsement for coverage. Concurrent causation, a situation where a covered peril and an excluded peril work together simultaneously to cause a loss, creating ambiguity about whether coverage applies. Under traditional concurrent causation doctrine, if a covered peril contributes substantially to the loss, coverage may apply even if an excluded peril is also involved. Anti-concurrent causation clause, a policy provision that eliminates coverage when a loss involves both covered and excluded perils working together, even if the covered peril contributed to the loss. This clause states that if any excluded cause contributes to the loss in any sequence, no coverage applies, preventing coverage disputes over concurrent causation. Replacement cost provision, a policy clause that provides payment for the full cost to repair or replace damaged property with new materials of like kind and quality, without deducting for depreciation. Payment is typically made in two stages: actual cash value initially, then the recoverable depreciation after repairs are completed or replacement is made. Salvage value, the residual value of damaged property that can be sold or recovered after a loss, which the insurer may take possession of after paying a total loss claim. Salvage reduces the insurer's net loss by allowing recovery of some value from damaged goods through sale to salvage buyers or repair facilities. Abandonment clause, a policy provision stating that the insured cannot abandon damaged property to the insurer and demand full payment for a total loss. The insurer has the option, but not the obligation, to take possession of salvage after paying a claim, and the insured must retain ownership unless the insurer chooses otherwise. Suit against us clause, a policy condition requiring that no legal action can be brought against the insurer unless the insured has fully complied with all policy provisions and the action is started within a specified time period, typically 1 or 2 years, after the loss. This establishes conditions precedent to litigation and a statute of limitations for filing suit against the insurer. Other insurance clause, property version, a policy provision that specifies how coverage applies when multiple policies cover the same property and loss, preventing the insured from collecting more than the actual loss. The clause typically provides for pro rata contribution among insurers based on their respective policy limits, or uses an excess approach where one policy pays first. Pro rata liability clause, a provision in the other insurance clause stating that when multiple policies cover the same loss, each insurer pays its proportionate share based on the ratio of its limit to the total of all applicable limits. For example, if 2 policies with limits of $100,000 and $200,000 both apply, They would pay losses in a 1-to-2 ratio. Contribution by equal shares, a method of apportioning loss payment among multiple insurers where each policy pays an equal amount until one policy's limit is exhausted, then remaining policies continue paying equally. This approach is used less commonly than contribution by limits, and can result in different outcomes depending on the size of the loss and policy limits. Contribution by limits, a method of apportioning loss payment among multiple insurers where each policy contributes based on the proportion its limit bears to the total of all applicable limits, regardless of the actual loss amount. This is the most common method and ensures each insurer pays its fair share based on the coverage it provided. Excess coverage, insurance that applies only after other applicable coverage, primary insurance, is exhausted, providing additional limits above the primary policy. Excess policies typically drop down to cover losses only when the underlying coverage is used up, and they may follow the terms of the primary policy or have independent terms. Primary coverage, insurance that pays first when a loss occurs, up to its policy limits, before any excess or secondary coverage applies. Primary policies have first dollar coverage responsibility, subject to deductibles, and must respond to covered losses before excess insurers have any obligation to pay. Inflation Guard, an endorsement or automatic policy feature that periodically increases property coverage, limits to keep pace with inflation and rising construction costs. The coverage typically increases by a specified percentage, such as 2 to 4% annually, on a quarterly or annual basis to prevent underinsurance. Ordinance or law, additional coverage, by endorsement, for the increased costs of rebuilding or repairing damaged property to comply with current building codes, zoning ordinances, or laws. This endorsement typically provides 3 coverages: loss to the undamaged portion of the building that must be demolished, demolition costs, and increased construction costs to meet current code requirements. Scheduled personal property, valuable items that are specifically listed on a policy or endorsement with individual descriptions and agreed values, providing broader open peril coverage without deductibles. Common scheduled items include jewelry, fine arts, cameras, musical instruments, furs, and collectibles that exceed standard policy sublimits. Backup of sewers and drains, an endorsement that covers damage caused when water or sewage backs up through sewers, drains, or sump pumps into the insured building. This coverage is typically excluded under standard homeowners' policies and must be added separately, providing protection against a common source of water damage. Identity theft expense coverage, an endorsement that reimburses the insured for expenses incurred to restore their identity and credit after identity theft, including legal fees, lost wages, document refiling costs, and credit monitoring services. This covers the costs of recovery rather than direct financial losses from the theft itself, which may be covered by other means. Equipment breakdown, coverage that protects against loss from mechanical or electrical breakdown of equipment, boilers, pressure vessels, and systems, including damage to the equipment itself and resulting property damage or business interruption. This extends beyond standard property coverage by including failures from causes like arcing, motor burnout, or operator error that would otherwise be excluded. Personal property replacement cost endorsement, an endorsement that changes the valuation of personal property contents from actual cash value to replacement cost, eliminating the depreciation deduction. This provides more favorable claim payments by paying the full cost to replace damaged items with new ones of like kind and quality, subject to the insured actually replacing the items. Watercraft endorsement, an endorsement that increases coverage limits for boats, watercraft, motors, trailers, and related equipment beyond the standard sublimits in homeowners' policies. This provides higher limits for physical damage to watercraft, but typically does not include liability coverage, which requires a separate boat policy for adequate protection. Home business endorsement, an endorsement that provides limited coverage for business personal property, business liability, and business income losses when a business is operated from the insured's home. This bridges the gap between personal homeowners coverage, which excludes most business exposures, and full commercial insurance, though substantial businesses require separate commercial policies. Permitted incidental occupancies, a policy provision or endorsement that allows limited business or professional activities to be conducted from the residence without voiding coverage, such as home offices, private teaching, or small-scale operations. This recognizes that many homeowners conduct minor business activities while maintaining primarily residential use of the property. Secondary residence endorsement, an endorsement that modifies coverage for properties that are not the insured's primary residence, such as vacation homes or seasonal properties, addressing unique exposures like extended vacancy periods and different usage patterns. This may adjust coverage terms, provide appropriate seasonal protection, and modify conditions that apply differently to non-primary residences. Short-term rental endorsement, an endorsement that provides coverage when the insured rents their home or rooms through platforms like Airbnb or VRBO, addressing exposures that standard homeowners policies exclude. This covers property damage, liability, and theft risks associated with short-term rentals, filling the gap between personal homeowners and commercial rental property insurance. Liability, legal responsibility for one's actions or omissions that cause harm or injury to another person or their property. When found liable, a party is legally obligated to compensate the injured party for damages, which is why liability insurance is essential. Legal liability, responsibility imposed by law, requiring a party to compensate another for harm, injury, or damages they have caused through their actions, omissions, or operations. Legal liability must be established through legal proceedings or settlement before an obligation to pay exists. Civil liability, legal responsibility arising from private disputes between individuals or organizations where one party seeks monetary compensation for harm suffered, as opposed to criminal liability where the state prosecutes. Civil liability is the foundation of most liability insurance claims and is established through tort law or breach of contract. Criminal liability, legal responsibility for conduct that violates criminal law and is prosecuted by the government, potentially resulting in fines, imprisonment, or other penalties. Insurance does not cover criminal liability, fines, or penalties because allowing such coverage would be against public policy. Tort liability, legal responsibility arising from a civil wrong, tort, that causes harm to another, including negligence, intentional acts, or strict liability. Tort liability forms the basis for most liability insurance claims and requires the injured party to prove the defendant's legal responsibility for damages. Contractual liability, liability that one party assumes through a written or oral contract, agreement, or hold harmless provision, accepting responsibility for another party's potential losses. This type of liability is specifically assumed by agreement rather than imposed by law, and coverage requires an insured contract under most liability policies. Statutory liability, legal responsibility imposed by specific statutes or laws rather than by common law or court decisions, such as workers' compensation, environmental regulations, or consumer protection laws. Statutory liability may impose strict liability or specific obligations beyond traditional tort liability standards. Third-party claim, a claim made by someone other than the insured or insurer seeking compensation for injury or damage allegedly caused by the insured's actions or negligence. In liability insurance, the insured is the first party, the insurer is the second party, and injured parties seeking damages are third parties. Occurrence, an accident, including continuous or repeated exposure to substantially the same general harmful conditions that results in bodily injury or property damage during the policy period. Occurrence-based policies cover events that happen during the policy period regardless of when claims are made, providing long-tail coverage. Claims-made coverage, a type of liability coverage that responds only to claims first made against the insured during the policy period, regardless of when the underlying incident occurred, provided it's after the retroactive date. This differs from occurrence coverage and requires continuous renewal to maintain protection, as claims made after the policy expires are not covered unless an extended reporting period is purchased. Retroactive date: the date specified in a claims-made liability policy before which incidents are not covered, even if the claim is made during the current policy period. Any injury or damage that occurred before the retroactive date is excluded from coverage, making this date critical in determining what claims are eligible. Extended reporting period, ERP: an option to extend the time for reporting claims under a claims-made policy after it expires or is cancelled, covering claims made during the extended period for incidents that occurred during the policy period or after the retroactive date. Also called tail coverage, this is essential when switching insurers or retiring from business to maintain protection for past exposures. Supplemental Extended Reporting Period, SERP: an optional extension beyond the basic extended reporting period that provides additional time, often unlimited, to report claims for covered events that occurred before the policy ended. This must typically be purchased within a short window after policy expiration and provides the most comprehensive tail coverage available. Duty to defend: the insurer's obligation to provide legal defense for the insured against claims or suits seeking damages covered by the policy, even if the allegations are groundless, false, or fraudulent. The duty to defend is broader than the duty to pay damages and continues until the case is resolved, potentially costing more than the actual claim settlement. Duty to indemnify: the insurer's obligation to pay for covered damages, settlements, or judgments on behalf of the insured once legal liability is established. This duty is narrower than the duty to defend and only applies when the insured is actually legally liable for covered damages. Defense costs: legal expenses incurred in defending the insured against claims or lawsuits, including attorney fees, court costs, expert witness fees, and investigation expenses. In most liability policies, defense costs are paid in addition to policy limits and do not reduce the amount available to pay damages. Supplementary payments, liability context: additional payments the insurer makes beyond policy limits for specific expenses related to defending or settling claims, such as bail bonds, appeal bonds, costs of litigation, prejudgment and post-judgment interest, and reasonable expenses incurred by the insured at the insurer's request. These payments typically do not reduce available coverage limits. Bodily injury liability: coverage for legal liability when the insured causes physical injury, sickness, disease, or death to another person. This includes medical expenses, lost wages, pain and suffering, and other damages resulting from bodily harm. Property damage liability: coverage for legal liability when the insured causes physical damage to or destruction of tangible property belonging to others, including loss of use of that property. This covers the cost to repair or replace damaged property and any resulting loss of use or income. Personal injury: coverage for legal liability arising from specified non-physical offenses, including false arrest, malicious prosecution, wrongful eviction, slander, libel, defamation, violation of privacy rights, and wrongful entry. This differs from bodily injury and protects against offenses that harm reputation, freedom, or privacy, rather than causing physical harm. Advertising injury: coverage for legal liability arising from offenses committed during advertising activities, including copyright infringement, misappropriation of advertising ideas, slander of goods or products, and libel in advertisements. This protects businesses against claims related to their marketing and promotional activities. Medical payments to others: no-fault coverage that pays reasonable medical expenses for persons injured on the insured's premises or by the insured's activities, regardless of legal liability, up to a per-person limit. This provides quick payment for minor injuries without requiring proof of negligence and may help prevent liability lawsuits. Legal damages: monetary compensation awarded by a court or agreed upon in settlement that a legally liable party must pay to an injured party for harm suffered. Legal damages include compensatory damages to restore the injured party and, in some cases, Punitive damages, to punish wrongful conduct. Casualty insurance, a broad category of insurance that covers legal liability for injury to persons or damage to property of others, as distinguished from property insurance, which covers the insured's own property. Casualty insurance includes general liability, auto liability, workers' compensation, and professional liability, protecting against third-party claims. Duty of care, a legal obligation requiring a person or entity to act with reasonable care to avoid causing foreseeable harm to others. The duty of care is the first element that must be established in a negligence claim and varies based on the relationship between parties and the circumstances. Breach of duty. The failure to fulfill or violation of the duty of care owed to another person, occurring when someone acts, or fails to act, in a manner that a reasonable person would not under similar circumstances. Breach of duty is the second essential element of negligence and must be proven to establish liability. Actual cause. The determination that the defendant's actions or omissions were the direct factual cause of the plaintiff's injury, typically established by the but-for test, but for the defendant's conduct, the injury would not have occurred. This must be proven along with proximate cause to establish causation in negligence cases. Reasonable person standard, a legal benchmark used to evaluate whether someone's conduct was negligent by comparing their actions to what a hypothetical reasonable person of ordinary prudence would have done under the same circumstances. This objective standard removes personal characteristics and measures behavior against community norms and common sense. Standard of care, the degree of caution, attention, and prudence that a reasonable person would exercise in a given situation, which varies depending on the circumstances, relationship, and professional status. Professionals are held to higher standards based on their training and expertise, while common carriers and innkeepers may have elevated duties. Foreseeability, the ability to reasonably anticipate that certain actions or conditions might result in harm or injury to others. A defendant is generally liable only for consequences that were foreseeable, as this determines whether a duty of care exists and whether the defendant's conduct was negligent. Gross negligence, an extreme departure from the standard of care that demonstrates reckless disregard for the safety or rights of others, going beyond ordinary negligence. Gross negligence involves conscious and voluntary disregard of the need to use reasonable care and may result in punitive damages or pierce immunity defenses. Imputed negligence, negligence attributed or transferred to one party based on their relationship with another party who was actually negligent, even though the first party was not personally negligent. Common examples include holding employers liable for employees' negligent acts within the scope of employment, vicarious liability, or holding parents liable for children's acts. Negligence per se, conduct that is automatically considered negligent because it violates a statute, ordinance, or regulation designed to protect the public, eliminating the need to prove breach of duty. If a law is violated and injury results to a person the law was designed to protect, negligence is established as a matter of law. Absolute liability, legal responsibility for harm that exists regardless of fault, negligence, or intent, typically imposed for ultra-hazardous activities like blasting, storing explosives, or keeping wild animals. This is the strictest form of liability, where simply engaging in the activity creates responsibility for any resulting damages. Assumption of risk, a legal defense in negligence cases where the defendant argues that the plaintiff voluntarily and knowingly accepted the risks inherent in an activity, thereby relieving the defendant of liability. This defense requires proof that the plaintiff had actual knowledge of the specific risk and voluntarily chose to encounter it. Comparative negligence, a legal doctrine that reduces a plaintiff's recovery in proportion to their own percentage of fault in causing the injury, rather than completely barring recovery. Under pure comparative negligence, damages are reduced by the plaintiff's fault percentage. Under modified comparative negligence, recovery is barred if the plaintiff is 50% or 51%, depending on state, or more at fault. Contributory negligence, a strict legal doctrine, used in few states, that completely bars a plaintiff from recovering any damages if they contributed to their own injury in any degree, even 1%. This harsh rule has been replaced by comparative negligence in most jurisdictions because it often leads to unfair outcomes. Last clear chance doctrine. A legal rule that allows a plaintiff who was contributorily negligent to still recover damages if the defendant had the last clear opportunity to avoid the accident but failed to do so. This doctrine mitigates the harsh effects of contributory negligence by shifting liability to the party who could have prevented the harm. Intervening cause, an independent event or action that occurs after the defendant's negligent act and contributes to or causes the plaintiff's injury, potentially breaking the chain of causation. A superseding intervening cause that is unforeseeable may relieve the original defendant of liability, while foreseeable intervening causes typically do not. Concurrent liability. A situation where two or more parties are simultaneously liable for the same injury or damage, each having independently contributed to the harm through separate acts of negligence. Each party may be held responsible for the entire damage, joint and several liability, or only their proportionate share, depending on jurisdiction. Joint and several liability, a legal doctrine that allows an injured party to recover the full amount of damages from any one of multiple defendants who are liable, regardless of each defendant's percentage of fault. This protects plaintiffs from uncollectible defendants, but can result in one defendant paying more than their proportional share, with the right to seek contribution from co-defendants. Res ipsa loquitur, a legal doctrine meaning the thing speaks for itself, that allows negligence to be inferred from the circumstances when an accident occurs that would not normally happen without negligence. This applies when the instrumentality causing harm was under the defendant's exclusive control. The plaintiff did not contribute to the injury, and the accident is of a type that ordinarily doesn't occur without negligence. Attractive nuisance, a legal doctrine imposing liability on property owners for injuries to children who trespass to access dangerous conditions or artificial features that are likely to attract children, such as swimming pools, trampolines, or construction equipment. Property owners must take reasonable precautions to protect children from hazards they may not appreciate due to their youth. Premises liability. Legal responsibility of property owners and occupiers for injuries that occur on their property due to dangerous conditions or failure to maintain safe premises. The level of duty owed varies based on the injured party's status, invitee, licensee, or trespasser, with the highest duty owed to business invitees. Operations liability, legal responsibility arising from a business's ongoing activities, work, or services performed at the insured's premises or at other locations during normal operations. This covers injuries or damage that occur while work is being performed but before the project is completed and handed over to the customer. Completed operations liability, legal responsibility for bodily injury or property damage that occurs after work has been completed and the premises or product have been turned over to the customer or owner. This exposure continues after the work is finished and can include failures, defects, or deficiencies in the completed work that cause harm later. Products liability, legal responsibility of manufacturers, distributors, suppliers, and retailers for injuries or damage caused by defective or dangerous products they place into the stream of commerce. Products liability can be based on negligence, breach of warranty, or strict liability, and continues throughout the product's useful life. Employers' liability, legal responsibility of employers for work-related injuries or illnesses to employees that fall outside workers' compensation coverage, such as third-party overactions, dual capacity suits, or consequential injuries to family members. This is typically Part 2 of workers' compensation policies and covers lawsuits rather than no-fault statutory benefits. Liquor liability, legal responsibility of businesses that manufacture, distribute, sell, or serve alcoholic beverages for injuries or damage caused by intoxicated persons to whom they provided alcohol. This applies to bars, restaurants, liquor stores, and other commercial establishments, and is excluded from general liability policies, requiring separate coverage. Professional liability, legal responsibility of professionals for financial losses caused by errors, omissions, negligence, or failure to perform professional services according to accepted standards. This coverage protects professionals like doctors, lawyers, accountants, architects, and engineers against claims of professional negligence or malpractice. Directors and officers, D&O liability, legal responsibility of corporate directors and officers for wrongful acts, errors, or omissions in managing the organization, including breach of fiduciary duty, mismanagement, or violations of securities laws. D&O insurance protects individuals from personal liability and the organization for indemnification obligations. Errors and omissions, E&O liability, legal responsibility for financial losses resulting from professional mistakes, negligent acts, oversights, or failure to perform services that should have been performed. This is essentially professional liability insurance for service providers like insurance agents, real estate brokers, consultants, and technology professionals. Malpractice, professional negligence by licensed professionals, especially healthcare providers, lawyers, or accountants, that results in injury or financial loss to clients or patients due to failure to meet professional standards of care. Malpractice claims require proving that the professional's conduct fell below accepted standards and directly caused damages. Garage liability, specialized liability coverage for automobile-related businesses, including auto dealers, repair shops, service stations, and parking garages, covering operations, premises, and garage operations exposures. This includes coverage for injuries from garage operations, damage to customers' vehicles in care, custody, or control, garage keepers, and products completed operations. Auto liability, coverage for legal responsibility when the insured's use, ownership, or operation of a vehicle causes bodily injury or property damage to others. Personal auto policies, PAP, and business auto policies, BAP, provide coverage for damages. The insured becomes legally obligated to pay, plus defense costs. Host liquor liability, limited coverage under general liability policies for liability arising when the insured occasionally serves alcohol at functions but is not in the business of manufacturing, selling, or serving alcoholic beverages. This applies to situations like office parties or corporate events, where alcohol is provided incidentally to business operations. Tenant liability, legal responsibility of renters or lessees for damage to the rented premises, or for injuries that occur on the premises due to the tenant's negligence. Tenants can be held liable for fire damage, structural damage from negligence, or injuries to visitors, making renters' insurance important protection. Pollution liability, legal responsibility for bodily injury, property damage, or cleanup costs resulting from the discharge, release, escape, or disposal of pollutants including chemicals, waste, contaminants, or hazardous materials. Standard general liability policies exclude pollution coverage, requiring specialized environmental liability insurance. Environmental impairment liability, legal responsibility for environmental damage, contamination, and cleanup costs resulting from pollution events, including gradual pollution, sudden accidents, and regulatory compliance obligations. This specialized coverage addresses soil contamination, groundwater pollution, air emissions, and remediation costs excluded from standard policies. Employment practices liability, EPLI, coverage for claims by employees alleging wrongful employment practices including discrimination, harassment, wrongful termination, retaliation, failure to promote, and other workplace-related violations. EPLI protects employers from the significant costs of defending and settling these claims, which are excluded from general liability policies. Advertising liability, legal responsibility arising from offenses committed during advertising activities, including copyright infringement of advertising materials, slander of goods or products, misappropriation of advertising ideas or style of doing business, and libel in advertisements. This is typically included as part of Coverage B in commercial general liability policies. Cyber liability. Legal responsibility and first-party costs arising from data breaches, cyber attacks, network security failures, and privacy violations, including notification costs, credit monitoring, legal defense, regulatory fines, and business interruption. Cyber liability insurance has become essential as traditional policies exclude or provide limited coverage for electronic data and cyber-related losses. Compensatory damages, monetary awards designed to compensate an injured party for actual losses suffered, restoring them to the position they would have been in had the injury not occurred. Compensatory damages include both economic losses, special damages, and non-economic losses, general damages, resulting from the defendant's wrongful conduct. Special damages, compensatory damages for specific calculable financial losses that can be precisely measured and documented, such as medical expenses, lost wages, property damage, rehabilitation costs, and future medical care. Special damages must be specifically proven with evidence like bills, receipts, and income records. General damages, compensatory damages for intangible, non-monetary losses that cannot be precisely calculated, such as pain and suffering, emotional distress, loss of enjoyment of life, and permanent disability. These damages are subjective and determined by the jury or judge based on the nature and severity of the injury. Punitive damages, monetary awards beyond compensatory damages designed to punish the defendant for particularly egregious, malicious, or reckless conduct and to deter similar behavior in the future. Punitive damages are not intended to compensate the victim but to penalize wrongdoing, and most liability insurance policies exclude coverage for punitive damages as against public policy. Exemplary damages, another term for punitive damages, awarded to make an example of the defendant and punish exceptionally harmful, intentional, or reckless conduct. Like punitive damages, exemplary damages serve to deter similar conduct and are typically not insurable because allowing coverage would undermine their punitive purpose. Pain and suffering. General damages awarded for the physical pain, discomfort, and emotional distress experienced by an injured party due to their injuries. This includes both past pain already endured and future pain expected to continue, representing a significant component of many personal injury awards. Loss of consortium. Damages awarded to the spouse or family members of an injured person for the loss of companionship, affection, comfort, sexual relations, and services they previously received. This derivative claim recognizes that serious injuries harm not only the victim, but also their closest relationships. Loss of use. Damages awarded when property damage causes the owner to lose the ability to use their property for a period of time, even if no actual out-of-pocket expense results. For example, when a vehicle is damaged and unavailable, loss of use compensates for the inconvenience and deprivation of transportation, whether or not a rental car is actually obtained. Assumption of risk. A legal defense in negligence cases where the defendant argues that the plaintiff voluntarily and knowingly accepted the risks inherent in an activity, thereby relieving the defendant of liability. This defense requires proof that the plaintiff had actual knowledge of the specific risk and voluntarily chose to encounter it. Contributory negligence, a strict legal doctrine, used in few states, that completely bars a plaintiff from recovering any damages if they contributed to their own injury in any degree, even 1%. As a defense, this allows defendants to avoid liability entirely by proving the plaintiff's own negligence contributed to the accident, making it one of the harshest defenses available. Comparative negligence, a legal defense that reduces a plaintiff's recovery in proportion to their own percentage of fault in causing the injury, rather than completely barring recovery. Defendants use this to reduce damages owed by establishing the plaintiff's contributory fault, with recovery reduced by the plaintiff's fault percentage, pure comparative, or barred if plaintiff is 50 to 51% plus at fault, modified comparative. Intervening cause. A defense arguing that an independent event or action occurred after the defendant's act and was the actual cause of the plaintiff's injury, breaking the chain of causation. If the intervening cause is unforeseeable and superseding, it can relieve the original defendant of liability by establishing they were not the proximate cause of harm. Statute of limitations, a law that sets the maximum time period after an event within which a lawsuit must be filed, after which the claim is forever barred. This defense allows defendants to avoid liability if the plaintiff fails to file suit within the specified period, typically 1 to 6 years depending on the claim type and jurisdiction. Sovereign immunity, a legal doctrine that protects government entities and officials from being sued for damages without their consent, based on the principle that the king can do no wrong. While many states have waived sovereign immunity to some extent through tort claims acts, this defense can still limit or bar claims against governmental bodies. Good Samaritan laws, statutes that provide legal protection from liability for individuals who voluntarily render emergency aid to injured or ill persons, encouraging bystanders to help without fear of lawsuit. These laws typically protect rescuers from ordinary negligence claims, though not gross negligence or reckless conduct, when providing emergency assistance in good faith. Release of liability. A legal document where one party gives up the right to sue another party for past or future claims arising from specified activities or incidents. Releases are often signed before participating in potentially dangerous activities and serve as a complete defense if properly drafted and executed, though they may not bar claims for gross negligence or intentional acts. Waivers, legal agreements where a party voluntarily relinquishes known rights, claims, or privileges, often used to waive the right to sue for injuries that may occur during an activity. Waivers must be clear, specific, and properly executed to be enforceable as a defense, and their validity varies by jurisdiction and circumstance. Hold harmless agreements, contractual provisions where one party agrees to assume liability and protect another party from legal responsibility for specified claims, losses, or damages. These agreements transfer liability risk and serve as both a defense, the indemnitor must defend, and a mechanism for recovering defense and settlement costs from the party who assumed the obligation. Agreement not to sue, a contract where one party promises not to initiate legal action against another party for specific claims or incidents, differing from a release in that rights may be preserved but simply not exercised. This agreement can serve as a complete defense to a lawsuit if the plaintiff violates the agreement by filing suit despite the promise not to do so. Insured contract, a written agreement or contract specifically defined in a liability policy as one for which contractual liability coverage applies, typically including leases, easement agreements, indemnification clauses, and agreements to assume tort liability of others. Not all contracts qualify as insured contracts, and the policy lists specific types that are covered while excluding others like warranties or performance guarantees. Supplementary payments, amounts the insurer pays in addition to policy limits for specific expenses related to a covered claim, such as defense costs, court costs, bail bonds, appeal bonds, prejudgment and post-judgment interest, and reasonable expenses incurred by the insured at the insurer's request. These payments typically do not reduce the available coverage limits for damages. Defense outside limits, a policy structure where defense costs are paid in addition to and do not reduce the policy limits available to pay damages or settlements. This is the standard approach in most liability policies and provides more total protection because legal expenses don't erode the coverage available for actual damages. Defense inside limits, a policy structure where defense costs are paid from and reduce the policy limits available to pay damages or settlements, meaning the total of defense and indemnity cannot exceed the policy limit. This less favorable structure is common in some professional liability and excess policies, requiring careful attention to how defense costs consume available coverage. Hammer clause, a policy provision that limits the insurer's obligation to pay a settlement or judgment if the insured refuses the insurer's recommendation to settle a claim. If the insured rejects a reasonable settlement recommendation and a higher judgment results, the insurer's liability may be capped at the settlement amount that could have been paid, with the insured responsible for the excess. Consent to settle clause, a policy provision requiring the insurer to obtain the insured's consent before settling a claim, giving the insured control over whether their reputation is affected by settlement admissions. This is common in professional liability and directors' and officers' policies where reputation is paramount, but it may be coupled with a hammer clause to prevent unreasonable refusals. Primary liability coverage, insurance that pays first when a loss occurs up to its policy limits before any excess or secondary coverage applies. Primary coverage has first dollar responsibility, subject to deductibles or self-insured retentions, and must respond to covered claims before excess insurers have any obligation. Excess liability coverage, insurance that applies only after underlying primary coverage, is exhausted, providing additional limits above the primary policy. Excess policies typically drop down to cover losses only when the underlying coverage limits are used up, and they may follow the terms of the primary policy or have independent terms. Umbrella liability policy, a broad form of excess liability coverage that provides additional limits above underlying primary policies and may also drop down to provide primary coverage for some exposures not covered by underlying policies. Umbrellas typically require a self-insured retention for drop-down coverage and provide broader coverage than standard excess policies. Follow form excess liability, an excess liability policy that adopts the same terms, conditions, exclusions, and definitions as the underlying primary policy, following its coverage form. This creates consistency between layers of coverage, though follow-form excess policies may have some independent provisions for matters not addressed in the underlying policy. Self-insured retention, the dollar amount of a claim that the insured must pay before the liability insurance policy begins to respond, functioning similarly to a deductible but applying before the insurer has any obligation. SIRs are common in umbrella policies for drop-down coverage and in claims-made policies, and unlike deductibles, the insured typically handles claims within the SIR without insurer involvement. Split liability limits, a liability limit structure that specifies separate maximum amounts for different types of coverage or occurrences, typically expressed as three numbers such as 100/300/50. In auto liability, this commonly represents per-person bodily injury, per-accident bodily injury, and per-accident property damage limits, with each limit applying independently to restrict total payment. Combined single limit, a liability limit structure that provides one total amount of coverage that applies to any combination of bodily injury and property damage claims from a single occurrence, without separate per-person or per-accident sublimits. This offers more flexibility than split limits because the full limit is available regardless of how damages are distributed among injured parties or between bodily injury and property damage. Non-owned liability, coverage for legal liability arising from the insured's use of vehicles they do not own, such as employees' personal vehicles used for business purposes or rental cars. This protects the insured when they are legally liable for accidents involving vehicles they use but do not own, lease, or hire. Hired auto liability, coverage for legal liability arising from the insured's use of vehicles hired, rented, leased, or borrowed with the owner's permission for short-term use. This applies to rental cars, leased vehicles, and temporarily borrowed vehicles, protecting the insured business or individual from liability while using these vehicles. Contractual liability coverage, coverage for liability that the insured assumes under a written contract or agreement, such as indemnification clauses in leases or hold harmless agreements. This coverage only applies to insured contracts as defined in the policy and allows the insured to transfer liability obligations through contract, with the insurance responding to assumed liabilities. Personal injury liability, coverage for legal liability arising from specified non-physical offenses, including false arrest, detention or imprisonment, malicious prosecution, wrongful eviction or entry, slander, libel, defamation, and violation of privacy rights. This coverage B protection in general liability policies addresses harm to reputation, freedom, and privacy rather than bodily injury, providing defense and indemnity for these specific enumerated offenses. Expected or intended injury exclusion, a liability policy exclusion that eliminates coverage for bodily injury or property damage expected or intended from the standpoint of the insured, preventing coverage for deliberate harmful acts. This excludes intentional wrongdoing while preserving coverage for accidents, though it may not bar coverage for unintended consequences of intentional acts in some jurisdictions. Contractual liability exclusion, an exclusion that eliminates coverage for liability assumed under contracts or agreements that do not qualify as insured contracts, as defined in the policy. This prevents the insured from using insurance to assume unlimited contractual obligations while still covering liability for standard business contracts like leases, permits, and indemnification agreements that meet the policy definition. Liquor liability exclusion, an exclusion in general liability policies that eliminates coverage for liability arising from the manufacture, sale, distribution, or serving of alcoholic beverages by businesses in the liquor business. This exclusion requires bars, restaurants, liquor stores, and similar establishments to purchase separate liquor liability coverage, though host liquor liability for occasional serving remains covered. Workers' compensation exclusion, an exclusion that eliminates liability coverage for injuries to employees that are covered or should be covered under workers' compensation, disability benefits, or unemployment compensation laws. This prevents duplication of coverage and ensures employee injuries are handled through the workers' compensation system rather than liability policies. Employers' liability exclusion, an exclusion that eliminates general liability coverage for bodily injury to employees arising out of and in the course of employment, whether or not workers' compensation applies. This exclusion ensures employer-employee injury claims are covered exclusively under workers' compensation policies. Part 2, Employers' liability, rather than general liability. Pollution exclusion, an exclusion that eliminates coverage for bodily injury or property damage arising from the actual, alleged, or threatened discharge, dispersal, seepage, migration, release, or escape of pollutants. This broad exclusion eliminates most pollution-related liability from general liability policies, requiring separate environmental liability coverage, though some policies provide limited exceptions for sudden and accidental pollution. Aircraft, auto, watercraft exclusion, an exclusion in commercial general liability policies that eliminates coverage for bodily injury or property damage arising from the ownership, maintenance, use, or entrustment of aircraft, automobiles, or watercraft. These exposures require separate specialized policies, aviation, auto, or boat insurance, though some limited exceptions exist for watercraft under certain lengths or non-owned watercraft. Professional services exclusion, an exclusion that eliminates coverage for liability arising from the rendering or failure to render professional services, medical treatment, or similar professional activities. This ensures that professional negligence, errors, and omissions are covered under specialized professional liability or malpractice policies rather than general liability coverage. Damage to your product exclusion, an exclusion that eliminates coverage for property damage to the insured's own product or work, recognizing that defects in the insured's products are business risks rather than insurable liability exposures. The insurer will not pay to repair or replace the insured's defective product itself, though it will cover damage the defective product causes to other property. Damage to your work exclusion, an exclusion that eliminates coverage for property damage to work or operations performed by or on behalf of the insured, preventing the policy from serving as a performance bond or warranty. The insurer will not pay to repair faulty workmanship or correct defects in completed work, though it may cover resulting damage to other property. Damage to property in your care, custody, or control, an exclusion that eliminates coverage for damage to property being worked on, stored, transported, or otherwise in the insured's physical possession or control. This recognizes that the insured has assumed a bailment responsibility for such property and should have separate bailee coverage or contractual protection, as general liability is not intended to cover property entrusted to the insured. Recall of products, an exclusion that eliminates coverage for the costs of withdrawing, inspecting, repairing, replacing, or disposing of the insured's products or work if a defect is discovered, even if no injury has occurred. This excludes the financial consequences of product recalls and systematic failures affecting multiple units, which are considered business risks rather than liability exposures. Mobile equipment exclusion, an exclusion that eliminates coverage for bodily injury or property damage arising from the transportation of mobile equipment by an automobile owned or operated by the insured. This clarifies that while mobile equipment itself, like bulldozers, is covered under general liability when being used, transporting it on a truck requires auto liability coverage. War exclusion, an exclusion that eliminates coverage for liability arising from war, whether declared or undeclared, warlike action by military forces, insurrection, rebellion, revolution, civil war, or usurped power. This catastrophic exposure exclusion protects insurers from unpredictable and potentially unlimited losses during military conflicts or civil unrest. Communicable disease exclusion, an exclusion that eliminates coverage for injury, damage, or loss arising from the actual or alleged transmission, spread, or exposure to communicable, contagious, or infectious diseases, pathogens, or viruses. This exclusion became widespread after COVID-19 to clarify that pandemic-related business interruption and liability claims are not covered under standard general liability and property policies. Summons, a legal document issued by a court notifying a defendant that a lawsuit has been filed against them and requiring them to appear or respond within a specified time period. The summons officially begins the legal process and establishes the court's jurisdiction over the defendant, who must be properly served with both the summons and complaint. Complaint, the initial legal document filed by a plaintiff that starts a lawsuit, outlining the allegations, facts, legal basis for the claim, and damages sought. The complaint identifies the parties, describes what the defendant allegedly did wrong, and demands specific relief or compensation. Answer, the defendant's formal written response to a complaint, admitting or denying each allegation and asserting any affirmative defenses. The answer must be filed within a specific time period, typically 20 to 30 days, and represents the defendant's first opportunity to present their side of the case. Deposition, a formal out-of-court oral testimony given under oath during the discovery phase of litigation, where attorneys question witnesses or parties to gather information and establish facts. Depositions are recorded by a court reporter and can be used at trial to impeach witnesses or as evidence if the witness is unavailable. Judgment, the final decision of a court determining the rights and obligations of the parties in a lawsuit, including any monetary damages awarded. A judgment can result from a trial verdict, summary judgment, or default, and becomes enforceable once entered by the court. Settlement, an agreement between parties to resolve a legal dispute without going to trial, typically involving payment of money in exchange for releasing all claims. Settlements allow parties to avoid the time, expense, and uncertainty of litigation, and can occur at any stage of the legal process. Arbitration, a form of alternative dispute resolution, where parties agree to have their dispute decided by a neutral third-party arbitrator rather than through court litigation, with decisions typically being binding. In liability insurance contexts, arbitration clauses may govern disputes between insureds and insurers over coverage issues or between parties to determine liability and damages. Mediation, a voluntary dispute resolution process where a neutral third-party mediator facilitates negotiations between parties to help them reach a mutually acceptable settlement. Unlike arbitration, the mediator does not impose a decision but guides discussions, and parties retain control over the outcome and can walk away if agreement cannot be reached. Comparative fault, a legal principle used in liability cases to determine each party's percentage of responsibility for causing an accident or injury, which then proportionally reduces damages owed. This concept underlies comparative negligence systems and affects both settlement negotiations and jury verdicts in determining how much each party must pay. Reservation of rights. A written notice from an insurer to an insured stating that the insurer is defending a claim but reserves the right to later deny coverage based on policy exclusions or conditions. This protects the insurer from waiving defenses while fulfilling its duty to defend, allowing investigation to continue while coverage questions remain unresolved. Subpoena, a legal document commanding a person to appear in court, at a deposition, or to produce documents or evidence under penalty of law. Subpoenas are issued by attorneys or courts to compel testimony or evidence from witnesses who might not voluntarily cooperate with the legal process. Legal expenses. The costs incurred in defending or prosecuting a legal claim, including attorney fees, court costs, expert witness fees, investigation costs, filing fees, and other litigation-related expenditures. In liability insurance, legal expenses, defense costs, are typically paid by the insurer in addition to policy limits under supplementary payments. Settlement negotiations. The process of discussions and bargaining between parties or their attorneys to resolve a dispute without trial, involving offers, counteroffers, and compromise to reach a mutually acceptable resolution. Insurers typically control settlement negotiations for liability claims and must act in good faith to protect the insured's interests. Litigation. The process of taking a legal dispute through the court system, including filing pleadings, conducting discovery, attending hearings, and potentially going to trial for a judge or jury decision. Litigation is typically expensive and time-consuming, making settlement an attractive alternative, and liability insurers have a duty to defend insureds through the litigation process. Financial responsibility laws. State laws requiring motorists to demonstrate their ability to pay for damages they cause in an accident, either through insurance, bond, cash deposit, or proof of sufficient assets. These laws are typically enforced after an accident or traffic violation and establish minimum liability limits that must be maintained to legally operate a vehicle. Compulsory insurance laws. State laws that require all vehicle owners or drivers to maintain minimum liability insurance coverage before registering or operating a vehicle, with penalties for non-compliance including fines, license suspension, or vehicle impoundment. These laws are more stringent than financial responsibility laws because they require proof of insurance up front rather than only after an accident. Proof of insurance, documentation, typically an insurance ID card or certificate, that demonstrates a vehicle is covered by liability insurance meeting state minimum requirements. Drivers must carry proof of insurance and present it when requested by law enforcement, at vehicle registration, or after an accident. Assigned risk plan, a state-operated mechanism that requires insurance companies to accept and provide coverage to high-risk drivers who cannot obtain insurance in the voluntary market, with insureds assigned proportionally among insurers based on market share. Also called residual market or shared market plans, these ensure that all drivers can obtain legally required coverage, though typically at higher premiums. Out-of-state coverage provision, a policy clause ensuring that auto liability coverage meets the minimum insurance requirements of any state where the insured vehicle is being driven, automatically adjusting limits upward if another state requires higher minimums. This provides seamless protection when traveling between states with different insurance requirements. No-fault insurance, an auto insurance system where each party's own insurance pays for their injuries and economic losses regardless of who caused the accident, eliminating or restricting the right to sue for certain damages. No-fault systems aim to reduce litigation, speed claim payments, and lower costs, though injured parties can still sue for serious injuries that exceed statutory thresholds. Personal injury protection, PIP, coverage required in no-fault states that pays for the insured's and passengers' medical expenses, lost wages, funeral costs, and other economic losses regardless of fault, up to policy limits. PIP provides first-party benefits and typically covers expenses not paid by health insurance, with benefits varying by state regarding amount, duration, and what expenses qualify. Residual bodily injury liability coverage in no-fault insurance states that allows injured parties to sue for damages once their injuries exceed the no-fault threshold, typically defined by dollar amount or severity. This coverage responds when injuries are serious enough to break through the no-fault restriction on lawsuits, covering pain and suffering and other damages beyond PIP benefits. Liability coverage trigger, the event that activates an auto liability policy's coverage, typically the occurrence of an accident during the policy period that results in bodily injury or property damage. For auto policies, coverage is generally triggered when the accident happens, occurrence basis, regardless of when the claim is made or reported. Motor Vehicle Financial Responsibility Limit, the minimum amount of liability insurance coverage required by state law to legally operate a vehicle, expressed as split limits, e.g. 25/50/25, or combined single limits. These mandated minimums vary by state and represent the floor for insurance protection, though many drivers purchase higher limits for better protection. Drive Other Car Endorsement, an endorsement that extends liability coverage to an individual when driving vehicles they do not own, providing coverage that follows the driver rather than the vehicle. This is particularly important for named non-owner policies or business auto policies where executives or employees regularly drive vehicles not owned by the company. HO1, Basic Form, the most restrictive homeowners policy form, providing named perils coverage for both dwelling and personal property, covering only 11 basic perils. This form is rarely used today due to its limited coverage and has been discontinued in many states in favor of broader forms. HO2, Broad Form, a homeowner's policy that provides named perils coverage for both dwelling and personal property, covering 16 broad form perils, including all basic perils, plus additional ones like falling objects and water damage. This offers more comprehensive protection than HO1 while remaining more affordable than special form coverage. HO3, Special Form, the most popular homeowners policy providing open perils, all-risk coverage on the dwelling and other structures, while personal property is covered on a named perils, broad form, basis. This combination offers comprehensive building protection while keeping premiums reasonable by limiting contents coverage to named perils. HO4, Renters, Contents, Broad Form, a policy designed for tenants who rent their residence, providing named perils coverage for personal property and liability protection, but no coverage for the building structure. This form covers the renter's belongings, additional living expenses if the unit becomes uninhabitable, and personal liability for injuries or damage to others. HO5, Comprehensive Form, the broadest homeowners policy providing open perils, all-risk coverage for both the dwelling and personal property, offering maximum protection with the fewest exclusions. This premium form is ideal for homes with valuable contents and provides the most comprehensive coverage available in a homeowner's package. HO6, Condo Unit Owners Form, a policy designed for condominium unit owners that covers personal property, improvements and betterments to the unit interior, loss assessment from the condo association, and personal liability. This form coordinates with the condominium association's master policy, which typically covers the building structure and common areas. HO7, Mobile Home Form, a homeowner's policy specifically designed for manufactured or mobile homes, addressing unique construction characteristics and perils that differ from traditional site-built homes. Coverage is similar to HO3, but adapted for the special needs and exposures of mobile home owners. HO8, Modified Coverage Form, a policy designed for older homes where replacement cost coverage would be prohibitively expensive, providing actual cash value or functional replacement cost coverage instead. This form uses the same perils as HO1, but is specifically tailored for historic homes, antique properties, or homes where modern building costs far exceed market value. Section 1. Property coverage. The portion of the homeowner's policy that covers physical damage to the insured's property, including the dwelling, other structures, personal property, and loss of use. This section includes coverages A, B, C, and D, along with additional coverages and extensions. Section 2. Liability coverage. The portion of the homeowner's policy that provides personal liability protection and medical payments to others for injuries or damage the insured legally causes. This section includes coverage E, personal liability, and coverage F, medical payments to others, along with supplementary payments for legal defense. Coverage A, dwelling, coverage for the physical structure of the residence, including attached structures, permanently installed fixtures, materials on premises for construction or repair, and building equipment and outdoor equipment servicing the premises. This is the primary coverage in homeowners' policies and serves as the base from which other coverage limits are typically calculated as percentages. Coverage B, other structures, coverage for structures on the insured premises that are separated from the dwelling by clear space, such as detached garages, sheds, fences, or swimming pools. This coverage is typically 10% of the coverage A limit and excludes structures used for business or rented to non-residents of the household. Coverage C, personal property. Coverage for the insured's movable belongings including furniture, clothing, electronics, and other contents, whether at the insured location or temporarily away from premises. This coverage is typically 50 to 75% of the coverage A dwelling limit and may include property of household members and guests, subject to special limits for certain categories. Coverage D, loss of use. Coverage that pays for additional living expenses when a covered loss makes the residence uninhabitable, additional living expense, or for lost rental income if part of the premises is rented, fair rental value. This coverage is typically 20 to 30% of coverage A and includes costs like temporary housing, meals, and storage that exceed normal living expenses. Coverage E, personal liability. Coverage that protects the insured against legal liability for bodily injury or property damage caused to others through the insured's negligence or actions at the insured location or elsewhere. This provides defense costs and pays damages up to the policy limit, typically $100,000 to $500,000, for covered incidents occurring anywhere in the world. Coverage F, medical payments to others. No-fault coverage that pays reasonable medical expenses for persons injured on the insured's premises or by the insured's activities, regardless of legal liability, within 3 years of the accident. This coverage applies to guests and others, not household members, with typical per-person limits of $1,000 to $5,000, and helps maintain goodwill while potentially preventing liability claims. Insured location. Any premises or location where coverage applies under the homeowner's policy, including the resident's premises, other residences acquired during the policy period, non-owned premises where insureds temporarily reside, vacant land owned or rented by insureds, and cemetery plots. This broad definition ensures liability coverage follows the insured to various locations beyond just their primary home. Residence premises. The 1 to 4 family dwelling where the insured resides, including other structures and grounds at that location, as shown in the declarations. This is the primary insured location and the address where the property coverages primarily apply. Additional insured, a person or entity added to the homeowner's liability coverage through endorsement to provide them with protection under the insured's policy for specified situations. While less common in homeowners than commercial policies, additional insureds might include domestic employees, care providers, or others with an insurable interest. Scheduled personal property. Valuable items specifically listed on an endorsement with individual descriptions and agreed values, receiving broader open peril coverage without deductibles or special limits. Common scheduled items include jewelry, fine arts, cameras, musical instruments, and collectibles that need protection beyond standard policy sublimits. Personal property replacement cost endorsement. an endorsement that changes the valuation of personal property from actual cash value to replacement cost, paying the full cost to replace damaged items with new ones without depreciation deduction. This endorsement significantly improves claim payments, but may require the insured to actually replace items to receive the full replacement cost benefit. Special limits of liability. Reduced maximum dollar amounts that apply to specific categories of personal property, such as money, $200, jewelry, $1,500, firearms, $2,500, and silverware, $2,500. These sublimits apply per occurrence and restrict coverage for high-value or theft-prone items unless they are specifically scheduled for higher coverage. Theft exclusions. Limitations in homeowners. Policies that exclude or restrict theft coverage in certain situations, such as theft from an unattended vehicle, except of electronic equipment, theft by tenants or employees, mysterious disappearance, or theft from a dwelling under construction. Some property categories, like credit cards, also have special theft limitations. Loss assessment coverage, coverage that pays the insured's share of assessments charged by a homeowners association or condominium association for covered losses to common property when the association's insurance is insufficient. Standard policies provide $1,000 coverage, but this can be increased by endorsement to protect against special assessments for major losses affecting shared property. Ordinance or law. Limited coverage, typically 10% of coverage A, for increased costs to comply with building codes when repairing or rebuilding after a covered loss. Standard homeowners policies provide minimal ordinance or law coverage, and significant protection requires a separate endorsement with higher limits for demolition costs, undamaged portion loss, and increased construction costs. Debris removal. Additional coverage that pays for the cost of removing debris of covered property after a loss, typically included within the coverage A limit, or providing an additional 5% if the loss and removal costs together exceed the limit. This covers hauling away damaged materials and is essential for preparing the site for rebuilding. Trees, shrubs, and plants coverage. Coverage for trees, shrubs, plants, and lawns on the resident's premises against specific named perils like fire, lightning, explosion, theft, aircraft, and vehicles. Typically 5% of coverage A with a $500 per item limit. This does not cover damage from wind, disease, or most weather-related causes, and excludes coverage for lawns in many circumstances. Credit card and forgery coverage. Coverage that pays up to $500 for unauthorized use of credit cards, electronic fund transfer cards, forgery, or counterfeit money without a deductible. This provides limited protection against financial crimes affecting the insured, though it doesn't cover business-related losses. Grave markers coverage, coverage for cemetery markers, headstones, grave markers, or urns on or away from the resident's premises against the same perils as personal property, typically with a $5,000 limit. This specialized coverage recognizes the sentimental and replacement value of burial site markers. Collapse. Coverage for sudden collapse of a building or part of a building, but only when caused by specific listed perils such as hidden decay, insect or vermin damage, weight of contents, weight of rain on a roof, or use of defective construction materials. Settling, cracking, shrinking, or bulging is not considered collapse and is excluded unless actual collapse results. Landlord's furnishings, coverage extension providing up to $2,500 for appliances, carpeting, and other household furnishings at the resident's premises regularly rented or held for rental to others. This limited coverage allows homeowners who rent part of their property to protect landlord-owned furnishings provided to tenants. Glass breakage, coverage for accidental breakage of glass or safety glazing materials that are part of covered buildings, storm doors, or storm windows, with special provisions for tenant-caused damage. This provides open peril coverage for glass, even in HO2 policies where building coverage is otherwise on a named perils basis. Inflation protection endorsement, an endorsement that automatically increases coverage A dwelling limits periodically, quarterly, or annually by a specified percentage to keep pace with rising construction costs. This helps prevent underinsurance by adjusting coverage without requiring annual review, with other coverages typically increasing proportionally. Watercraft liability. Limited liability coverage under homeowners' policies for watercraft the insured owns or uses, subject to restrictions based on length, horsepower, and type of vessel. Full coverage applies to sailboats under 26 feet and boats with motors under 25 horsepower, while larger watercraft require separate boat insurance. Business pursuits endorsement. An endorsement that provides limited coverage for liability and property exposures arising from business activities conducted from the residence, such as office work, consulting, or small-scale operations. This bridges the gap between personal homeowners coverage, which excludes business, and commercial insurance for minor business activities. Home day care coverage, an endorsement that provides coverage for liability and property damage exposures when the insured operates a daycare or childcare business from their home. Standard homeowners policies exclude business pursuits, making this endorsement essential for in-home daycare providers to obtain necessary protection. Identity theft restoration coverage, an endorsement that reimburses expenses incurred to restore the insured's identity after theft, including legal fees, lost wages, notary and certified mailing costs, and loan application fees. This covers the cost of recovery rather than direct financial losses and typically provides $10,000 to $25,000 in coverage. Earthquake endorsement, a separate endorsement or policy that adds coverage for damage caused by earthquakes, earth movement, volcanic eruption, and related shock waves. This coverage includes a percentage deductible, typically 10 to 25% of coverage A, covers all policy coverages A, B, C, D, and often includes loss assessment coverage for condo owners. Flood exclusion, an exclusion in homeowners' policies that eliminates coverage for damage caused by flood, surface water, waves, tidal water, overflow of bodies of water, or water backing up through sewers or drains from external sources. Flood coverage must be obtained separately through the National Flood Insurance Program or private flood insurers. Personal property at other residences limit. A coverage extension limiting coverage for personal property usually located at other residences of the insured, like vacation homes, to 10% of coverage C. This provides some coverage for contents at secondary locations, but may be inadequate for fully furnished vacation properties, which should be separately insured. DP1, Basic Form, the most restrictive dwelling policy form, providing named perils coverage for only fire, lightning, and internal explosion, unless extended coverage perils are added by endorsement. This basic form values losses at actual cash value, provides no theft coverage, and is designed for properties that don't qualify for homeowners policies, such as rental properties or vacant homes. DP2, Broad Form, a dwelling policy providing broader named perils coverage, including all basic perils, plus additional ones like falling objects, weight of ice/snow/sleet, and water damage from plumbing. This form offers replacement cost coverage for the dwelling, coverage A, and includes coverage E, additional living expense, making it more comprehensive than DP1 but less extensive than DP3. DP3, Special Form, the broadest dwelling policy form providing open perils, all risk coverage on the dwelling and other structures, while personal property remains on a broad named perils basis. This offers the most comprehensive protection for non-owner-occupied or specialized residential properties that don't qualify for standard homeowners insurance. Coverage A, Dwelling. Coverage for the dwelling structure at the location shown in the declarations, including structures attached to the dwelling and materials and supplies on or adjacent to the premises for construction, alteration, or repair. This is the primary coverage in dwelling policies and covers the physical building itself. Coverage B, Other Structures. Coverage for structures on the residence premises separated from the dwelling by clear space, such as detached garages, sheds, or fences, typically 10% of the Coverage A limit. This excludes structures used for business purposes or rented to anyone other than tenants of the dwelling. Coverage C, personal property, optional coverage in dwelling policies, Coverage A and B are mandatory, that covers personal property owned or used by the insured or residents while on the resident's premises. This coverage must be specifically purchased and is limited to broad-named perils regardless of the form, with actual cash value settlement unless endorsed for replacement cost. Coverage D, fair rental value, coverage that reimburses the insured for lost rental income when a covered loss makes part or all of the dwelling uninhabitable and unfit for its normal use. This pays the fair rental value minus expenses that don't continue during the uninhabitable period, helping landlords cover mortgage payments when they cannot collect rent. Coverage E, additional living expense, DP2 and DP3 only. Coverage available only in DP2 and DP3 policies that pays the increase in living expenses necessary to maintain the insured's normal standard of living when the dwelling becomes uninhabitable due to a covered loss. This is similar to homeowners' Coverage D, but applies when the property owner also lives in the insured dwelling. Extended coverage perils, an endorsement that adds additional named perils to the basic DP1 coverage, including windstorm, hail, explosion, external, riot or civil commotion, aircraft, vehicles, smoke, volcanic action, and vandalism, malicious mischief. Without this endorsement, DP1 covers only fire, lightning, and internal explosion. VMM, vandalism and malicious mischief endorsement, an endorsement that adds coverage for intentional damage or destruction caused by vandals, which may be excluded or limited in basic dwelling forms or when properties are vacant. This is particularly important for vacant properties or those under renovation where vandalism risk is elevated. Broad form perils, DP2. The set of 16 named perils covered under DP2 policies, including all basic perils plus falling objects, weight of ice/snow/sleet, accidental discharge or overflow of water or steam, sudden and accidental damage from artificially generated electrical current, freezing of plumbing, and sudden and accidental damage from heating/cooling/sprinkler systems. This expanded list provides significantly more protection than DP1. Special form perils DP3. Open perils all-risk coverage provided for the dwelling and other structures under DP3, covering all direct physical loss, except those specifically excluded. This is the broadest approach, protecting against any cause of loss not specifically listed as an exclusion in the policy. Automatic increase in insurance endorsement. An endorsement that automatically increases dwelling coverage limits by a specified percentage annually to keep pace with inflation and rising construction costs. This prevents underinsurance without requiring manual policy updates, with the premium adjusting accordingly at each renewal. Replacement cost for Coverage A, automatic replacement cost valuation for the dwelling in DP2 and DP3 policies, unlike DP1, which uses actual cash value, paying the full cost to repair or replace the dwelling without depreciation deduction. This provides more favorable claim payments and better protection for building structures. Actual cash value default for personal property. The standard valuation method for personal property, Coverage C, in dwelling policies, which deducts depreciation from replacement cost to determine claim payment. Unless a replacement cost endorsement is purchased, contents claims are settled at depreciated value reflecting age, wear, and condition. Theft coverage endorsement. An optional endorsement that must be added to dwelling policies to provide theft coverage for personal property, as theft is not automatically included in any DP form. This endorsement is essential for protecting contents from burglary and must be specifically purchased as dwelling policies focus primarily on building coverage. Dwelling under construction endorsement. An endorsement that modifies coverage for properties currently being built or substantially renovated, addressing unique exposures during construction such as materials theft, construction defects, and partial completion. This may include builders' risk-type features and adjusts coverage as construction progresses. Rental value coverage, coverage that compensates the property owner for lost rental income when a covered loss makes the dwelling unrentable, calculated as the fair rental value minus expenses that don't continue during the loss period. This is coverage D in dwelling policies and is crucial for landlords whose properties generate rental income. Personal liability supplement, an optional endorsement that adds Section 2 liability coverage to dwelling policies, providing personal liability and medical payments protection similar to homeowners' policies. Since dwelling policies only include property coverage by default, this endorsement is important for property owners who occupy the dwelling or want liability protection. Part A, Liability Coverage. The section of the personal auto policy that provides bodily injury and property damage liability coverage when the insured is legally liable for an auto accident, paying damages, and providing legal defense. This coverage applies to the insured, family members, and others using the covered auto with permission, subject to policy limits. Part B, Medical Payments. Coverage optional no-fault coverage that pays reasonable medical expenses for the insured and passengers injured in an auto accident, regardless of who caused the accident, up to the per-person limit. Coverage applies to medical expenses incurred within 3 years of the accident for treatment of injuries sustained. Part C, Uninsured Motorist, coverage. Coverage that protects the insured and passengers when injured by a driver who has no liability insurance or is a hit-and-run driver, paying for bodily injury and property damage in some states, up to the policy limits. This coverage fills the gap when the at-fault driver cannot pay for damages due to lack of insurance. Part D, Coverage for damage to your auto. The section providing physical damage coverage for the insured's vehicle, including both collision and other than collision, comprehensive coverages. This optional coverage pays to repair or replace the insured's vehicle when damaged, subject to the chosen deductible and actual cash value limits. Part E, Duties after an accident or loss. The section that outlines the insured's obligations following an accident, including prompt notification to the insurer, cooperation with investigation, submission of proof of loss, and protection of the vehicle from further damage. Failure to fulfill these duties can jeopardize coverage or delay claim payment. Part F, General Provisions. The section containing standard policy provisions, such as policy period and territory, changes to the policy, cancellation and non-renewal terms, transfer of rights, and other administrative conditions. This section establishes the fundamental rules governing the insurance contract. Split limits, a liability limit structure common in auto policies expressed as 3 numbers, e.g., 100/300/50, representing per-person bodily injury, per-accident bodily injury, and per-accident property damage maximums. Each limit applies independently, restricting how much the insurer will pay for different types of damages in a single accident. BI/PD, bodily injury/property damage, abbreviations for the 2 main types of auto liability coverage. Bodily injury, BI, covers harm to people, while property damage, PD, covers damage to others' vehicles or property. These form the foundation of auto liability insurance and may be expressed as split limits or combined single limits. Family member definition. A person related to the named insured by blood, marriage, or adoption who resides in the same household, including wards or foster children. Family members are automatically insured under the PAP for all coverages and have the broadest protection without needing to be specifically named. Covered auto. Any vehicle that qualifies for coverage under the policy, including owned autos described in the declarations, newly acquired autos, temporary substitute autos, and trailers. The definition varies by coverage part and determines what vehicles receive protection under each section of the policy. Owned auto, a vehicle owned by the named insured or family member that is described in the policy declarations or acquired during the policy period. Owned autos receive the broadest coverage under the PAP and include vehicles titled in the insured's name. Non-owned auto, a vehicle not owned by or furnished for regular use to the named insured or family members, such as borrowed cars or rental vehicles. The PAP provides liability coverage for non-owned autos, but typically does not extend physical damage coverage unless specifically endorsed. Temporary substitute auto, a vehicle not owned by the insured that is temporarily used while a covered auto is out of normal use due to breakdown, repair, servicing, loss, or destruction. The substitute vehicle receives the same coverage as the vehicle it's replacing for the duration of its use. Newly acquired auto, a vehicle acquired during the policy period that automatically receives coverage, typically with an extended period, 14 to 30 days depending on coverage, to notify the insurer and add it to the policy. Automatic coverage ensures seamless protection when purchasing a new or additional vehicle. Trailer coverage, automatic coverage for trailers owned by the insured or used with a covered auto, including farm wagons, utility trailers, and boat trailers. Coverage applies while attached to or detached from the vehicle, with liability following the towing vehicle. Uninsured motorist, UM, coverage that protects insureds when injured by drivers who have no liability insurance, insufficient insurance, or are hit-and-run drivers whose identity cannot be established. UM coverage pays for bodily injury damages and property damage in some states that the uninsured driver should have paid. Underinsured motorist, UIM, coverage that applies when an at-fault driver has liability insurance, but the limits are insufficient to fully compensate the insured for injuries sustained. UIM coverage pays the difference between the at-fault driver's limits and the insured's damages up to the UIM policy limit. Stacking of UM/UIM, the practice of combining or stacking uninsured/underinsured motorist coverage limits from multiple vehicles on the same policy or multiple policies to provide higher total coverage. Stacking may be vertical, combining per person and per accident limits, or horizontal, combining limits from multiple vehicles, though many states restrict or prohibit this practice. Hit-and-run definition: an accident where the driver who caused the damage cannot be identified and leaves the scene without providing information, qualifying as an uninsured motorist for coverage purposes. Most policies require the insured to report hit-and-runs to police promptly, and may require physical contact with the vehicle or independent verification of the accident. Phantom vehicle: an unidentified vehicle whose driver causes an accident but flees before being identified, typically requiring physical contact with the insured's vehicle for UM coverage to apply. The phantom vehicle concept addresses hit-and-run situations where the at-fault driver's identity and insurance status cannot be determined. Collision, coverage for damage to the insured's vehicle resulting from impact with another vehicle or object, or from the vehicle overturning, regardless of fault. This coverage requires a deductible and pays to repair or replace the vehicle up to its actual cash value. Other than collision, coverage for damage to the insured's vehicle from causes other than collision or overturn, including theft, vandalism, fire, glass breakage, falling objects, flood, and animal strikes. This broad coverage protects against most non-collision perils and typically has a lower deductible than collision. Transportation expenses: coverage that reimburses the insured for rental car costs or other transportation expenses when a covered auto is stolen or being repaired after a covered loss under Part D. Standard policies provide limited daily reimbursement, often $20 to $30 per day, for a specified period, with higher limits available by endorsement. Rental reimbursement endorsement: an optional endorsement that increases the daily limit and duration for rental car expenses beyond the standard transportation expenses coverage. This provides more generous reimbursement, typically $30 to $100 per day, when the insured's vehicle is being repaired or replaced after a covered loss. Towing and labor endorsement: an optional endorsement that pays for towing and labor costs when a covered vehicle breaks down, becomes disabled, or requires roadside assistance. This typically provides a per-occurrence limit, such as $75 to $100, for services like jump starts, tire changes, lockout service, and towing to a repair facility. Gap insurance, coverage that pays the difference between what the insured owes on a vehicle loan or lease and the actual cash value the insurance company pays after a total loss. This gap protection is essential for vehicles with significant depreciation or when the loan balance exceeds the vehicle's value due to low down payment or long loan terms. Custom equipment endorsement, an endorsement that increases coverage for non-factory equipment and modifications added to the vehicle, such as custom wheels, stereo systems, ground effects, or aftermarket performance parts. Standard policies have low limits, typically $1,000 to $1,500 for custom equipment, requiring this endorsement for full protection of expensive modifications. Diminution of value exclusion, a standard policy exclusion that eliminates payment for the reduction in a vehicle's market value after an accident even when properly repaired, recognizing that accident history reduces resale value. Insurers pay only for actual repair costs, not for the stigma or decreased value associated with having been in an accident. Betterment, a reduction in claim payment when repairs result in the insured receiving parts or components that are better or newer than those that existed before the loss. Insurers may deduct for betterment when worn parts are replaced with new ones, charging the insured for the improved condition they're receiving. Primary versus occasional driver, classification of drivers based on how frequently they operate a specific vehicle, with primary drivers being those who use the vehicle most often and occasional drivers using it less frequently. This distinction affects premium calculation, as primary drivers of high-risk vehicles face higher rates than occasional drivers. Driver assignments, the process of designating which driver primarily operates each vehicle on a multi-car policy, used by insurers to calculate accurate premiums based on driver-vehicle combinations. Proper assignment ensures that high-risk drivers are matched with their actual vehicles, rather than being assigned to the least expensive vehicle to manipulate rates. Territory rating, the geographic area where the vehicle is principally garaged and operated, which significantly affects premium due to varying accident rates, theft rates, repair costs, and claim frequencies. Urban territories with higher traffic density, theft rates, and repair costs result in higher premiums than rural territories. Usage categories, classifications of how a vehicle is primarily used, affecting premium rates based on exposure, pleasure, occasional personal use, commute, regular driving to from work, or business use, regular work-related driving beyond commuting. Higher mileage and increased exposure from commuting or business use result in higher premiums than pleasure use. Multi-car discount, a premium reduction offered when multiple vehicles are insured on the same policy, recognizing administrative savings and reduced exposure per vehicle. This discount incentivizes keeping all household vehicles with one insurer and can result in significant savings compared to insuring vehicles separately. Safe Driver Rating Plan, a premium structure that rewards drivers with clean records through discounts while surcharging those with accidents or violations, using a point system or direct premium adjustments. This encourages safe driving behavior by making premiums reflect individual driving history and claims experience. No-fault insurance, an auto insurance system where each party's own insurance pays for their injuries and economic losses regardless of who caused the accident, eliminating or restricting the right to sue for certain damages. No-fault systems aim to reduce litigation, speed claim payments, and lower costs, though injured parties can still sue for serious injuries that exceed statutory thresholds. Personal injury protection, PIP, coverage required in no-fault states that pays for the insured's and passengers' medical expenses, lost wages, funeral costs, and other economic losses regardless of fault, up to policy limits. PIP provides first-party benefits and typically covers expenses not paid by health insurance, with benefits varying by state regarding amount, duration, and what expenses qualify. Assigned risk, state-operated mechanisms that require insurance companies to accept and provide coverage to high-risk drivers who cannot obtain insurance in the voluntary market. with insureds assigned proportionally among insurers based on market share. These ensure that all drivers can obtain legally required coverage, though typically at higher premiums than voluntary market rates. Financial responsibility laws. State laws requiring motorists to demonstrate their ability to pay for damages they cause in an accident, either through insurance, bond, cash deposit, or proof of sufficient assets. These laws are typically enforced after an accident or traffic violation and establish minimum liability limits that must be maintained to legally operate a vehicle. Compulsory liability laws, state laws that require all vehicle owners or drivers to maintain minimum liability insurance coverage before registering or operating a vehicle, with penalties for non-compliance including fines, license suspension, or vehicle impoundment. These laws are more stringent than financial responsibility laws because they require proof of insurance up front rather than only after an accident. Personal umbrella policy, a broad form of excess liability coverage that provides additional limits above underlying primary policies, auto, homeowners, and may also drop down to provide primary coverage for some exposures not covered by underlying policies. Umbrellas offer high limits, typically $1 to $5 million, at relatively low cost and provide broader coverage than standard policies, making them essential for protecting significant personal assets. Excess liability coverage, insurance that applies only after underlying primary coverage is exhausted, providing additional limits above the primary policy without broadening coverage terms. Excess policies typically follow the terms of the underlying coverage and respond only when primary limits are fully paid, offering pure additional capacity rather than broader protection. Drop-down coverage, a feature of umbrella policies where the umbrella provides primary coverage, subject to a self-insured retention, for certain exposures not covered by underlying policies, such as personal injury offenses or certain premises liability claims. This allows the umbrella to drop down and act as primary insurance when no underlying coverage is available for a covered loss. Self-insured retention. The dollar amount the insured must pay out of pocket before the umbrella policy responds when drop-down coverage applies or when no underlying coverage exists. The SIR, typically $250 to $10,000, functions like a deductible but applies only to losses not covered by underlying policies, with the insured responsible for handling and paying claims within the retention. Primary versus excess liability. The distinction between insurance that pays first, primary, up to its limits, versus insurance that pays only after primary coverage is exhausted, excess. Primary policies have first dollar coverage responsibility, while excess policies provide additional layers of protection once underlying limits are used up. Follow form liability, an excess liability policy structure that adopts the same terms, conditions, exclusions, and definitions as the underlying primary policy, creating consistency between coverage layers. This ensures that if the primary policy covers a claim, the excess will also respond once primary limits are exhausted, though some independent provisions may exist. Underlying limits requirement. The minimum liability limits that must be maintained on primary policies, typically auto and homeowners, for an umbrella policy to remain in force. Common requirements are $250,000 over $500,000 auto liability and $300,000 homeowners liability, ensuring adequate primary coverage exists before the umbrella responds. Underlying policies. The primary liability insurance policies, personal auto and homeowners, that must be maintained as a condition of umbrella coverage and that pay first before the umbrella responds. These underlying policies provide the foundation layer of liability protection, with the umbrella providing excess coverage above their limits. Worldwide coverage, a benefit of umbrella policies providing liability coverage for incidents occurring anywhere in the world, not just within the United States and its territories. This broad territorial scope protects insureds during international travel and activities, though some exclusions may apply for extended foreign residence or business operations. Excluded personal liabilities. Specific types of liability exposures that umbrella policies do not cover, such as business or professional liability, intentional acts, contractual liability, beyond insured contracts, and liability assumed under written contracts. These exclusions require separate specialized insurance and prevent the umbrella from covering inappropriate or uninsurable exposures. Intentional act exclusion, an exclusion eliminating coverage for bodily injury or property damage expected or intended from the insured's standpoint, preventing coverage for deliberate harmful acts. This exclusion prevents using the umbrella to cover intentional torts, criminal acts, or deliberate wrongdoing, though it may not bar coverage for unintended consequences of intentional acts in some circumstances. Recreational vehicle liability. Coverage extension in umbrella policies for liability arising from ownership or use of recreational vehicles like ATVs, snowmobiles, golf carts, or small watercraft that may not be covered by underlying auto or homeowners policies. This drop-down feature provides primary coverage, subject to the SIR, for recreational vehicle exposures, filling gaps in underlying coverage. Personal inland marine, a category of insurance covering movable personal property, valuables, and items requiring broader coverage than standard homeowners policies provide, originally developed for goods in transit. Personal inland marine includes floaters for jewelry, fine arts, cameras, musical instruments, and other high-value items that need worldwide all-risk protection without deductibles. Personal articles floater, a policy or endorsement that provides open peril coverage for specifically scheduled valuable items like jewelry, furs, cameras, musical instruments, fine arts, and collectibles with agreed values. This coverage applies worldwide, has no deductible, covers mysterious disappearance, and pays the scheduled amount without depreciation, offering superior protection to standard homeowners' sublimits. Personal effects floater. Coverage for personal belongings while traveling, protecting items temporarily away from home against broader perils than standard homeowners' off-premises coverage. This specialized coverage is particularly useful for frequent travelers, covering baggage, clothing, and personal items worldwide with minimal restrictions. Scheduled valuables, high-value items specifically listed on an insurance policy or endorsement with individual descriptions, values, and appraisals, receiving broad open peril coverage. Common scheduled items include engagement rings, watches, fur coats, paintings, sculptures, rare coins, and stamps that exceed standard policy sublimits and require enhanced protection. Watercraft package policy, specialized insurance for boats, yachts, and watercraft, providing comprehensive coverage, including hull, physical damage, liability, medical payments, and additional coverages like salvage, wreck removal, and personal effects. This package addresses unique marine exposures beyond what homeowners or auto policies cover, with coverage tailored to vessel size, type, and usage. Snowmobile insurance, specialized coverage for snowmobiles, providing liability protection, physical damage coverage, collision and comprehensive, medical payments, and uninsured motorist coverage for winter recreational vehicles. Standard homeowners and auto policies provide limited or no coverage for snowmobiles, making dedicated coverage essential for owners. Recreational vehicle insurance, specialized policies covering recreational vehicles like motorhomes, campers, all-terrain vehicles, and dirt bikes, providing liability, physical damage, and unique coverages like vacation liability and personal effects. These policies address exposures that standard auto and homeowners policies exclude or limit, tailored to recreational use patterns and mobile living spaces. Golf cart liability endorsement, an endorsement that adds liability coverage for golf carts owned or used by the insured, which may be excluded or have limited coverage under standard homeowners or auto policies. This coverage is essential for golf cart owners, particularly in retirement communities where golf carts are used for transportation, providing liability protection for on-course and off-course use. Mobile home insurance, specialized property and liability coverage for manufactured or mobile homes that may use modified homeowners forms or specialized mobile home policies addressing unique construction and exposure characteristics. Coverage accounts for differences in construction methods, foundation types, transportation risks, and depreciation patterns compared to site-built homes. Earthquake policy, a separate policy or endorsement that provides coverage for damage caused by earthquakes, earth movement, volcanic eruption, and related shock waves, which are excluded from standard homeowners policies. Coverage includes dwelling, personal property, additional living expenses, and typically uses a percentage deductible, 10 to 25% of coverage A, rather than a flat dollar amount. Flood insurance, coverage obtained through the National Flood Insurance Program, NFIP, or private insurers for damage caused by flooding, which is excluded from standard homeowners and dwelling policies. NFIP policies provide separate limits for building $250,000 maximum and contents $100,000 maximum with a 30-day waiting period covering rising water, storm surge, mud flow, and surface water accumulation. Commercial Package Policy, CPP, a modular commercial insurance policy combining multiple coverage parts, property, liability, crime, inland marine, under one policy with common declarations, conditions, and definitions. The CPP offers flexibility, convenience, and often premium discounts compared to purchasing separate monoline policies, allowing businesses to customize coverage to their specific needs. Building and Personal Property Coverage Form, BPP, the standard commercial property form that covers buildings, business personal property, and personal property of others, with coverage triggered by selecting one of three cause of loss forms. This is the foundation of commercial property insurance and can be written on a specific or blanket basis with various optional coverages added by endorsement. Cause of loss. Basic form. The most restrictive commercial property cause of loss form covering 11 basic named perils, including fire, lightning, explosion, windstorm, hail, smoke, aircraft, vehicles, riot, vandalism, and sprinkler leakage. This provides the minimum level of protection at the lowest premium and is rarely used except for high-risk properties or to reduce costs. Cause of loss, broad form, a commercial property form covering all basic perils plus additional named perils such as falling objects, weight of ice, snow, sleet, and water damage from plumbing or HVAC systems. This middle-tier option provides more comprehensive protection than basic form while remaining more affordable than special form coverage. Cause of loss, special form. The broadest commercial property coverage providing open perils, all risk protection for all direct physical loss except those specifically excluded, placing the burden on the insurer to prove an exclusion applies. This is the preferred coverage for most commercial properties, offering comprehensive protection against unforeseen causes of loss. Coverage extensions. Additional amounts of coverage automatically provided without additional premium for specific exposures, like newly acquired or constructed property, personal effects, valuable papers, and property off-premises, subject to specified limits and conditions. These extensions provide limited coverage for common business exposures that might otherwise require separate policies or endorsements. Outdoor property coverage. A coverage extension providing limited protection for outdoor property, including fences, radio/TV antennas, signs not separately covered, trees/shrubs/plants, and detached signs, typically with a $2,500 limit and $1,000 per item sublimit. This extension provides basic coverage for exterior property that's exposed to more perils than building contents. Outdoor signs coverage. Coverage extension for signs attached to buildings or freestanding on the premises, providing $2,500 coverage as part of the outdoor property extension or higher limits when separately scheduled. Signs are subject to specific limitations and may require separate scheduling for full replacement cost if they're expensive or custom-made. Valuable papers and records coverage. A coverage extension providing limited coverage, $2,500. typical for the cost to research, replace, or restore valuable papers, documents, books, and electronic data, covering reproduction cost rather than intrinsic value. Higher limits require separate scheduling or an inland marine policy for full protection of critical business records. Accounts receivable coverage, a coverage extension providing limited protection, $2,500 typical, for amounts due from customers that cannot be collected due to loss of accounts receivable records, including collection expenses and interest charges. Businesses with significant receivables need higher limits through endorsement or separate coverage to protect this critical asset. Legal liability coverage form, a specialized form covering the insured's legal liability for damage to property of others in the insured's care, custody, or control, such as tenant's liability for damage to a leased building. This provides coverage that standard liability policies exclude for property in the insured's care, custody, or control. Builder's risk, specialized property coverage for buildings under construction, including the structure, materials, supplies, equipment, and temporary structures at the job site. This covers the interests of owners, contractors, and lenders during construction, and typically terminates when the building is completed, occupied, or accepted by the owner. Condominium Commercial Unit Owners Form, a specialized commercial property form for businesses that own condominium units, covering business personal property, improvements and betterments, and the unit owner's share of building property not covered by the association's master policy. This coordinates with the association's coverage to ensure complete protection without gaps or overlaps. Condominium Association Coverage. Property coverage for condominium associations protecting common areas, the building structure, and shared property as defined in the association documents, using either a single entity or bare walls in approach. This master policy determines what the association covers versus what unit owners must insure individually. Leasehold interest coverage. Coverage for a tenant's financial interest in favorable lease terms when a covered loss terminates the lease or makes the premises unusable, compensating for the loss of rent savings below market rates. This protects tenants who have below-market leases that represent a valuable business asset. Consequential loss. An indirect loss resulting from a direct physical loss, such as business income loss, extra expenses, or loss of market value following property damage. While direct losses involve physical damage to property, consequential losses are the resulting financial impacts that extend beyond the immediate physical damage. Vacancy. The condition where a building or structure has no people, business operations, or property present for more than 60 consecutive days. Commercial vacancy provisions are stricter than residential, often suspending coverage for vandalism, sprinkler leakage, water damage, glass breakage, and theft, while reducing payment by 15% for other covered losses. Vacancy condition. A policy provision that reduces or suspends certain coverages when a building is vacant for more than 60 consecutive days, recognizing increased exposure to vandalism, theft, and deterioration. Unlike unoccupancy, which has people or operations but is temporarily empty, vacancy significantly increases risk and triggers coverage limitations. Tenant improvements and betterments, alterations, installations, or additions made by a tenant at their expense to a building they occupy but do not own, which become part of the building. Coverage protects the tenant's financial interest in these improvements, with valuation based on use interest, if the tenant can relocate them, or proportionate interest, if they cannot. Stock, inventory, merchandise held for sale, raw materials, goods in process of manufacture, and finished goods ready for sale, representing a major business personal property exposure. Stock values fluctuate seasonally and require careful valuation, often using reporting forms to adjust coverage as inventory levels change. Merchandise, goods, products, and commodities that a business holds for sale to customers, synonymous with inventory or stock in retail and wholesale operations. Merchandise is a key component of business personal property coverage, and may require seasonal adjustments or reporting forms due to fluctuating values. Fixtures, equipment, machinery, or property permanently attached to a building that would damage the property if removed, such as built-in shelving, lighting systems, or HVAC equipment. The classification as fixtures versus business personal property affects whether they're covered under building or contents coverage. Business personal property. Movable property owned by the business and used in its operations, including furniture, equipment, machinery, stock, and supplies, but excluding real property, vehicles, and certain other categories. BPP is covered under Coverage B of commercial property forms with specific definitions and limitations that vary from personal property in homeowners' policies. Property off-premises, a coverage extension providing limited coverage $10,000, typical for business personal property, while temporarily away from the insured premises, excluding property at fairs, sales locations, or in vehicles. Higher limits require scheduling or separate inland marine coverage for property regularly away from premises. Agreed value, a coverage option where the insurer and insured agree in advance on the value of covered property, suspending the coinsurance requirement and guaranteeing payment of the agreed amount in the event of total loss. This eliminates valuation disputes and coinsurance penalties, but requires annual revaluation to maintain accuracy. Stated value, a valuation provision where a specific amount is stated in the policy, but actual payment is the lesser of stated amount, actual cash value, or replacement cost, without suspending coinsurance. Unlike agreed value, stated value doesn't guarantee full payment and still requires meeting coinsurance obligations. Monthly limit of indemnity, a business income coverage option that pays a specified fraction, often 1/3 or 1/4, of the business income limit for each month of loss, without requiring coinsurance. This simplified approach works well for businesses with consistent monthly income and eliminates the complexity of coinsurance calculations. Maximum period of indemnity, a business income coverage option that pays for a specified time period, 120, 180, or 360 days, following a loss, regardless of the actual business income loss, without coinsurance requirements. This option provides certainty about coverage duration and eliminates coinsurance, though it may not fully protect businesses with long recovery periods. Value reporting form, a commercial property coverage approach requiring the insured to periodically report property values, typically monthly or quarterly, with premiums adjusted based on actual values reported and coverage automatically adjusting to match. This is ideal for businesses with fluctuating inventory, preventing both overinsurance and underinsurance while ensuring adequate protection. Deductible aggregation, a provision limiting the total deductible amount when multiple locations or buildings are damaged in a single occurrence, capping the total deductible at a specified amount or number of deductibles. This prevents excessive out-of-pocket costs when catastrophic events damage multiple insured locations simultaneously. Occurrence limit of insurance, the maximum amount the insurer will pay for all covered losses resulting from a single occurrence, regardless of the number of locations, buildings, or types of property damaged. This cap protects the insurer from unlimited exposure when a single event causes widespread damage across multiple insured interests. Annual aggregate limit, the maximum amount the insurer will pay for all covered losses during the policy year, regardless of the number of occurrences. Once this limit is exhausted, no further coverage is available until the policy renews, making it critical for businesses to monitor accumulating losses. Business income, coverage for lost net income and continuing operating expenses when business operations are suspended due to direct physical loss to covered property from a covered cause of loss. This time element coverage ensures businesses can survive the financial impact of forced closures, paying for lost profits and ongoing expenses like payroll and rent during the period of restoration. Extra expense, coverage for reasonable and necessary expenses incurred to continue operations during the period of restoration following a covered loss, beyond what would normally be spent. This includes costs to operate from temporary locations, rent equipment, expedite repairs, or other measures to minimize business interruption. Period of restoration. The time period beginning when physical loss occurs and ending when property should be repaired or replaced with reasonable speed, or when business is resumed at a new location. This defines how long business income coverage continues and establishes the timeframe for measuring business interruption losses. Extended business income, coverage that extends business income protection beyond the period of restoration for a specified number of days, typically 30 to 60, or until normal business operations resume, whichever occurs first. This recognizes that businesses may not immediately return to pre-loss income levels even after repairs are complete. Civil authority coverage. Coverage for business income and extra expense losses when a civil authority prohibits access to the insured premises due to a covered cause of loss at a nearby location. This applies when government orders prevent access even though the insured's property isn't directly damaged, typically limited to 30 days. Utility services, direct damage, coverage for direct physical loss to covered property caused by interruption of utility services, electricity, gas, water, steam, telecommunications, when the interruption results from covered property damage at the utilities facilities. This addresses losses when power outages or utility failures directly damage the insured's property. Utility services, time element, coverage for business income and extra expense losses resulting from interruption of utility services when covered property damage occurs at the utility provider's facilities within specified distance limits. This covers the business interruption consequences of losing power, water, or communications even when the insured's property suffers no direct damage. Contingent business income. Coverage for business income losses when the insured's operations are suspended due to covered property damage at a supplier's, manufacturer's, or customer's location, contributing or recipient locations. This protects businesses dependent on supply chains, covering income losses when they cannot obtain materials or deliver products due to others' property losses. Coverage A, bodily injury and property damage. The primary coverage in commercial general liability policies that pays for the insured's legal liability when their business operations cause bodily injury or property damage to third parties, including defense costs and damages. This coverage responds to claims made or occurrences happening during the policy period, subject to per occurrence and aggregate limits. Coverage B, personal and advertising injury. CGL coverage for legal liability arising from specified non-physical offenses including false arrest, malicious prosecution, wrongful eviction, slander, libel, defamation, violation of privacy rights, and offenses committed during advertising activities like copyright infringement. This protects businesses against claims for reputational harm, invasion of privacy, and advertising-related torts. Coverage C, medical payments. No-fault coverage that pays reasonable medical expenses for persons injured on the insured's premises or due to the insured's operations, regardless of legal liability, up to a per-person limit, typically $5,000 to $10,000. This provides quick payment for minor injuries without requiring proof of negligence and may help prevent larger liability claims. Occurrence form, a commercial general liability policy that covers bodily injury or property damage that occurs during the policy period, regardless of when the claim is made, providing long-tail coverage. This is the preferred form because coverage continues indefinitely for incidents that happen during the policy period, even if claims are filed years later. Claims-made form, a commercial general liability policy that covers claims first made during the policy period, provided the injury or damage occurred after the retroactive date, creating coverage limitations based on when claims are reported. This form requires continuous renewal to maintain coverage and typically necessitates purchasing tail coverage when switching insurers or retiring. Retroactive date. The date specified in a claims-made CGL policy before which incidents are not covered, even if the claim is made during the current policy period. Any bodily injury or property damage that occurred before the retroactive date is excluded, making it critical to maintain or carry forward the earliest retroactive date when renewing or changing carriers. Extended reporting period, an option to extend the time for reporting claims under a claims-made CGL policy after it expires or is cancelled, covering claims made during the extended period for incidents that occurred after the retroactive date but before policy expiration. Also called tail coverage, this is essential when discontinuing claims-made coverage to maintain protection for past exposures. Basic extended reporting period, an automatic, non-cancelable extension included in claims-made policies, typically 60 days, to report claims for incidents that occurred during the policy period but weren't reported before expiration. This provides a limited grace period at no additional charge, but usually covers only incidents reported within the short window after policy end. Supplemental extended reporting period, an optional, purchased extension, typically unlimited duration, that provides additional time beyond the basic ERP to report claims for covered incidents that occurred before policy expiration. This must usually be requested within 60 days of policy expiration and requires an additional premium, often 100 to 200% of expiring annual premium, but provides comprehensive tail coverage. Insured contract, a written contract or agreement specifically defined in the CGL policy as one for which contractual liability coverage applies, including leases of premises, sidetrack agreements, easements, indemnification obligations in connection with premises/work, and elevator maintenance agreements. Only these specifically defined contracts receive coverage, while other assumed liabilities are excluded. Hostile fire. In commercial general liability, the concept of fire that escapes its intended location becomes relevant in determining fire legal liability coverage for tenants. Coverage applies when tenant negligence causes a hostile fire that damages the landlord's building, filling the gap left by the care, custody, or control exclusion. Fire legal liability. Coverage for the insured's liability for fire damage to premises rented to or temporarily occupied by the insured. This provides coverage for tenant liability when fire damages a leased building, subject to a specified sublimit, typically $50,000 to $100,000 or higher if increased. Premises, operations liability. Combined liability exposure arising from conditions on the insured's premises and ongoing business operations covering injuries to customers, vendors, or the public from hazards like slip and falls, falling objects, or operational accidents. This represents the basic day-to-day liability exposure of businesses and is automatically covered under Coverage A. Products completed operations liability. Liability arising from the insured's products after they leave the insured's custody or from work completed and turned over to others, including defects, failures, or injuries occurring later. This exposure has a separate aggregate limit from premises operations and continues after work is finished, covering long-tail exposures from products and completed projects. Operations liability. Liability arising from the insured's ongoing business activities, work in progress, and operations before completion, distinct from completed operations, which addresses liability after work is finished. This includes injuries occurring at job sites, during service calls, or while work is being performed. Third-party injury. Injury or damage to someone other than the insured or their employees, creating potential liability exposure that general liability policies cover. Third parties include customers, visitors, the public, vendors, and anyone with whom the insured does not have an employment relationship. Product recall, an exclusion eliminating coverage for the costs of withdrawing, inspecting, repairing, replacing, or disposing of the insured's products or work due to known or suspected defects, even if no injury has occurred. This sistership exclusion treats systematic product defects as business risks rather than insurable liability, excluding both recall expenses and loss of business income. Libel, written, printed, or broadcast defamation that harms a person's or business's reputation, covered under Coverage B, Personal and Advertising Injury of the CGL. Commercial libel includes false statements in advertising, written communications, or published materials that damage another's reputation or business. Slander, spoken defamation that harms a person's or business's reputation, covered under Coverage B, Personal and Advertising Injury of the CGL. Commercial slander includes false oral statements made to third parties that damage reputation, disparage products, or harm business relationships. Wrongful eviction, the illegal or improper removal of a person from premises they have the right to occupy, covered under Coverage B, Personal and Advertising Injury. This protects landlords, property managers, and businesses against claims when they improperly force someone to leave premises, violating their possessory rights. Violation of privacy rights, offenses including invasion of privacy, unauthorized disclosure of private information, or intrusion into someone's private affairs, covered under Coverage B, Personal and Advertising Injury. This has become increasingly important with data breaches and social media, protecting businesses against claims for improper use or disclosure of personal information. Damage to impaired property, an exclusion eliminating coverage for loss of use of undamaged property that cannot be used because the insured's defective product or work is incorporated into it. For example, if a defective component makes an entire machine unusable, the CGL won't cover the machine owner's loss of use, as this represents a warranty or product quality issue rather than liability. Electronic data exclusion, an exclusion eliminating coverage for damages to electronic data, including loss, corruption, destruction, or loss of use of data, programs, or software. This broad exclusion removes most cyber-related exposures from CGL coverage, requiring separate cyber liability insurance for data breaches, network security failures, and technology errors. Recall of products, work, or impaired property. An exclusion eliminating coverage for costs to withdraw, inspect, repair, replace, or dispose of the insured's products or work, or property containing the insured's products or work when defects are known or suspected. This sistership exclusion treats product recalls and systematic failures as uninsurable business risks. Distribution of material in violation of statutes exclusion, an exclusion that eliminates advertising injury coverage when the insured knowingly violates laws governing emails, text messages, faxes, or phone calls, such as anti-spam laws or do-not-call regulations. This prevents coverage for willful violations of communications regulations like the Telephone Consumer Protection Act. Aircraft, auto, or watercraft exclusion, an exclusion eliminating bodily injury or property damage arising from ownership, maintenance, use, or entrustment of aircraft, automobiles, or watercraft, as these require specialized policies. Limited exceptions exist for parking on premises, watercraft under certain lengths on premises, and vehicles used primarily off public roads. Business Owners Policy, BOP, a package policy designed for small to medium-sized businesses that combines property, liability, and business income coverages in a simplified, standardized format at a lower cost than separate policies. BOPs provide automatic coverages and higher limits than typical for small businesses, with eligibility based on business type, size, and revenue. Eligibility rules, criteria that determine which businesses qualify for BOP coverage, typically based on business type, square footage, number of stories, annual revenues, and specific operations. Eligible businesses generally include offices, retail stores, restaurants, and light manufacturing under certain size thresholds, while businesses like auto dealers, bars, and financial institutions are typically ineligible. BOP property coverage in BOPs that provides special open peril coverage for buildings, and broad-named perils coverage for business personal property, with many coverages included automatically. The BOP form is more generous than standard commercial property forms, including higher automatic limits for coverage extensions and additional coverages without separate premiums. BOP liability coverage, General liability coverage included in BOPS that combines premises operations and products completed operations liability into a single integrated coverage, similar to standard CGL but simplified. This provides both occurrence-basis liability protection and medical payments coverage without requiring separate policy forms. Automatic seasonal increase, a feature in BOPs that automatically increases business personal property and business income limits by a specified percentage, typically 25%, during the insured's peak business season. This temporary increase addresses seasonal inventory fluctuations common in retail businesses without requiring endorsements or additional premium for the brief period. Business income included. Business income, business interruption, coverage is automatically included in BOPs without requiring separate purchase or premium calculation, providing 12 months of coverage for lost income and continuing expenses. This standard inclusion represents one of the BOP's major advantages, as comparable coverage must be added by endorsement in standard commercial property policies. Extra expense included. Coverage for reasonable expenses to continue operations after a covered loss is automatically included in BOPS as part of the business income coverage. Extra expense coverage helps businesses minimize business interruption by paying for costs like temporary locations, equipment rental, and expedited repairs. Hired non-owned auto liability, an endorsement available for BOPs that provides liability coverage for autos the business hires, rents, leases, or borrows, hired autos, and for employee-owned vehicles used for business purposes, non-owned autos. This optional coverage fills gaps for businesses that don't own vehicles but have auto liability exposure from business use of other vehicles. Protective safeguards endorsement, an endorsement requiring the insured to maintain specific fire or burglar alarm systems in working order as a condition of coverage, similar to the commercial property version. Failure to maintain these required protective devices can result in policy suspension or claim denial, and this endorsement is typically required based on underwriting assessment of the risk. Utility services, direct damage, coverage automatically included in BOPs for direct physical damage to covered property caused by interruption of utility services when the interruption results from covered damage to the utility's equipment within specified distance limits. This covers damage like frozen pipes from power outages or spoiled inventory from loss of refrigeration. Utility services, time element, coverage, automatically included in BOPs for business income and extra expense losses resulting from interruption of utility services caused by covered damage to the utility provider's equipment within 1 mile of the premises. This addresses business interruption when power, water, communications, or other utilities are disrupted even though the insured's property isn't directly damaged. Professional liability exclusion, an exclusion in BOPs that eliminates coverage for liability arising from rendering or failure to render professional services, errors, omissions, or mistakes in professional activities. Businesses with professional exposure, medical, legal, accounting, consulting, need separate professional liability or errors and omissions coverage, as BOPs only cover general liability risks. Computer-related losses exclusion, an exclusion that eliminates or limits coverage for loss of electronic data, computer programming errors, computer viruses, and costs to research, replace, or restore electronic information. While BOPS provide limited coverage for electronic data as part of valuable papers coverage, comprehensive cyber exposures require separate cyber liability insurance. Outdoor signs, BOPs, provide more generous coverage for outdoor signs than standard commercial property policies, typically including $2,500 per sign. Some forms provide higher limits for signs attached to buildings or on premises. This enhanced automatic coverage often eliminates the need to separately schedule signs unless they're particularly valuable or custom-made. Business Auto Coverage Form, BACF, the standard commercial auto policy form providing liability, physical damage, and other coverages for vehicles used in business operations, with coverage determined by numerical symbols designating which autos are covered. The BACF is more flexible than personal auto policies, allowing businesses to select specific coverages for different classes of vehicles based on their operational needs. Auto symbols, numerical designations used in business auto policies to identify which categories of vehicles are covered under each coverage section, appearing in the declarations next to each coverage. Symbols determine whether coverage applies to any auto, owned autos only, hired autos, non-owned autos, or specifically described autos, with different symbols applicable to different coverages. Symbol 1. Any auto. The broadest auto symbol providing coverage for any vehicle used in the business, including owned, hired, non-owned, and newly acquired autos without requiring specific description. This symbol provides maximum flexibility, but typically costs more due to the unlimited scope of covered vehicles. Symbol 2. Owned autos only. A symbol restricting coverage to only those autos the named insured owns, including those acquired after the policy begins. This provides automatic coverage for newly purchased vehicles, but excludes hired and non-owned autos unless additional symbols are selected. Symbol 7. Specifically described autos. A symbol restricting coverage to only those individual vehicles specifically listed in the policy declarations by year, make, model, and VN. This provides the narrowest coverage with no automatic extension to newly acquired vehicles, requiring the insured to notify the insurer to add new vehicles. Symbol 9. Non-owned autos. A symbol providing coverage for vehicles the named insured does not own, lease, hire, rent, or borrow that are used in connection with the business, typically employee-owned vehicles used for business purposes. This protects the employer from vicarious liability when employees use personal vehicles for business activities. Drive-away contractors exclusion. An exclusion in business auto policies eliminating coverage for businesses that transport vehicles for others as their primary business, such as drive-away companies that deliver new cars to dealerships. These specialized operations require specifically designed motor carrier coverage due to unique exposures. Motor carrier coverage form, a specialized commercial auto form designed for trucking companies and common carriers that transport goods or passengers for hire, providing coverage tailored to interstate commerce requirements and federal regulations. This form addresses unique exposures like cargo liability and regulatory compliance that standard business auto policies don't cover. Truckers Coverage Form, a specialized commercial auto form for long-haul truckers and for hire motor carriers that combines auto liability, trailer interchange coverage, and provisions for both owned and non-owned equipment. This addresses the unique needs of independent truckers who may operate both their own vehicles and haul trailers owned by others. Employer's non-ownership liability, coverage for an employer's vicarious liability when employees use their personal vehicles for business purposes, protecting the company even though it doesn't own the vehicles. This Symbol 9 coverage is essential for businesses whose employees drive personal cars for deliveries, sales calls, or other work-related activities. Fellow employee exclusion. An exclusion in business auto liability coverage, eliminating coverage for bodily injury to a fellow employee injured during the course of employment, as these injuries should be covered by workers' compensation. This prevents duplication of coverage and ensures employee injuries are handled through the workers' compensation system rather than auto liability. Mobile equipment. Land vehicles designed primarily for use off public roads or not subject to motor vehicle registration, including bulldozers, forklifts, cherry pickers, and farm equipment, which are typically covered under general liability rather than auto policies. The distinction between autos and mobile equipment determines which policy provides coverage, with specific definitions clarifying borderline cases. MCS 90 Endorsement. A federally mandated endorsement for motor carriers operating in interstate commerce that guarantees minimum liability coverage will be available to the public regardless of policy conditions the insurer might assert. This endorsement protects the public by ensuring payment for injuries or damage caused by commercial carriers, with the insurer retaining rights to seek reimbursement from the insured for breaches of policy conditions. Garage coverage form, a specialized commercial policy designed for auto dealerships, repair shops, service stations, and parking garages that combines auto liability, premises liability, garage keepers coverage, and dealers' physical damage. This integrated form addresses the unique exposures of businesses that sell, repair, service, store, or park customers' vehicles. Garage keepers coverage for a garage's legal liability for damage to customers' vehicles while in the insured's care for service, repair, storage, or safekeeping, available on direct legal liability or direct primary and excess basis. This fills the gap created by the care, custody, or control exclusion in general liability policies, protecting garages against claims for damage to vehicles entrusted to them. Dealers' physical damage coverage, specialized property coverage for auto dealers protecting inventory vehicles, new or used autos held for sale, against physical damage, typically written on an open lot basis with automatic coverage for newly acquired vehicles. This coverage addresses the unique exposure of constantly changing inventory with high values and special valuation needs. Auto liability rating. The process of calculating commercial auto premiums based on factors including vehicle type and use, radius of operation, local, intermediate, long haul, driver records, business type, territory, and loss history. Commercial rating is more complex than personal auto due to varied vehicle uses, multiple drivers, and business-specific exposures. Workers' compensation, a mandatory, no-fault insurance system that provides medical benefits, wage replacement, rehabilitation, and death benefits to employees injured or killed in work-related accidents, regardless of fault. This statutory coverage is required in all states and provides guaranteed benefits to injured workers while generally protecting employers from liability lawsuits through the exclusive remedy doctrine. Employers' liability, Part 2 of the workers' compensation policy that provides coverage for employer liability lawsuits that fall outside the workers' compensation system, such as third-party overactions, dual-capacity suits, or consequential injuries to spouses. This complements the statutory workers' compensation benefits by covering common law liability claims not subject to the exclusive remedy doctrine. Exclusive remedy doctrine. A legal principle stating that workers' compensation benefits are the employee's sole remedy against the employer for work-related injuries, barring employees from suing their employer in civil court for additional damages. This trade-off provides employees with guaranteed benefits without proving fault while protecting employers from unlimited liability and costly litigation. Compensable injury, an injury, illness, or death that qualifies for workers' compensation benefits because it meets the statutory requirements of arising out of and occurring in the course of employment. Compensable injuries must be work-related and occur during employment activities to trigger benefits. Occupational disease, an illness or condition that develops gradually over time due to repeated exposure to workplace hazards, such as asbestosis, carpal tunnel syndrome, or hearing loss from noise exposure. These diseases are compensable under workers' compensation if they arise out of and are peculiar to the employee's occupation or work environment. Work-related injury, an injury or illness that arises out of and occurs in the course of employment, establishing the causal connection to work activities required for workers' compensation coverage. The injury must result from workplace conditions, activities, or exposures during the performance of job duties. Arising out of and in the course of employment, AOC, the dual test for determining workers' compensation compensability, requiring that the injury both originates from work activities or conditions arising out of and occurs during the period of employment while performing job duties in the course of. Both elements must be satisfied for an injury to be compensable under workers' compensation. Permanent partial disability, a workers' compensation classification for injuries that result in permanent impairment or loss of function of a body part, but don't completely disable the worker from all employment. Benefits are typically calculated based on a schedule of injuries, like loss of a finger, or as a percentage of wage earning capacity loss. Temporary partial disability, a workers' compensation classification for workers who can return to modified or light-duty work, earning less than their pre-injury wages during recovery, but are expected to eventually regain full capacity. Benefits typically pay a percentage of the wage loss, often 2/3, until the worker reaches maximum medical improvement. Permanent total disability, a workers' compensation classification for catastrophic injuries that permanently and completely prevent the worker from performing any substantial gainful employment. Benefits typically continue for life and may include both wage replacement, often 2/3 of pre-injury wages, and medical care. Temporary total disability, a workers' compensation classification for workers who are completely unable to work during recovery but are expected to eventually return to employment. Benefits typically pay a percentage of pre-injury wages, usually 2/3, from the end of a waiting period until the worker can return to work or reaches maximum medical improvement. Experience modification factor, a multiplier applied to workers' compensation premiums that adjusts rates based on the employer's actual loss experience compared to the expected losses for similar businesses. A mod below 1.0, like 0.85, provides a discount for better-than-average safety performance, while a mod above 1.0, like 1.20, surcharges premiums for worse-than-average experience. Payroll, the primary basis for calculating workers' compensation premiums, with rates applied per $100 of employee wages or payroll. Different job classifications have different rates reflecting the varying degrees of risk, with higher hazard occupations, construction, manufacturing, having significantly higher rates per $100 of payroll than lower-risk jobs, clerical, sales. NCCI, National Council on Compensation Insurance, the largest workers' compensation rating and statistical organization that develops rates, classification codes, and policy forms for most states that don't have independent rating bureaus. NCCI collects loss data, establishes experience modification factors, and provides advisory rates and forms that many states adopt or use as guidelines. Monopolistic state funds, state-operated workers' compensation systems in jurisdictions, North Dakota, Ohio, Washington, Wyoming, where private insurers are prohibited from writing coverage and all employers must purchase from the state fund. These states maintain exclusive control over workers' compensation insurance as a government function. Competitive State Fund, a state-operated workers' compensation insurer that competes with private insurance companies, providing an option for employers while maintaining competition in the market. These funds often serve as insurers of last resort for high-risk employers while competing for standard business alongside private carriers. Federal Employers' Liability Act, FELA, a federal law providing railroad workers with the right to sue their employers for injuries caused by employer negligence, serving as an alternative to state workers' compensation systems. FELA requires injured railroad employees to prove employer negligence, but allows recovery of full damages, including pain and suffering, unlike limited workers' compensation benefits. Jones Act, a federal law providing seamen and maritime workers the right to sue vessel owners and operators for injuries caused by negligence or unseaworthiness, similar to FELA for railroad workers. The Jones Act applies to workers who spend significant time aboard vessels and provides broader remedies than workers' compensation, including maintenance and cure benefits. Longshore and Harbor Workers' Compensation Act, LHWCA, a federal workers' compensation program covering maritime workers who work on navigable waters or adjoining areas, docks, piers, terminals, but are not seamen covered by the Jones Act. LHWCA provides no-fault benefits similar to state workers' compensation, but with federal oversight and different benefit structures, covering longshoremen, harbor workers, and ship repairers. Employee theft, coverage for loss of money, securities, or other property resulting from theft committed by an employee, acting alone or in collusion with others. This is the most common commercial crime coverage and protects against dishonest acts by employees, including embezzlement, larceny, and misappropriation of funds or property. Forgery or alteration, coverage for loss resulting from forgery or alteration of checks, drafts, promissory notes, or similar written promises, orders, or directions to pay money. This protects businesses when someone fraudulently signs or alters financial instruments, such as forged checks or altered amounts on legitimate checks. Theft, disappearance, and destruction. A broad crime coverage ensuring against loss of money and securities from any cause inside or outside the premises, including mysterious disappearance, where the cause cannot be determined. This provides the most comprehensive protection for money and securities, but typically costs more than coverage limited to specific named causes, like robbery or burglary. Inside the premises, coverage for loss of money and securities by actual or attempted robbery or safe burglary, or loss of other property by actual or attempted robbery, burglary, or theft occurring inside the insured premises. This form requires evidence of forced entry or exit or threat of violence, providing more restrictive coverage than theft, disappearance, and destruction. Outside the premises, coverage for loss of money and securities while outside the insured premises in the care and custody of a messenger or armored car service, protecting against robbery or other causes of loss. This covers deposits being taken to the bank, money being transported between locations, or cash in possession of authorized employees away from the business. Robbery, the unlawful taking of property from the care and custody of a person by force, threat of violence, or by putting that person in fear. In crime insurance, robbery requires both the taking of property and the element of force or threat against a person present, distinguishing it from burglary. Safe burglary, the unlawful taking of property from within a locked safe or vault by a person making forcible entry into the safe, evidenced by marks of forced entry on the exterior. This coverage requires visible signs that tools or explosives were used to break into the safe, not just that the safe was found open. Custodian, an employee, partner, or member designated to have care and custody of property inside the premises, not including janitors, watchpersons, or persons with similar duties. Custodians have authorized access to valuables, and their duties include safeguarding money, securities, and other property. Messenger, an employee, partner, or member authorized to have care and custody of property outside the premises while traveling in the performance of duties. Messengers transport money, securities, or other valuable property between locations, such as taking bank deposits or delivering important documents. Computer fraud, coverage for loss of money, securities, or other property resulting from fraudulent entry of electronic data or computer program instructions into the insured's computer system. This covers situations where someone uses the insured's computer to transfer funds or property fraudulently, such as hacking into banking systems to initiate unauthorized transfers. Funds transfer fraud, coverage for loss of funds resulting from fraudulent instructions to a financial institution to transfer money from the insured's account, including telephone, electronic, or written instructions. This protects against sophisticated fraud schemes where criminals impersonate executives or use social engineering to authorize fraudulent wire transfers. Money and securities coverage, commercial version, protection for currency, coins, banknotes, bullion, traveler's checks, money orders, and other negotiable instruments, as well as evidences of debt and securities. This coverage is fundamental to commercial crime policies and can be written on various bases, including theft, robbery, burglary, or mysterious disappearance. Employee dishonesty bond, coverage protecting employers against financial losses caused by fraudulent or dishonest acts committed by employees, including theft, embezzlement, and misappropriation. This is essentially employee theft coverage structured as a bond, guaranteeing compensation to the employer for losses caused by dishonest employees. Fidelity bond, a type of insurance that protects employers against financial loss caused by dishonest acts of specified employees or classes of employees. Fidelity bonds can be written on a blanket basis covering all employees, name schedule basis, listing specific individuals, or position schedule basis, covering specified positions. Surety bond, a three-party agreement where the surety guarantees to the obligee that the principal will fulfill an obligation, such as completing a construction project or performing according to contract terms. Unlike insurance, which protects the insured, surety bonds protect third parties, and the surety expects to be reimbursed by the principal if a claim is paid. Commercial umbrella policy, a broad form of excess liability coverage for businesses that provides additional limits above underlying commercial policies, CGL, auto, employer's liability, and may also drop down to provide primary coverage for some exposures not covered by underlying policies, subject to a self-insured retention. Commercial umbrellas typically provide $1 to $25 million or more in additional coverage, protecting business assets against catastrophic liability claims while often broadening coverage beyond underlying policies. Follow Form Excess Liability, a commercial excess liability policy that adopts the same terms, conditions, exclusions, and coverage grants as the underlying primary commercial policies without broadening or restricting coverage. This creates vertical alignment between coverage layers, ensuring that if the primary policy covers a loss, the excess will respond once underlying limits are exhausted, though some independent provisions may exist. Self-insured retention, the dollar amount, typically $10,000 to $100,000, that the insured must pay out of pocket before the commercial umbrella responds when providing drop-down coverage or when no underlying insurance applies. The SIR functions like a large deductible, but typically requires the insured to handle claims administration and defense within the retention, with the umbrella providing both defense and indemnity once the SIR is exhausted. Underlying commercial limits, the minimum liability limits that must be maintained on primary policies, typically 1 million CGL, 1 million auto, 1 million employer's liability, as a condition for the commercial umbrella to remain in force. These required underlying limits ensure adequate primary coverage exists before the umbrella layer responds, and may vary based on the insured's operations, revenues, and risk profile. Umbrella drop-down coverage, a feature of commercial umbrellas where the policy provides primary coverage, subject to the self-insured retention, for certain exposures not covered by underlying policies but covered by the umbrella. This can include broader territory, additional insureds not covered by underlying policies, or coverage for excluded operations, with the umbrella dropping down to provide first-dollar coverage after the SIR. Aggregate limits, the maximum amount the commercial umbrella will pay for all covered claims during the policy period, typically applying separately to products' completed operations and to general aggregate exposures. Unlike per-occurrence limits, which apply to each individual claim, aggregate limits cap total payments across multiple claims, requiring careful monitoring as losses accumulate throughout the policy year. Cyber liability, specialized coverage for first-party costs and third-party liability arising from data breaches, cyber attacks, network security failures, and privacy violations, including notification costs, credit monitoring, forensic investigations, business interruption, extortion payments, regulatory fines, and liability to customers whose data was compromised. This essential modern coverage addresses exposures that traditional commercial policies exclude, protecting businesses against the financial consequences of ransomware, hacking, system failures, and data theft. Employment practices, liability, EPLI, coverage protecting employers against claims by employees, former employees, or job applicants alleging wrongful employment practices, including discrimination, harassment, wrongful termination, retaliation, failure to promote, and other workplace-related violations of employment laws. EPLI provides defense costs and damages for these claims, which are excluded from general liability policies and have become increasingly common and expensive. Directors and officers, D&O liability, specialized coverage protecting corporate directors, officers, and the organization itself against claims alleging wrongful acts in managing the company, including breach of fiduciary duty, mismanagement, violations of securities laws, and other management decisions causing financial harm to shareholders, creditors, or the organization. D&O insurance is essential for attracting qualified board members by protecting their personal assets from liability and covering the organization's obligation to indemnify them. Fiduciary liability, coverage for liability arising from the management of employee benefit plans, pension, 401k, health insurance, when fiduciaries breach duties under ERISA, Employee Retirement Income Security Act, including mismanagement of plan assets, failure to diversify investments, or providing misleading information to participants. This specialized coverage protects plan trustees, administrators, and the sponsoring organization from claims by plan participants alleging financial losses due to improper plan management. Professional liability, insurance protecting businesses and professionals against financial losses caused by errors, omissions, negligence, or failure to perform professional services according to accepted standards, covering liability that general liability policies exclude. Also called errors and omissions, E&O insurance, this covers professionals like consultants, engineers, architects, insurance agents, technology firms, and other service providers whose advice or services could cause financial harm to clients. Malpractice insurance, professional liability coverage specifically for licensed professionals like physicians, dentists, lawyers, accountants, and other practitioners whose errors or negligence could cause injury or financial loss to patients or clients. Malpractice policies are typically written on a claims-made basis due to long-tail exposure and provide both defense costs and damages for claims alleging professional negligence or failure to meet standards of care. Pollution liability, specialized coverage for bodily injury, property damage, and cleanup costs resulting from pollution events at the insured's premises or resulting from the insured's operations, covering both sudden accidents and gradual pollution excluded by general liability policies. This essential coverage for environmentally sensitive businesses addresses releases of contaminants, hazardous materials, chemicals, and waste materials, whether sudden or occurring over time. Environmental impairment liability, comprehensive coverage for environmental damage, contamination, and associated costs including cleanup, remediation, defense, and third-party liability for both on-site and off-site pollution conditions. This specialized policy addresses regulatory compliance obligations under environmental laws like CERCLA, Superfund, site remediation costs, natural resource damage, and historical pollution conditions discovered during property transactions. Boiler and machinery, coverage for direct damage to equipment and indirect losses from mechanical or electrical breakdown of boilers, pressure vessels, machinery, and electrical systems, including business interruption and spoilage resulting from equipment failure. Modern equipment breakdown coverage extends beyond traditional boiler explosion to include computer equipment, HVAC systems, production machinery, and technology failures that standard property policies exclude as mechanical breakdown. Ordinance or law, coverage for increased costs when building codes, zoning ordinances, or laws require upgrades or different construction methods when repairing damaged commercial property, including demolition of undamaged portions, loss to the undamaged portion that must be demolished, and increased construction costs to comply with current codes. This essential commercial property endorsement addresses potentially catastrophic costs when older buildings must be brought to current code following even partial losses. Suretyship, a three-party relationship where the surety guarantees to the obligee, project owner, government entity, that the principal, contractor, business, will fulfill contractual obligations, with the surety assuming responsibility if the principal defaults. Unlike insurance, where the insured expects the insurer to pay losses, suretyship expects the principal to reimburse the surety for any payments made, and surety bonds are used extensively in construction, licensing, and public contracts. Commercial flood, coverage available through the National Flood Insurance Program or private insurers for commercial properties against damage from flooding, with NFIP providing up to $500,000 for building coverage and $500,000 for contents coverage per building. Commercial flood insurance is essential for businesses in flood zones, as standard commercial property policies exclude flood damage, and private market options now offer higher limits and broader coverage than NFIP for some risks. Crime insurance, specialized commercial coverage protecting businesses against financial losses caused by criminal acts such as employee theft, robbery, burglary, forgery, computer fraud, and funds transfer fraud. Crime policies can be written as standalone coverage or as part of a commercial package, addressing exposures that general liability and property policies exclude. Discovery form, a crime coverage form that covers losses discovered during the policy period, regardless of when the loss actually occurred, provided it happened after the retroactive date and while prior continuous coverage was in force. This form provides broader coverage than loss sustained because it responds to losses that may have occurred years earlier but weren't discovered until the current policy period. Loss sustained form, a crime coverage form that covers losses occurring during the policy period, regardless of when they are discovered, with a discovery period, typically 1 year, after policy expiration to report covered losses. This form requires both the loss occurrence and policy period to coincide, making it more restrictive than the discovery form, but often less expensive. Inside the premises coverage, crime coverage for loss of money, securities, or other property, while inside the insured premises caused by actual or attempted robbery, safe burglary, or other specified perils. This form requires evidence of forced entry or violence and is more restrictive than broad theft coverage. Outside the premises coverage, crime coverage for loss of money and securities, while outside the insured premises in the care and custody of a messenger or armored car service. This protects against losses during transit, such as bank deposits being transported or cash movements between business locations. Money, currency, coins, banknotes, bullion, traveler's checks, registered checks, and money orders held for sale to the public, as defined in crime policies. This definition is broader than just cash and includes various negotiable monetary instruments. Securities, negotiable and non-negotiable instruments representing money or property, including tokens, tickets, stamps, stock certificates, bonds, and evidences of debt, as defined in crime policies. Securities have value but are not money itself, requiring separate consideration in crime coverage. Other property, tangible property other than money and securities that has intrinsic value, excluding electronic data, computer programs, manuscripts, records, and accounts receivable in crime policies. This category typically receives more limited coverage than money and securities and may be subject to different covered perils. Custody, the legal responsibility for care and control of property, determining whose actions trigger coverage under crime policies. Custody typically rests with authorized employees, partners, or designated custodians who have been given responsibility for safeguarding valuables. Care and custody. The standard establishing responsibility for property in crime insurance, requiring that designated individuals have both physical control and responsibility for safeguarding the property. Loss must occur while property is in the care and custody of authorized persons for coverage to apply under most crime forms. Employee, a natural person, not a corporation or entity, in the regular service of the insured in the ordinary course of business, including directors while performing acts within the scope of their duties as employees, but excluding independent contractors, agents, and others not directly employed. This definition is critical because crime policies distinguish between employee theft covered and theft by non-employees may not be covered. Messenger, an employee, partner, or member authorized to have care and custody of property outside the premises while traveling in the performance of duties. Messengers transport money, securities, or other valuable property between locations, and losses in their custody trigger outside the premises coverage. Watchperson. A person retained specifically to have care and custody of property inside the premises whose sole duty is to protect the property, excluding persons with other duties. Watchpersons and guards are typically excluded from certain crime coverages because their sole duty is security, creating different expectations than for regular employees. Guard. A person employed to protect property, similar to a watchperson but may have broader responsibilities, whose actions may be excluded from certain crime coverages. The distinction between guards/watchpersons and other employees affects coverage because security personnel are expected to prevent losses. Protective safeguards, security devices, systems, or measures required to be maintained as a condition of crime coverage, including alarms, safes, vaults, surveillance systems, or security personnel. Failure to maintain required protective safeguards can suspend coverage or result in partial denial of claims. Safe burglary, the unlawful taking of property from within a locked safe or vault by a person making forcible entry into the safe, evidenced by visible marks of forced entry on the exterior. Crime policies require proof that tools or explosives were used to break into the safe, distinguishing this from mere opening of an unlocked safe. Vault, a secured room or compartment designed for the storage of valuables with reinforced walls, floor, ceiling, and a locking door system, providing higher security than a standalone safe. Vaults represent the highest level of physical security for valuable property and may have different coverage terms than safes in crime policies. Burglary, the unlawful taking of property from inside the premises by a person making forcible entry or exit, evidenced by visible marks or damage to the exterior of the premises or its doors, windows, or locks. Crime policies require physical evidence of forced entry or exit to distinguish burglary from other forms of theft, making this coverage more restrictive but typically less expensive. Robbery. The unlawful taking of property from the care and custody of a person by force, threat of violence, or by putting that person in fear of bodily harm. Robbery requires both the taking of property and the element of force or threat against a person who is present, distinguishing it from burglary, where no confrontation occurs. Theft, the broadest category of unlawful taking of property, encompassing burglary, robbery, larceny, and other forms of stealing without the owner's consent. Theft coverage in crime policies may require no specific method of taking, providing the most comprehensive protection, but typically at higher premiums. Larceny, the unlawful taking and carrying away of someone else's personal property, with the intent to permanently deprive the owner of possession. Larceny differs from burglary and robbery in that it doesn't require forced entry or confrontation, covering situations like shoplifting or pickpocketing. Forgery, the fraudulent making, altering, or imitating of a document or signature with intent to deceive, particularly involving checks, drafts, promissory notes, or other financial instruments. Crime policies cover losses when someone forges the insured's signature or alters legitimate documents to steal funds. Counterfeiting, the illegal creation, reproduction, or imitation of currency, securities, or other negotiable instruments with intent to deceive and pass them as genuine. Crime policies may cover losses when businesses unknowingly accept counterfeit money or when counterfeit items are substituted for genuine property. Extortion, the unlawful obtaining of money, property, or services from a person or entity through coercion, threats of harm, property damage, or exposure of damaging information. Crime policies may cover payments made under threat or losses resulting from extortion attempts, though coverage terms vary significantly. Kidnapping, extortion, threat, a criminal act involving threats to kidnap or harm individuals unless ransom or other demands are met, creating exposure for businesses whose executives or employees may be targeted. Specialized kidnap and ransom insurance covers ransom payments, negotiation expenses, and related costs, often excluded from standard crime policies. Computer fraud, the use of a computer to fraudulently cause a transfer of money, securities, or other property from inside the insured's premises or banking system to a person or place outside. This covers situations where criminals hack into systems, manipulate programs, or use unauthorized access to steal funds electronically. Funds transfer fraud. Loss of funds resulting from fraudulent instructions directing a financial institution to transfer, pay, or deliver money from the insured's account. This coverage addresses increasingly common fraud schemes where criminals impersonate executives or use social engineering to authorize wire transfers, often called CEO fraud or business email compromise. Fraudulent instruction. False or deceptive directions to transfer funds, change payees, or redirect payments, typically communicated through email, phone, or other electronic means while impersonating authorized personnel. These instructions lead to funds transfer fraud and represent a major exposure for businesses with wire transfer capabilities. Money orders and counterfeit paper currency. Coverage for loss resulting from the insured's acceptance of counterfeit money orders or paper currency in good faith exchange for merchandise, money, or services. This protects businesses that regularly accept cash or money orders from losses due to sophisticated counterfeits that pass initial inspection. Credit card fraud. Unauthorized use of credit cards or credit card information to obtain money, goods, or services, creating losses for businesses that accept credit cards or for individuals whose cards are stolen or compromised. Crime policies may provide limited coverage for credit card fraud, though coverage is often restricted and sublimited. Employee dishonesty. Fraudulent or dishonest acts committed by employees with the intent to cause the employer financial loss, including theft, embezzlement, forgery, and misappropriation of funds or property. This is the most common commercial crime coverage and protects against losses from trusted employees who violate their positions for personal gain. Social engineering fraud. Fraud schemes using psychological manipulation, impersonation, or deceptive communication, emails, phone calls, texts, to trick employees into voluntarily transferring money or property without realizing they've been deceived. This modern coverage addresses losses when employees follow what appear to be legitimate instructions that are actually from criminals impersonating executives, vendors, or customers, representing a rapidly growing exposure not traditionally covered by crime policies. ISO Commercial Crime Policy, the Standard Insurance Services Office Crime Policy Form, providing modular coverage options that businesses can select from various insuring agreements to customize protection against specific crime exposures. This simplified policy structure replaced multiple older crime forms and allows businesses to choose only the coverages they need, such as employee theft, forgery, computer fraud, or funds transfer fraud. Employee theft coverage, an insuring agreement covering loss of money, securities, and other property resulting directly from theft committed by an employee, whether acting alone or in collusion with others. This fundamental crime coverage protects against embezzlement, larceny, and misappropriation by employees, and can be written on a blanket basis, covering all employees, or scheduled basis, naming specific employees or positions. Forgery or alteration coverage, an insuring agreement covering loss resulting from forgery or alteration of checks, drafts, promissory notes, or similar written instruments, whether the forgery is of the insured's signature or payee endorsement. This protects businesses when criminals forge signatures on company checks or alter legitimate checks to change amounts or payees. Money and securities coverage. Broad coverage for loss of money and securities from any cause while inside or outside the premises, providing the most comprehensive protection for monetary instruments. This all-risk approach covers theft, mysterious disappearance, destruction, and other causes without requiring proof of specific covered perils like robbery or burglary. Inside the premises, theft of money and securities. Coverage for loss of money and securities by theft, disappearance, or destruction while inside the premises, without requiring evidence of forced entry or robbery. This provides broader protection than robbery or safe burglary coverage by covering mysterious disappearance and theft without violence or forced entry. Inside the premises, robbery or safe burglary, coverage for loss of money and securities inside the premises caused by actual or attempted robbery of a custodian, or by safe burglary, requiring evidence of force or threat. This more restrictive coverage requires either confrontation, robbery, or visible signs of forced entry to a safe burglary, making it less expensive than broad theft coverage. Outside the premises, messenger robbery, coverage specifically for loss of money and securities while in the care and custody of a messenger outside the premises, typically caused by robbery but potentially covering other perils depending on policy language. This protects against losses during transit, such as when employees transport bank deposits or cash between locations. Computer fraud coverage, an insuring agreement covering loss of money, securities, or other property resulting from the use of a computer to fraudulently cause transfer of property from inside the insured's premises or banking system. This addresses theft accomplished through hacking, unauthorized access to computer systems, or manipulation of electronic records to transfer funds. Funds transfer fraud coverage, an insuring agreement covering loss of funds from the insured's account resulting from fraudulent transfer instructions to a financial institution, including wire transfers and electronic payments based on deceptive communications. This critical modern coverage addresses business email compromise, CEO fraud, and social engineering schemes that trick employees into authorizing fraudulent transfers. Money orders and counterfeit currency coverage, an insuring agreement covering loss resulting from the insured's acceptance in good faith of counterfeit money orders or counterfeit paper currency in exchange for merchandise, money, or services. This protects businesses from losses when they unknowingly accept sophisticated counterfeits during normal business transactions. Extortion coverage, an insuring agreement covering loss of property when the insured surrenders it under threat of bodily harm, damage to property, or other coercive threats, including ransom payments and related expenses. This coverage has been renamed from kidnap/ransom to reflect broader application beyond kidnapping to include cyber extortion, product tampering threats, and other coercive demands. Partners included excluded endorsement, an endorsement that modifies employee theft coverage to either include or exclude partners, members, and managers from the definition of employee for coverage purposes. This is important because crime policies typically define employees narrowly, and this endorsement clarifies whether business owners and partners are covered under employee dishonesty provisions. Theft, disappearance, or destruction, the broadest form of money and securities coverage that insures against loss from any cause, including theft, mysterious disappearance, when the cause cannot be determined, and accidental destruction. This all-risk approach provides maximum protection, but costs more than coverage limited to specific perils like robbery or burglary. Position Schedule Bond, a fidelity bond that covers specific job positions rather than named individuals, providing coverage for whoever occupies the designated position regardless of personnel changes. This approach simplifies administration when employees change positions or leave, as coverage automatically extends to replacement employees in the scheduled positions. Blanket coverage, employee dishonesty coverage applying to all employees without naming individuals or positions, with a single limit applying to any loss regardless of how many employees are involved. This simplified approach eliminates the need to schedule employees individually and automatically covers new hires, making it ideal for businesses with numerous employees or high turnover. Scheduled coverage, crime coverage that specifically names individual employees or positions with separate limits for each, providing more control over coverage amounts for high-risk positions. This approach costs less than blanket coverage, but requires updating the schedule when employees change, and multiple employees involved in a single loss may provide cumulative limits. Fidelity bond, a type of insurance protecting employers against financial losses caused by fraudulent or dishonest acts of employees, guaranteeing employee honesty and integrity. Fidelity bonds can cover all employees, blanket, specific named employees, name schedule, or designated positions, position schedule, with the insurer paying the employer for employee theft or dishonesty. Commercial blanket bond, a fidelity bond providing a single amount of coverage that applies to losses caused by any employee or combination of employees, without naming individuals or requiring notification of new hires. This provides automatic coverage for all current and future employees up to the blanket limit per occurrence, simplifying administration and ensuring no coverage gaps. Name schedule bond, a fidelity bond listing specific employees by name with individual coverage amounts for each person, requiring the employer to notify the insurer of personnel changes to maintain coverage. This approach allows different coverage amounts for different employees based on their access to assets, but requires ongoing administration to keep the schedule current. Position schedule bond, a fidelity bond covering specific job positions rather than named individuals, with coverage limits assigned to each position regardless of who occupies it. This eliminates the need to update the bond when employees change positions or are replaced, as coverage automatically transfers to whoever fills the scheduled position. Financial institution bond, a specialized comprehensive fidelity bond designed for banks, credit unions, and other financial institutions covering employee dishonesty, robbery, burglary, computer fraud, and other crimes specific to financial services. This all-in-one bond addresses the unique and extensive crime exposures faced by institutions handling large volumes of money and securities. Employee dishonesty bond, another term for a fidelity bond that protects employers against theft, fraud, embezzlement, and other dishonest acts committed by employees. This guarantees employee honesty and reimburses the employer for financial losses resulting from employee misconduct. Janitorial services bond, a specialized fidelity bond covering cleaning companies against liability for theft or damage caused by their employees while working on customer premises. This protects both the janitorial company and provides assurance to customers that they're protected if cleaning personnel steal or damage property. ERISA bond, a fidelity bond required by the Employee Retirement Income Security Act covering plan fiduciaries and persons who handle plan funds against losses due to fraud or dishonesty. ERISA requires bonding of at least 10% of plan assets up to specified maximums to protect retirement plan participants from misappropriation of their retirement funds. Surety, the party, typically an insurance company, that guarantees the principal's performance of an obligation to the obligé, assuming responsibility if the principal fails to fulfill contractual or legal duties. The surety evaluates the principal's ability to perform and expects to be reimbursed by the principal if it must make payments to the obligé. Principal, the party, contractor, business, or individual, whose performance is guaranteed by the surety bond, with primary responsibility to fulfill the obligation to the obligee. The principal applies for the bond, pays the premium, and is expected to reimburse the surety for any losses paid, making suretyship fundamentally different from insurance. Obligee, the party, project owner, government entity, or beneficiary, who requires and benefits from the surety bond, receiving protection if the principal fails to perform. The obligé requires the bond as a condition of contract or law and has the right to make claims against the surety if the principal defaults. Bond penalty, the maximum dollar amount the surety will pay under a surety bond, also called the penal sum or bond amount. Unlike insurance policy limits, the bond penalty represents the maximum obligation rather than expected losses, and the principal remains ultimately responsible to reimburse the surety for payments made. Performance bond, a surety bond guaranteeing that a contractor will complete a construction project according to contract specifications, on time, and in accordance with all terms. If the contractor defaults, the surety must either find a replacement contractor to complete the work or pay the obligé up to the bond penalty amount. Bid bond, a surety bond submitted with a construction bid guaranteeing that if the contractor is awarded the project, They will enter into the contract at the bid price and provide required performance and payment bonds. This protects project owners from contractors who submit unrealistically low bids and then refuse to perform, with the bond paying the difference between the winning and next lowest bid. Payment bond, a surety bond guaranteeing that a contractor will pay all laborers, subcontractors, and material suppliers involved in a construction project. This protects suppliers and workers who might otherwise file mechanics liens against the property if unpaid, ensuring they receive payment even if the contractor defaults. License and permit bonds, surety bonds required by government agencies as a condition of receiving a business license or permit, guaranteeing compliance with applicable laws, regulations, and ordinances. These bonds protect the public and government by ensuring businesses operate according to legal requirements, with examples including contractor licenses, auto dealer bonds, and mortgage broker bonds. Judicial bond, a broad category of surety bonds required by courts in legal proceedings, guaranteeing performance of court-ordered duties or protecting against losses if court actions are wrongful. Judicial bonds include appeal bonds, injunction bonds, and various litigation-related guarantees. Fiduciary bond, a surety bond required for court-appointed fiduciaries such as executors, administrators, guardians, conservators, and trustees, guaranteeing they will faithfully perform their duties in managing others' assets. These bonds protect beneficiaries and estates from mismanagement, theft, or breach of fiduciary duty by court-appointed individuals. Contract bond, a broad category of surety bonds guaranteeing performance of contractual obligations, including performance bonds, payment bonds, bid bonds, and maintenance bonds used primarily in construction. Contract bonds ensure that contractors fulfill their agreements and protect project owners from contractor default. Completion bond, a specialized surety bond used in construction and entertainment industries, guaranteeing that a project will be completed according to specifications and within budget. In film production, completion bonds guarantee that movies will be finished and delivered to distributors, while in construction, they ensure projects reach substantial completion regardless of contractor problems. Manifest intent, a requirement in employee dishonesty coverage that the employee must have acted with the clear purpose and intent to cause the employer financial loss and obtain financial benefit for themselves or another party. This mens rea requirement distinguishes dishonest theft from mere mistakes, negligence, or poor judgment, requiring proof that the employee intentionally sought to steal or defraud the employer. Occurrence. In crime policies, an occurrence is defined as an individual act or series of related acts, with all acts by one employee or multiple employees in collusion counted as a single occurrence subject to one limit. This definition is critical for applying policy limits, as multiple thefts by the same employee over years may be treated as one occurrence or as separate occurrences depending on policy language and whether acts are related. Evidence of loss requirement, a policy condition requiring the insured to provide proof of loss through documentation, records, statements, or other evidence demonstrating that a covered loss occurred and establishing the amount. Crime policies typically require detailed evidence including financial records, inventory documentation, witness statements, and sometimes police reports to substantiate claims. Inventory shortage exclusion, an exclusion eliminating coverage for shortages disclosed through inventory counts or profit and loss computations, unless the insured can prove a specific covered cause of loss. This prevents coverage for unexplained inventory shrinkage that could result from undetectable employee theft, shoplifting, administrative errors, waste, or poor record-keeping rather than a specific insured event. Profit and loss computation exclusion, an exclusion denying coverage for losses discovered solely through comparison of profit and loss records, balance sheets, or financial statement analysis without identifying a specific occurrence. This prevents claims based merely on missing profits or unexplained financial shortfalls where the specific mechanism and timing of loss cannot be determined. Voluntary parting, a coverage limitation or exclusion in some crime forms for situations where the insured voluntarily gives up property due to deception, trick, or false pretense without realizing they're being defrauded. Traditional crime policies excluded voluntary parting, but modern forms like social engineering fraud coverage have been developed to address these increasingly common schemes. Indemnification under crime contract, the principle that crime insurance pays only after the insured has actually suffered a financial loss, not based on potential or anticipated losses. Unlike some other coverages, crime policies require proof of actual monetary damage before indemnification occurs, with valuation at the time of discovery often differing from property insurance approaches. Territory limitations. Many crime policies provide worldwide coverage with no territorial restrictions, protecting against losses occurring anywhere, unlike property and liability policies that typically restrict coverage to specific geographic areas. This recognizes that crime exposures, especially employee dishonesty, computer fraud, and funds transfer fraud, can occur across borders in today's global business environment. Prior loss knowledge exclusion. An exclusion denying coverage for losses caused by employees if the insured knew or had reason to suspect the employee was dishonest before the policy period or retroactive date. This prevents insureds from concealing known theft or dishonesty and then purchasing coverage to recover for losses they knew were occurring. Restitution. Court-ordered repayment by a convicted criminal to the victim for losses caused by the crime, which may reduce the insurer's obligation to pay under a crime policy. When an employee is convicted of theft and ordered to make restitution, any amounts actually recovered reduce the insured's loss, and insurers may coordinate with criminal restitution proceedings to maximize recovery. Subrogation. The insurer's right after paying a claim to pursue recovery from responsible parties, including dishonest employees, third parties who aided the theft, or financial institutions that failed to detect fraud. Crime policies may have specific subrogation provisions requiring the insured to cooperate in prosecuting dishonest employees and attempting recovery, with special rules about waiving subrogation rights that differ from property insurance. Floater, a type of inland marine insurance policy that floats with movable property, providing coverage regardless of location, typically offering all-risk protection for valuable items that move from place to place. Floaters contrast with traditional property insurance that covers property only at fixed locations, making them ideal for jewelry, art, cameras, and other items that travel with the insured. Personal floater, a category of inland marine insurance covering individuals' valuable personal property with broad, all-risk coverage that follows the property worldwide. Personal floaters include coverage for jewelry, furs, cameras, musical instruments, fine arts, and other high-value items that need protection beyond standard homeowners' policy sublimits. Schedule, a listing of individual items with specific descriptions and agreed values attached to a floater policy, establishing the exact property covered and the amount payable for each item in case of loss. Scheduling in floaters requires detailed descriptions, often with appraisals or photos, and agreed values, providing certainty about coverage and eliminating valuation disputes at claim time. Unscheduled property, property covered under a floater policy on a blanket basis without individual item descriptions, subject to a total limit and often per-item sublimits. Unscheduled coverage provides flexibility for collections or groups of similar items without requiring detailed listings, though it typically provides less comprehensive protection than scheduled coverage. Scheduled property, individual items specifically described and valued on a floater policy schedule, each with its own agreed value and detailed description, including make, model, serial numbers, and distinguishing characteristics. Scheduled items receive the full agreed value without depreciation and typically have no deductibles, providing premium coverage for high-value property. Personal property floater, a comprehensive inland marine policy providing all-risk coverage for all types of personal property, except excluded items like autos and animals, either on a scheduled or unscheduled basis, essentially providing worldwide coverage for the insured's belongings. This broad form eliminates many exclusions found in homeowners' policies and covers property anywhere in the world. Personal Articles Floater, PAF, a popular inland marine policy that provides scheduled, all-risk coverage for specific categories of valuable personal property, including jewelry, furs, cameras, musical instruments, silverware, fine arts, and stamps or coins. PAF coverage has no deductible, covers mysterious disappearance, applies worldwide, and pays agreed values established when items are scheduled. Personal Effects Floater, a specialized inland marine policy covering clothing, personal items, and baggage while traveling, providing broader coverage than homeowners' off-premises limitations. This coverage is particularly useful for frequent travelers who carry valuable personal belongings and need protection against loss, theft, or damage away from home. Travel Baggage Floater, inland marine coverage specifically designed for luggage and personal belongings while traveling, protecting against loss, theft, damage, or mysterious disappearance during trips. This provides more comprehensive and higher limits than the limited coverage included in homeowners' policies for property away from premises. Valuable Items Floater, a general term for inland marine policies covering high-value personal property items that need broader protection than homeowners' policies provide, including jewelry, furs, fine arts, and collectibles. These floaters provide all-risk coverage, worldwide protection, and agreed values without deductibles. Jewelry Floater, an inland marine policy or endorsement providing all-risk coverage for jewelry items including rings, watches, necklaces, and other precious items, with each piece scheduled and valued individually. Jewelry floaters cover perils excluded in homeowners' policies like mysterious disappearance and have no deductible, making them essential for engagement rings and valuable jewelry. Fine Arts Floater, specialized inland marine coverage for paintings, sculptures, antiques, rare books, and other artistic or collectible items, providing all-risk protection at agreed values. Fine arts coverage includes protection during transit, exhibition, restoration, and storage, with specialized valuation and claims handling for unique items. Camera Floater, inland marine coverage for cameras, lenses, projectors, films, and photographic equipment, providing all-risk protection for professional and serious amateur photographers. This covers equipment anywhere in the world, including during use, with coverage for both owned and rented equipment. Musical Instrument Floater, inland marine coverage for musical instruments including pianos, violins, guitars, and other instruments owned by musicians, providing all-risk protection worldwide. This covers instruments during performances, practice, transit, and storage, with agreed values established for each scheduled instrument. Stamp and Coin Floater, specialized inland marine coverage for stamp and coin collections, providing all-risk protection at agreed values for numismatic and philatelic items. This covers both scheduled individual rare items and unscheduled collections, with special provisions for market value fluctuations and appreciation. Silverware Floater, inland marine coverage for silver flatware, serving pieces, tea sets, and other silverware items, providing all-risk protection at agreed values. This covers sterling silver and silver-plated items against all perils, including mysterious disappearance, with each piece or set described and valued on the schedule. Golfer's Equipment Floater, specialized inland marine coverage for golf clubs, bags, balls, and related equipment, providing all-risk protection on and off the golf course. This covers equipment against theft, damage, or loss anywhere in the world, including during play, in transit, and in storage, with some policies even covering hole-in-one expenses. Commercial Articles Coverage, a broad category of inland marine insurance covering various types of business property that move from location to location or require specialized coverage beyond standard commercial property forms. This includes equipment, tools, samples, and other business property that doesn't fit neatly into fixed location property coverage. Contractors' Equipment Coverage, inland marine insurance for mobile equipment, machinery, tools, and apparatus owned or leased by contractors, providing all-risk coverage for property used at job sites, in transit, or in storage. This covers bulldozers, backhoes, scaffolding, power tools, and other contractor equipment that moves frequently and faces exposures that standard property policies don't adequately address. Accounts receivable coverage. Inland marine coverage for the inability to collect outstanding customer debts due to loss or damage of accounts receivable records, paying the uncollectible amounts plus collection expenses and interest. This protects businesses from financial loss when fire, theft, or other covered perils destroy billing records, making it impossible to determine what customers owe or to prove and collect debts. Valuable papers and records coverage. Inland marine insurance for the cost to research, replace, or restore important business documents, plans, blueprints, abstracts, books, maps, and films when lost or damaged. Unlike property coverage that pays actual cash value, this covers reproduction costs which can far exceed the physical value of paper, making it essential for businesses with critical records. Signs coverage. Inland marine coverage for outdoor and indoor signs including neon, mechanical, electrical, and painted signs, providing all-risk protection for these specialized advertising fixtures. This covers signs against broader perils than standard property policies and accounts for unique exposures like electrical failures, windstorm damage, and vandalism. Electronic Data Processing (EDP) coverage. Specialized inland marine coverage for computers, peripheral equipment, media, and data processing equipment, providing all-risk protection for hardware, software, and electronic data. EDP coverage addresses unique technology exposures including power surges, mechanical breakdown, media damage, and extra expense to continue operations, which standard property policies exclude or limit. Installation floater. Coverage for machinery, equipment, building materials, and supplies while being transported to a job site during installation and for a specified period after installation is complete. This bridges the coverage gap between the seller's interest during shipment and the buyer's permanent property insurance, protecting during the vulnerable installation period. Builder's risk floater. An inland marine form of builder's risk coverage providing broader protection than standard builder's risk, often used for specialized construction like bridges, tunnels, or installations requiring coverage at multiple locations. This floater approach provides more flexible territory and coverage than fixed-location builders' risk forms. Exhibition floater. Inland marine coverage for property displayed at trade shows, conventions, exhibitions, or fairs, providing all-risk protection while in transit to and from the event and during the exhibition. This covers booth materials, display items, samples, and inventory against theft, damage, or loss during the vulnerable exhibition period. Trade show floater. Another term for exhibition floater, specifically covering property exhibited at trade shows, including displays, demonstration equipment, product samples, and booth fixtures. This provides comprehensive coverage for the unique exposures of exhibiting at conventions where property faces increased theft and damage risks. Pattern and die coverage. Specialized inland marine coverage for patterns, dies, molds, and forms used in manufacturing, covering these expensive production tools against loss or damage anywhere. This is essential for manufacturers whose operations depend on specialized tooling that costs significantly more to replace than its physical material value suggests. Tool floater. Inland marine coverage for tools, machinery, and equipment owned by mechanics, technicians, contractors, or other tradespeople, providing all-risk protection for these essential business assets. This covers tools at job sites, in vehicles, at the shop, or anywhere else, protecting against theft and damage that standard policies exclude. Leasehold interest coverage. Inland marine coverage protecting a tenant's financial interest in favorable lease terms when a covered loss terminates the lease or makes premises unusable, compensating for lost rent savings below market rates. This protects tenants with below-market leases that represent valuable business assets and could be lost due to property damage. Bailee's customer coverage, direct coverage for customers' property while in a bailee's possession, paying for damage or loss regardless of the bailee's legal liability. This provides broader protection than bailee's liability coverage by eliminating the need to prove negligence, improving customer relations, and simplifying claims. Bailee's liability coverage protecting bailees against legal liability for damage to customers' property in their care, custody, or control, responding only when the bailee is legally liable due to negligence. This fills the gap created by care, custody, or control exclusions in general liability policies, but requires proving the bailee was at fault. Bailee's Customer Floater, a comprehensive inland marine policy providing coverage for customers' property in a bailee's possession on a direct basis, without requiring proof of bailee negligence. This offers the broadest protection for bailees like dry cleaners, repair shops, or warehouses by automatically covering customer property regardless of fault. Commercial Property Floaters, a broad classification of inland marine policies covering various types of commercial personal property that moves or requires specialized coverage, including contractor equipment, dealer inventory, signs, and other mobile business property. This umbrella term encompasses numerous specific floater forms designed for different business types and property categories. Dealer's coverage, specialized inland marine coverage for businesses that sell, rent, lease, display, or demonstrate merchandise, covering inventory both on and off premises, including at customer locations and during transit. This provides flexible coverage for dealer stock that constantly changes in value and location, with automatic coverage for newly acquired inventory and property at various locations. Domestic shipments, a category in the nationwide marine definition referring to goods and merchandise being transported within the United States by common carriers, contract carriers, or the owner's own vehicles. This recognizes that property in transit faces unique exposures requiring specialized inland marine coverage rather than fixed location property insurance. Instrumentalities of transportation, a category in the nationwide marine definition encompassing bridges, tunnels, roads, pipelines, power transmission lines, and other fixed structures essential for transporting people, goods, or utilities. These structures are eligible for inland marine coverage because they facilitate the movement of property or energy across distances, even though they're permanently affixed to locations. Instrumentalities of communication, a category in the nationwide marine definition including radio towers, television towers, communication satellites, telephone lines, fiber optic cables, and other equipment used to transmit information or signals. These are covered under inland marine because they facilitate communication across distances, analogous to the historical marine insurance concept of transmitting information across waters. Bridges, fixed structures spanning bodies of water, valleys, or roads that qualify for inland marine coverage under the nationwide marine definition as instrumentalities of transportation. Bridges are insured under inland marine forms rather than standard property policies due to their role in facilitating the movement of vehicles, goods, and people across obstacles. Tunnels, underground or underwater passages that allow transportation through mountains, under rivers, or beneath cities, qualifying for inland marine coverage as instrumentalities of transportation. Tunnels face unique construction and maintenance exposures that specialized inland marine coverage addresses better than standard property forms. Wharves, structures built along shorelines where ships can dock for loading and unloading cargo or passengers, eligible for inland marine coverage under the nationwide marine definition. Wharves are insured as instrumentalities of transportation because they facilitate the transfer of goods between water and land transport. Piers, platform structures extending from shore into water where vessels can dock, covered under inland marine as instrumentalities of transportation due to their role in maritime commerce. Piers serve similar functions to wharves and face unique exposures from weather, water damage, and vessel impacts that inland marine forms address. Docks, water-based structures or facilities where ships moor for loading, unloading, or repairs, covered under inland marine insurance as instrumentalities of transportation. Docks include the physical structures and adjacent areas used in maritime commerce and vessel servicing. Loading, unloading equipment, machinery and apparatus used to load and unload cargo from ships, trucks, trains, or aircraft, including cranes, conveyors, forklifts, and hoists, covered under inland marine as equipment facilitating transportation. This equipment is essential to the transportation process and faces unique exposures requiring specialized coverage. Radio and television towers, transmission towers, and antenna structures used for broadcasting radio and television signals, covered under inland marine insurance as instrumentalities of communication. These towers are eligible for inland marine coverage due to their role in transmitting information across distances, fitting the marine insurance concept of facilitating communication similar to historical ship-to-shore signaling. Motor truck cargo coverage. Inland marine insurance for trucking companies covering their legal liability for damage to customers' goods being transported, protecting against the carrier's liability under bills of lading. This can be written on a legal liability basis, covering only when the carrier is legally liable, or on a broader basis, covering cargo regardless of legal liability. Motor truck carrier liability. The legal responsibility of trucking companies for loss or damage to cargo they transport for others, arising from common law, contract terms, and statutory obligations. Carriers face varying degrees of liability, depending on whether they're common carriers, contract carriers, or private carriers, with motor truck cargo insurance addressing this exposure. Owner's goods on owner's truck coverage, inland marine coverage for a business's own property while being transported in vehicles owned, leased, or operated by the insured, protecting the shipper's interest rather than carrier liability. This covers the business owner's inventory, equipment, or goods in transit on their own trucks, filling gaps left by standard commercial property and auto policies. Trip transit coverage. Single shipment inland marine coverage purchased for one specific transport of goods from origin to destination, providing all risk protection for that individual trip. This is suitable for businesses that occasionally ship valuable goods and don't need continuous annual transit coverage, with premiums based on the value and routing of each shipment. Annual transit coverage. Year-round inland marine coverage, providing continuous protection for all shipments throughout the policy period, automatically covering goods as they're shipped without requiring individual trip declarations. This eliminates the need for trip-by-trip certificates and typically covers shipments by the insured's own vehicles, common carriers, and other transportation methods, with premiums based on estimated annual shipping values. Transportation floater. A broad inland marine policy covering goods in transit by various means of transportation, protecting the shipper's interest in property being moved from one location to another. This provides flexible, all-risk coverage from point of origin to final destination, regardless of transportation method, addressing the shipper's need to protect their property investment during vulnerable transit periods. Shipper's interest coverage, inland marine coverage protecting the owner or seller of goods being transported against loss or damage during shipment, covering the shipper's financial interest in the cargo. This differs from carrier liability coverage by protecting the cargo owner's interest rather than the transporter's legal liability, and covers the full value of goods regardless of carrier's limited liability. Warehouse legal liability. Coverage for a warehouse operator's legal liability for damage to customers' goods stored in their facility, protecting against claims when the warehouse is legally responsible for loss or damage. This fills the care, custody, or control exclusion gap in general liability policies, covering the warehouse's negligent damage to property they're holding for others. Carrier's legal liability. The legal responsibility of transportation companies for loss or damage to cargo entrusted to them for transport, arising from common law duties, contractual obligations, and federal/state regulations. Common carriers typically have strict liability for cargo unless loss results from accepted causes like acts of God. while contract and private carriers may have more limited liability based on agreements. Bill of lading, a document issued by a carrier acknowledging receipt of cargo for shipment, serving as a receipt, a contract of carriage, and potentially a document of title to the goods. The bill of lading establishes the carrier's liability for the cargo and specifies terms of transportation, destinations, and consignees, forming the legal foundation for carrier liability and cargo insurance. Straight bill of lading, a non-negotiable bill of lading consigning goods directly to a specific consignee who must prove identity to receive the cargo, with the document serving as a receipt and contract but not transferable as a document of title. This is the most common form for domestic shipments, where the shipper doesn't need to transfer ownership during transit. Released bill of lading, a bill of lading where the shipper declares a cargo value lower than the actual value in exchange for reduced freight rates, limiting the carrier's liability to the released declared value. This transfers more risk to the shipper, who must secure cargo insurance for the difference between actual and released values, making it essential to coordinate bill of lading values with cargo insurance coverage. Free on board, FOB, a shipping term indicating the point at which ownership and risk of loss transfer from seller to buyer, with FOB origin, meaning the buyer assumes risk once goods leave the seller's location, and FOB destination, meaning the seller retains risk until goods reach the buyer. This designation is critical in determining whose insurance applies during transit and at what point cargo insurance coverage should begin or end for each party. Warehouse-to-warehouse clause, a coverage provision in inland marine transit policies extending protection from the moment goods leave the initial warehouse or place of storage until they're delivered to the final warehouse or destination, including all usual transit and temporary storage. This ensures continuous coverage throughout the entire shipping process, including loading, transportation, intermediate stops, and unloading, eliminating gaps that could occur if coverage were limited only to time in transit. Loading and unloading clause, a provision specifying that coverage includes the processes of loading goods onto and unloading goods from transportation vehicles, extending protection beyond just the transit period itself. This addresses a vulnerable exposure period when goods are being handled and are susceptible to damage from drops, improper handling, or equipment failures during the transfer process. Sue and labor clause, a policy provision requiring the insured to take reasonable steps to protect property from further damage after a loss occurs, and authorizing the insurer to reimburse these protection costs in addition to policy limits. Borrowed from ocean marine terminology, this clause obligates the insured to act as if uninsured and mitigate losses, with the insurer paying reasonable expenses incurred to prevent or minimize damage, recognizing that such efforts benefit both parties. Equipment breakdown coverage, modern term for boiler and machinery insurance covering sudden and accidental breakdown of mechanical, electrical, and pressure equipment, including the equipment itself, resulting property damage, and business interruption losses. This coverage extends beyond traditional boiler explosions to include breakdowns from electrical arcing, mechanical failure, operator error, and centrifugal force that standard property policies exclude. Boiler and machinery coverage, traditional term for insurance covering damage from sudden and accidental breakdown of pressure, mechanical, and electrical equipment, including boilers, pressure vessels, refrigeration systems, and production machinery. While the term has largely been replaced by equipment breakdown, it historically referred to coverage for steam boiler explosions and has expanded to cover modern equipment failures. Pressure vessel, a container designed to hold gases or liquids at pressures substantially different from ambient pressure, including boilers, tanks, heat exchangers, and piping systems that are susceptible to explosion or rupture. These are key insured objects under equipment breakdown coverage due to the catastrophic damage potential from pressure-related failures. Mechanical breakdown, the failure of machinery or equipment due to mechanical causes such as motor burnout, gear failure, bearing seizure, or component malfunction that standard property policies exclude. Equipment breakdown coverage responds to these sudden mechanical failures that occur despite proper maintenance, distinguishing them from gradual wear and tear. Electrical arcing, a sudden electrical discharge or short circuit that damages electrical equipment, wiring, or connected machinery, covered under equipment breakdown policies. Arcing can destroy motors, transformers, switchgear, and electrical systems through intense heat, and is a common cause of equipment failure in commercial and industrial settings. Centrifugal force breakdown, damage caused when rotating equipment like turbines, engines, or flywheels fly apart due to excessive speed, mechanical failure, or material defects. Equipment breakdown coverage responds to these sudden, violent failures where centrifugal forces tear equipment apart, which standard property policies exclude as mechanical breakdown. Explosion. Under equipment breakdown coverage, explosion refers specifically to the sudden and violent rupture of pressure equipment due to internal steam or fluid pressure, distinct from the broader explosion peril in property policies. This definition focuses on pressure vessel failures rather than combustion explosions or other types covered under standard property forms. Covered equipment, machinery, apparatus, and equipment that generates, transmits, or utilizes mechanical or electrical power, subject to breakdown coverage including boilers, pressure vessels, refrigeration systems, air conditioning equipment, electrical systems, and production machinery. Not all equipment on premises qualifies. Items must be specifically described as covered objects and meet definition requirements. Object definition: the specific pieces of equipment scheduled in the policy declarations that are covered against breakdown, identified by type, location, and serial number. Each object must be specifically described and becomes a covered item under the policy, with coverage extending to breakdowns of these scheduled objects. Accident. Under equipment breakdown coverage, an accident is defined as a sudden and accidental breakdown of covered equipment that causes direct physical damage requiring repair or replacement. This differs from liability accident definitions and requires that breakdown be fortuitous, sudden, and not result from gradual deterioration or wear and tear. Spoilage damage. Coverage for loss of perishable goods in refrigerated spaces caused by equipment breakdown, such as food spoiling when refrigeration systems fail. This addresses consequential losses from equipment failures that standard property policies exclude, protecting businesses dependent on temperature control like restaurants, grocers, and cold storage facilities. Utility interruption coverage, coverage for business income losses when off-premises utility service, electricity, gas, water, steam, communications, is interrupted due to equipment breakdown at the utilities facility. This extends protection beyond on-premises equipment failures to include losses when power plants, substations, or utility equipment break down. Business interruption, equipment breakdown, coverage for lost income and continuing expenses when business operations are suspended due to equipment breakdown, providing time element protection similar to standard business income coverage. This addresses the often lengthy repair periods needed for complex equipment failures that can shut down operations for weeks or months. Expediting expenses, coverage for reasonable extra costs to make temporary repairs, expedite permanent repairs, or speed delivery of replacement equipment following a breakdown. This includes overtime labor, express shipping, temporary equipment rentals, and other costs to minimize business interruption, paid in addition to repair or replacement costs. Newly acquired equipment endorsement, an endorsement automatically extending equipment breakdown coverage to equipment acquired during the policy period for a specified time, typically 30 to 90 days, before it must be reported and added to the policy. This ensures continuous protection as businesses purchase new equipment without requiring immediate notification. Testing exclusion, an exclusion eliminating coverage for equipment breakdown that occurs during testing, experimentation, or operation under abnormal conditions not typical for the equipment's normal use. This prevents coverage for failures during commissioning, pressure testing, or experimental operations where breakdown risk is significantly elevated. Ordinance or law, coverage under equipment breakdown policies for increased costs to comply with building codes, safety codes, or regulations when repairing or replacing broken equipment. This addresses requirements to upgrade equipment to current standards when breakdowns necessitate repairs or replacement, covering the cost difference between code-compliant and original equipment. Flood, a general and temporary condition of partial or complete inundation of normally dry land from overflow of inland or tidal waters, unusual and rapid accumulation or runoff of surface waters, mudflow, or collapse of land along a body of water due to erosion or undermining caused by waves or currents. This statutory definition establishes what constitutes flood for NFIP purposes and differs from standard property policy water damage definitions. National Flood Insurance Program, NFIP, a federal program created by the National Flood Insurance Act of 1968 that makes flood insurance available in participating communities, managed by FEMA, and providing up to $250,000 building coverage and $100,000 contents coverage for residential properties. The NFIP establishes flood zones, rates, and building standards while subsidizing coverage in high-risk areas where private insurance is unavailable or unaffordable. Write Your Own WYO program, an arrangement where private insurance companies issue and service NFIP policies under their own names, while the federal government retains the flood risk and sets rates and coverage terms. WIO companies handle policy administration and claims but are reimbursed by NFIP for losses, allowing policyholders to purchase federal flood coverage through private insurers they already do business with. Special Flood Hazard Area, SFHA, High-Risk Flood Zones, Zones A, AE, AH, AO, V, VE, where there is at least a 1% annual chance of flooding, 100-year flood, and where federal flood insurance is mandatory for federally backed mortgages. Properties in single-family homes face the highest flood risk and premiums, and communities must enforce strict floodplain management regulations in these areas. Flood zones, geographic areas designated by FEMA based on flood risk levels, determining insurance requirements, premium rates, and building standards. Zones range from high-risk areas, A and V zones, requiring mandatory insurance for mortgaged properties, to moderate to low-risk areas, B, C, and X zones, where insurance is optional but recommended. Zone A, a special flood hazard area, with a 1% annual chance of flooding, where base flood elevations have not been determined, requiring flood insurance for mortgaged properties. Zone A areas have known flood risk but lack detailed elevation studies, making them subject to standard NFIP rates without elevation-based adjustments. Zone AE, a special flood hazard area with a 1% annual chance of flooding, where base flood elevations have been determined and mapped, allowing for elevation-based premium calculations. Properties in Zone AE must have flood insurance if mortgaged, with rates varying based on how high the structure is built relative to the base flood elevation. Zone V, coastal high-hazard, special flood hazard areas, subject to high-velocity wave action and storm surge from hurricanes or coastal storms, where base flood elevations have not been determined. Zone 5 properties face the highest flood risk and require flood insurance for mortgaged properties, with strictest building standards requiring elevated structures on pilings or columns. Zone VE, coastal high-hazard areas with a 1% annual chance of flooding and additional hazards from storm-induced waves, where base flood elevations have been determined. Zone 5E has the highest NFIP premiums due to severe wave and erosion risks, and requires structures to be elevated above base flood elevation on breakaway walls or open foundations. Zone X, areas of moderate to low flood risk outside the 100-year floodplain, including areas protected by levees, where flood insurance is not required but is available and recommended. Zone X includes both 500-year floodplains, 0.2% annual chance, and areas with minimal flood risk, with significantly lower premiums than high-risk zones. Base flood, a flood having a 1% chance of being equaled or exceeded in any given year, also called the 100-year flood, used as the standard for NFIP mapping and insurance requirements. Despite the name, a base flood can occur in any year and represents the regulatory standard for floodplain management and mandatory insurance requirements. Base flood elevation, BFE, the computed elevation to which floodwater is anticipated to rise during a base flood, shown on flood insurance rate maps, and used to determine insurance premiums and building requirements. Structures built at or above BFE receive lower insurance rates, while those below face higher premiums reflecting increased risk. 100-year flood, a flood event with a 1% probability of occurrence in any given year, the statistical basis for special flood hazard areas and mandatory insurance requirements. Despite the name, this doesn't mean flooding occurs once every 100 years. There's a 1% chance every single year, and a property in a 100-year floodplain has about a 26% chance of flooding during a 30-year mortgage. 500-year flood, a flood event with a 0.2% probability of occurrence in any given year, representing moderate flood risk where insurance is optional. Properties in 500-year floodplains, some Zone X areas, aren't required to have flood insurance, but may still qualify for lower-cost preferred risk policies. Regular program, the standard NFIP coverage level available to communities that have completed detailed flood studies and adopted comprehensive floodplain management regulations, providing full coverage limits, $250,000, building $100,000 contents for residential. Regular program communities have higher limits and more coverage options than those in the emergency program. Emergency program, limited NFIP coverage, available to communities that have just joined the program but haven't completed detailed flood studies yet, providing reduced limits, typically $35,000, building $10,000 contents for residential. Communities remain in emergency program status until FEMA completes flood insurance rate maps and they adopt full floodplain management regulations. Pre-firm building, a structure built before the effective date of the community's first flood insurance rate map. Firm, typically qualifying for subsidized NFIP rates that don't reflect true flood risk. Pre-firm buildings often lack elevation certificates and may be below current base flood elevation standards, facing eventual rate increases as subsidies are phased out. Post-firm building, a structure built after the effective date of the community's first firm, required to meet NFIP building standards, including elevation requirements. Post-firm buildings pay full-risk actuarial rates based on their elevation relative to BFE, with compliant structures receiving significantly lower premiums. Federal Insurance Administrator, the FEMA official responsible for administering the NFIP, with authority to set rates, define coverage, establish building standards, and make final claim determinations. This position represents the federal government's role as ultimate insurer and regulator of the flood insurance program. Elevation Certificate, a FEMA form completed by licensed surveyors documenting a building's elevation relative to base flood elevation, required for rating post-firm structures and obtaining accurate NFIP premiums. Elevation certificates are essential for proper rating and may be required at closing, policy application, or when requesting lower rates for elevated structures. Loss avoidance measures, activities that prevent or reduce flood losses during an imminent flood, such as sandbagging, relocating contents, or temporary flood barriers, which NFIP encourages but doesn't typically reimburse. Unlike sue and labor clauses in marine policies, NFIP doesn't pay for preventive measures, focusing on post-loss indemnification only. Increased cost of compliance, ICC, additional NFIP coverage up to $30,000 for costs to bring substantially damaged or improved structures into compliance with local floodplain management ordinances, including elevation, relocation, demolition, or floodproofing. ICC helps property owners afford required upgrades after major flood losses trigger substantial damage improvement rules. Waiting period, a 30-day period between policy purchase and effective date during which no coverage applies, designed to prevent people from buying insurance only when flooding is imminent. Exceptions include newly mapped high-risk areas, 30 days from map effective date, purchases required for mortgage closing, no waiting period, and policy renewals, no waiting period if continuous coverage. Preferred Risk Policy, PRP, a lower-cost NFIP policy available to properties in moderate to low-risk areas, Zones B, C, X, and some higher-risk zones if the property has no flood loss history. PRPs offer reduced premiums to encourage insurance purchase in areas where coverage isn't mandatory, with combined building and contents coverage at discounted rates. Dwelling Form, the standard NFIP policy for residential properties, including single-family homes, condominiums, unit owner coverage, and residential units in non-residential buildings, providing up to $250,000 building coverage and $100,000 contents coverage. This form covers the building structure, foundation elements, and essential equipment, with separate contents coverage available. General Property Form, the NFIP policy for non-residential properties, including commercial buildings, churches, and residential buildings with 5 or more units, providing up to $500,000 building coverage and $500,000 contents coverage. This form addresses commercial property needs with higher limits and different coverage terms than the residential dwelling form. Residential Condominium Building Association Policy, RCBAP, an NFIP policy purchased by condominium associations to cover the building structure and common elements in residential condominiums, providing up to $250,000 times the number of units. This master policy covers what the association is responsible for under governing documents, while individual unit owners purchase separate coverage for their contents and improvements. Earthquake Insurance, specialized coverage for damage caused by earthquakes, earth movement, volcanic eruption, and related shock waves, which are excluded from standard property policies. This coverage is typically purchased as a separate policy or endorsement with high percentage-based deductibles, 10 to 25% of coverage amount, and covers both direct property damage and resulting business interruption or additional living expenses. Earthquake Deductible, a deductible calculated as a percentage of the property's insured value, typically 10 to 25%, rather than a flat dollar amount, making the insured responsible for substantial initial loss costs. For example, a $500,000 home with a 15% earthquake deductible requires the owner to pay the first $75,000 of loss, making earthquake coverage most valuable for catastrophic rather than minor losses. Earthquake Occurrence Period, a provision treating all earthquake shocks occurring within a specified period, commonly 72 or 168 hours, as a single occurrence subject to one deductible. This prevents multiple deductibles from applying when earthquakes and aftershocks occur in quick succession, recognizing that seismic events typically involve multiple tremors that should be treated as one event. Volcanic eruption, coverage included in earthquake policies for damage caused by volcanic explosion, lava flow, ash fall, pyroclastic flows, and other volcanic activity, recognized as earth movement related to seismic activity. While standard property policies may cover some volcanic perils, earthquake forms provide comprehensive coverage for all aspects of volcanic events. Earth movement, all forms of earth shaking, sinking, rising, or shifting, including earthquakes, tremors, aftershocks, volcanic activity, landslides, mudflows, and subsidence when caused by seismic events. Earthquake policies define earth movement broadly to encompass all related ground disturbances that standard policies exclude. Shock waves, seismic waves radiating from an earthquake's epicenter that cause ground shaking and structural damage, explicitly covered under earthquake policies. These waves include primary waves, P waves, secondary waves, S waves, and surface waves that cause the physical damage to buildings and infrastructure during earthquakes. Aftershock coverage rules, provisions in earthquake policies governing how subsequent seismic events following a major earthquake are treated, typically including all aftershocks within the occurrence period, 72 to 168 hours, as one event. This ensures that the multiple tremors following major earthquakes don't each trigger separate deductibles, recognizing the continuous nature of seismic activity. Earthquake endorsement. An endorsement added to homeowners or commercial property policies that adds earthquake coverage to the base policy, extending all coverages, dwelling, personal property, loss of use, liability, to include earthquake perils. This endorsement modifies the standard earth movement exclusion while maintaining the policy structure, adding earthquake protection with a percentage-based deductible. Mini policy, a streamlined earthquake insurance policy with limited coverage options and standardized terms, notably used by the California Earthquake Authority, CEA, offering only basic building coverage with optional contents and loss-of-use coverage available for additional premium. Many policies provide affordable catastrophic coverage by limiting benefits, excluding masonry repair coverage, and using high-percentage deductibles, making them suitable for basic protection in high-risk areas. Aviation insurance, specialized coverage for aircraft owners, operators, and aviation businesses addressing unique exposures, including aircraft physical damage, hull, liability for ground and flight operations, passenger injuries, and hangar operations. Aviation insurance requires specialized underwriting, considering pilot qualifications, aircraft type, usage, and operational areas due to high-value assets and catastrophic loss potential. Aircraft hull coverage, physical damage coverage for the aircraft itself, similar to comprehensive and collision coverage for autos, protecting against damage from crashes, weather, fire, theft, and other perils. Hull coverage can be written on an all-risk or specified perils basis with agreed value settlement, covering the aircraft structure, engines, avionics, and installed equipment. Ground-only coverage, the most restrictive hull coverage providing protection only when the aircraft is on the ground and not in motion, excluding damage during taxi, takeoff, flight, or landing. This limited coverage is suitable for aircraft under long-term storage or grounded for extended periods, offering lower premiums by eliminating in-motion and flight exposures. Ground and taxi coverage, hull coverage protecting the aircraft while on the ground and during taxiing operations, but excluding coverage while in flight, on takeoff roll, or landing. This intermediate coverage level is suitable for aircraft owners during training periods when pilots are building hours or when flight coverage is cost-prohibitive. In-flight coverage, comprehensive hull coverage providing protection during all phases of operation, including ground operations, taxiing, takeoff, flight, and landing, offering complete physical damage protection. This broadest coverage is standard for operational aircraft and necessary for aircraft regularly used for their intended purpose. Aviation liability, coverage for legal liability when aircraft operations cause bodily injury or property damage to third parties on the ground or in other aircraft, including passengers when not specifically excluded. Aviation liability policies are typically written with single-limit coverage, combining bodily injury and property damage, with extremely high limits available due to catastrophic loss potential. Passenger liability, coverage specifically for bodily injury to passengers aboard the insured aircraft, which may be excluded from basic aviation liability and purchased separately. Passenger liability recognizes that passengers assume some risk by boarding aircraft and may be subject to different coverage terms, limits, and exclusions than ground victim liability. Bodily injury to passengers, liability coverage for injuries to fare-paying or non-fare-paying passengers aboard the insured aircraft during flight operations, typically written with per-passenger and per-occurrence limits. This coverage addresses the aviation industry's unique exposure, where multiple passenger injuries from a single accident can create enormous liability. Bodily injury to non-passengers, liability coverage for injuries to people on the ground or in other aircraft who are not passengers on the insured aircraft, typically providing broader coverage than passenger liability. This covers third-party victims who didn't assume risk by boarding the aircraft, such as ground victims or occupants of other aircraft involved in collisions. Airport liability, coverage for airport owners and operators protecting against liability from airport operations, including liability for aircraft damage or injuries occurring on airport property, runway conditions, fueling operations, and ground support services. This specialized coverage addresses unique airport exposures beyond standard premises liability, including damage to visiting aircraft and aviation-specific operations. Hangar keepers liability, coverage for airport operators, fixed base operators (FBOS), and maintenance facilities for legal liability for damage to customers' aircraft in their care, custody, or control. This fills the care, custody, or control exclusion gap in general liability policies, protecting hangar operators when aircraft are damaged during storage, maintenance, or servicing. Pilot warranty, a policy condition requiring that only pilots meeting specified qualifications, licenses, ratings, flight hours, recent experience, may operate the insured aircraft, with coverage suspended if unqualified pilots fly. Pilot warranties are strictly enforced in aviation insurance, and violation can void coverage even if the unqualified pilot wasn't responsible for the accident. Pilot in command requirement, a specification that the pilot flying the aircraft must hold appropriate certifications and ratings for the aircraft type and operation being conducted, meeting minimum flight hour and recent experience requirements. This requirement protects insurers from increased risk when inexperienced or unrated pilots operate complex aircraft. Airworthiness certificate. An FAA-issued certificate confirming that an aircraft meets safety standards and is properly maintained and safe to fly, required for coverage under aviation insurance policies. Loss of airworthiness due to improper maintenance, modifications, or regulatory violations can suspend coverage until the certificate is restored. Aviation medical liability, liability coverage for injuries or deaths resulting from in-flight medical emergencies, inadequate emergency medical equipment, or crew errors in providing first aid or medical assistance. This specialized coverage addresses airlines' exposure when passengers suffer medical emergencies during flight and crew members provide assistance. Drone/UAV coverage, specialized insurance for unmanned aerial vehicles, drones, covering hull damage, liability for ground damage or injuries, invasion of privacy claims, and commercial operations. Drone coverage has emerged as drones became common for commercial photography, inspections, deliveries, and agriculture, with different requirements for recreational versus commercial operations. Smooth limits, a single limit of liability applying to all aviation claims from one occurrence, regardless of the number of passengers, ground victims, or property damaged, rather than separate per person and per occurrence limits. Smooth limits simplify coverage by providing one total amount available for all claims arising from an aviation accident. Make and model rating factor, an underwriting consideration in aviation insurance based on the specific aircraft type's accident history, complexity, performance characteristics, and repair costs. Different makes and models have dramatically different loss experiences. A complex high-performance aircraft costs more to insure than a simple trainer, even with identical pilots. Farm insurance, specialized property and liability coverage designed for agricultural operations combining residential coverage for the farmhouse with coverage for barns, equipment, livestock, crops, and farm liability exposures. Farm policies recognize the unique combination of personal residence, commercial operations, and specialized agricultural property and liability exposures that standard homeowners and commercial policies don't adequately address. Farm Owners Policy, a package policy providing comprehensive coverage for farm dwellings, structures, personal property, farm property, equipment, livestock, and liability in a single integrated form. This combines personal lines coverages, similar to homeowners, with commercial farm coverages in one policy, simplifying insurance for owner-operated farms. Coverage A, dwelling, coverage for the farmer's residence and attached structures on the farm premises, similar to homeowners' coverage A, but adapted for rural settings and farm operations. This recognizes that farm dwellings may have business uses, be more isolated, face unique exposures like agricultural chemical storage, and may have higher reconstruction costs due to remote locations. Coverage B, other private structures, coverage for non-farm structures used for personal rather than agricultural purposes, such as detached garages for personal vehicles, tool sheds for home maintenance equipment, or guest houses. This distinguishes personal use structures from farm buildings used in agricultural operations, which are covered separately. Coverage C, household personal property. Coverage for personal belongings in the farm dwelling used for household purposes rather than farm operations, similar to homeowners' contents coverage. This distinguishes family possessions from farm property, business equipment, and inventory, which receive separate coverage. Coverage D, loss of use. Coverage for additional living expenses when the farm dwelling becomes uninhabitable due to a covered loss, paying for temporary housing and increased living costs. This mirrors homeowners' loss of use coverage, but may have different limits reflecting rural rental costs and longer reconstruction periods for remote properties. Coverage E, scheduled farm personal property. Coverage for specifically listed farm property with individual item descriptions and values, including expensive equipment, breeding livestock, or specialized machinery requiring agreed value protection. Scheduling provides broader coverage and agreed value settlement for high-value farm property that needs protection beyond blanket limits. Coverage F, unscheduled farm personal property. Blanket coverage for farm property not specifically scheduled, including general farm equipment, tools, supplies, and livestock under specified per item or per category limits. This provides automatic coverage for numerous farm items without requiring individual listings, though with more limited valuation than scheduled property. Coverage G, other farm structures, coverage for agricultural buildings and structures including barns, silos, grain bins, machinery sheds, fencing, and other farm improvements used in farming operations. This coverage addresses the unique structures essential to agricultural operations that aren't covered as dwellings or private structures. Farm liability coverage. Coverage for legal liability arising from farm operations, premises, products, and activities including injuries to farm visitors, employees, custom farming operations, and products sold. Farm liability recognizes unique exposures like agricultural chemical use, livestock, farm machinery, and roadside sales that standard homeowners' liability doesn't adequately cover. Farm operations, the agricultural activities conducted on the farm, including planting, harvesting, livestock raising, equipment operation, product sales, and custom work for others, creating liability and property exposures requiring specialized coverage. Farm operations range from small hobby farms to large commercial agricultural businesses with vastly different insurance needs. Farm machinery, equipment used in agricultural operations including tractors, combines, harvesters, planters, irrigation systems, and other motorized or mechanical apparatus essential to farming. Farm machinery represents substantial investment requiring specialized coverage that addresses mobile use, seasonal exposure variations, and valuation challenges. Farm mobile equipment, self-propelled agricultural equipment that typically isn't licensed for highway use, but moves around the farm and between fields, including tractors, combines, and specialized implements. This equipment falls into a gray area between auto and property coverage, often requiring specific farm policy provisions or inland marine coverage. Livestock coverage. Coverage for farm animals including cattle, horses, pigs, sheep, and other animals raised for commercial purposes or breeding, typically written on a blanket or scheduled basis, depending on value. Livestock coverage addresses perils including disease, predators, accident, fire, and adverse weather, with breeding stock often requiring scheduled coverage at higher values. Poultry coverage, specialized coverage for chickens, turkeys, ducks, and other domestic fowl raised commercially for eggs or meat, typically written on a blanket per head value basis. Poultry operations face unique exposures, including disease outbreaks, ventilation system failures, and catastrophic losses when large numbers of birds are housed together. Farm products, harvested crops, eggs, milk, and other agricultural commodities produced on the farm but not yet sold, requiring coverage during storage and until transferred to buyers. Farm products coverage bridges the gap between growing crop coverage and standard business personal property coverage, addressing unique valuation and loss issues for agricultural commodities. Farm pollutants, agricultural chemicals, pesticides, herbicides, fertilizers, fuels, and animal wastes that can cause environmental contamination, typically subject to limited or excluded coverage under farm policies. Modern farm operations use substantial quantities of potentially hazardous materials, requiring specialized pollution liability coverage beyond standard farm policy limits. Custom farming, operations where the farmer performs agricultural services on others' land or with others' crops using the farmer's equipment and expertise, such as harvesting, plowing, or spraying for neighboring farms. Custom farming creates additional liability exposure, requiring specific coverage, as it involves operating on others' property and affecting others' crops. Employers' liability, coverage for liability to farm employees not covered by workers' compensation, including third-party overactions and liability for injuries to family members or casual laborers who may not be subject to workers' compensation. Many states exempt small farms from mandatory workers' compensation, making employers' liability coverage essential for employee injury protection. Farm inland marine floaters, specialized coverage for movable farm property requiring broader protection than standard farm policy provides, including portable equipment used off-premises, property at markets or shows, and high-value items needing scheduled coverage. These floaters address farm property that moves to customer locations, county fairs, livestock shows, or between owned and leased land parcels. Barns, silos, granaries, specific types of agricultural structures covered under farm policies, each with unique construction, use, and exposure characteristics affecting coverage and valuation. These essential farm buildings house livestock, store feed and grain, and protect equipment, often representing substantial value requiring adequate insurance limits. Pasture, fencing, corrals coverage, coverage for perimeter fencing, cross-fencing, gates, cattle guards, and livestock containment structures essential to farm operations, typically subject to sublimits and limited covered perils. Fencing represents substantial investment on large farms, but faces unique valuation challenges and is often limited to specified perils like fire or vehicle damage rather than all-risk coverage. Peak season coverage, automatic or endorsement-based increase in coverage limits during harvest season when grain storage bins are full, livestock inventory is highest, or harvested crops are stored awaiting sale. This addresses seasonal fluctuations in farm property values without maintaining year-round coverage at peak levels, reducing premium costs while ensuring adequate protection during critical periods. Crop insurance, specialized coverage protecting farmers against financial losses from reduced crop yields or revenue due to natural disasters, weather, pests, or price fluctuations. Crop insurance is heavily subsidized by the federal government and administered through the USDA's Risk Management Agency, providing essential income protection for agricultural operations vulnerable to factors beyond farmer control. Multi-peril crop insurance, MPCI, the most common federally subsidized crop insurance providing yield or revenue protection against multiple natural perils including drought, excess moisture, hail, wind, frost, disease, and insect damage. MPCI is the foundation of the federal crop insurance program, offering comprehensive protection that makes farming economically viable despite weather unpredictability. Actual production history, APH, a farmer's proven crop yield history over the past 4 to 10 years, used to establish the expected yield and insurance guarantee under MPCI policies. APH determines coverage levels by averaging historical yields, with adjustments for new producers or those without complete yield records, establishing the baseline against which actual production is measured. Acreage report, a required filing documenting planted acres by crop type, variety, planting dates, and intended use, submitted to the crop insurance provider and farm service agency to establish coverage. Accurate acreage reporting is essential for determining premiums and establishing insured production guarantees, with late or inaccurate reports potentially reducing or voiding coverage. Planted acreage, the number of acres actually seeded or transplanted with an insured crop, reported to establish coverage and used to calculate premiums and potential indemnity payments. Planted acreage must meet specific definitions, including proper planting practices, timely planting, and approved varieties to qualify for full coverage. Prevented planting, coverage that provides indemnity payments when insured, farmers are prevented from planting crops by an insured peril, typically excess moisture or flooding, during the planting period. Prevented planting coverage compensates for lost planting opportunity and may pay 50 to 60% of the full production guarantee, helping farmers recover some income when they cannot even plant. Yield guarantee, the amount of production per acre that crop insurance guarantees, calculated by multiplying the farmer's APH by the selected coverage level, 50 to 85%. If actual production falls below the yield guarantee due to insured causes, the policy pays an indemnity for the difference. Revenue protection, a crop insurance option that protects against loss of revenue due to declining prices, reduced yields, or both, using futures prices to establish both the guarantee and final value. Revenue protection has become the most popular coverage choice as it addresses both production and price risks that farmers face. Price election, the price per unit used to calculate crop insurance guarantees and indemnities, typically based on projected commodity futures prices established before planting. Price elections determine the dollar value of yield guarantees and ultimately the amount of protection purchased, with higher price elections resulting in higher premiums and potential indemnities. Catastrophic coverage, KT, minimal federally subsidized crop insurance available for a nominal administrative fee, providing coverage at 50% of yield guarantee and 55% of price election, essentially covering only catastrophic losses. CAT coverage pays only when losses exceed 50% of expected production and pays only 55% of value for production shortfalls, serving as a minimal safety net for farmers unable to afford higher coverage. Crop hail insurance, specialized single peril coverage for hail damage to growing crops, written by private insurers without federal involvement, providing protection against a specific frequent risk not always well covered by MPCI. Crop hail policies can supplement MPCI coverage and typically pay on an acreage damage basis regardless of whether the loss affects total farm yield. Farm Service Agency, FSA integration. The coordination between USDA's Farm Service Agency and crop insurance programs, with FSA maintaining acreage records, administering disaster programs, and providing support services that complement crop insurance. FSA offices serve as reporting points for acreage and assist farmers in navigating federal farm programs, including crop insurance. Replant coverage, additional crop insurance coverage, paying for the cost to replant crops when initial plantings fail due to insured perils before reaching certain growth stages. Replant coverage helps farmers afford seed, labor, and expenses to replant when weather or other covered perils destroy initial plantings, essential for maintaining production potential. Late planting period, a window after the final planting date during which farmers can still plant and maintain reduced crop insurance coverage, with coverage decreasing for each day beyond the final date. Late planting provisions allow flexibility when weather delays planting while adjusting coverage to reflect reduced yield potential from delayed planting. Policy jacket, the outer wrapper or binder of an insurance policy containing the general provisions, conditions, and forms that apply to all insureds using that policy type, with the declarations page and specific coverage forms inserted inside. The jacket provides the standardized framework and common policy language while allowing customization through the declarations and endorsements. Policy provisions, detailed clauses and stipulations within an insurance policy that establish specific rules, requirements, rights, and obligations beyond the basic structure of declarations, ensuring agreements, conditions, and exclusions. These include specialized clauses addressing unique situations, state-specific requirements, or particular coverage modifications. Mandatory endorsements. Endorsements that must be attached to a policy by law, regulation, or insurer underwriting rules to comply with state requirements or to modify coverage for specific situations. Examples include state-specific amendatory endorsements, terrorism disclosure notices, or required modifications for certain occupancy types. Optional endorsements. Endorsements available for purchase to add, broaden, or modify coverage based on the insured's needs, offered at additional premium. These allow policyholders to customize coverage by adding protection for specific exposures like earthquake, equipment breakdown, or higher limits for scheduled property. Supplemental declarations, additional declaration pages added to a policy providing details about specific locations, vehicles, coverages, or other insured interests beyond what fits on the primary declarations page. Supplemental declarations are common in complex commercial policies with multiple locations or large fleets requiring extensive listings. Master policy? A single insurance policy covering multiple certificate holders, locations, or subsidiary entities under one contract, commonly used for group insurance, franchises, or parent companies with multiple subsidiaries. The master policy provides centralized administration and potentially better rates, while individual certificates evidence coverage for each covered entity. Certificate of coverage, a document issued to individuals covered under a master policy showing their specific coverage details, rights, and obligations as certificate holders rather than named insureds. This differs from certificates of insurance, which merely evidence that coverage exists, as certificates of coverage actually convey coverage rights to the certificate holder. Policy schedule, a detailed listing within a policy showing all covered locations, buildings, equipment, or other insured interests with their respective values, limits, and applicable coverages. This differs from personal articles scheduling by applying to commercial policies with multiple insured interests, requiring organized presentation of coverage details. Policy manuscript, a non-standard insurance policy form specifically drafted for an individual insured's unique needs, rather than using standardized forms, typically for large or unusual risks requiring tailored coverage. Manuscript policies are negotiated between insurer and insured, allowing flexibility, but requiring careful review as they lack the legal precedent of standardized forms. Large manuscript form, a comprehensive, custom-drafted insurance policy for major corporate insureds with complex operations requiring coverage that standard forms cannot adequately address. These policies often run hundreds of pages and are individually negotiated, providing bespoke insurance solutions for multinational corporations or unusual risk profiles. Standardized ISO forms, pre-drafted insurance policy forms developed by ISO and adopted by many insurers, providing uniform coverage language with established legal interpretations. ISO forms bring consistency to the insurance market, reduce drafting costs, and provide precedent from court decisions interpreting standard language, making coverage more predictable. Proprietary forms, insurance policy forms developed by individual insurers for their own use, rather than adopted from ISO or other advisory organizations, allowing insurers to differentiate their products and customize coverage. Proprietary forms may provide broader or more restrictive coverage than standard forms, but lack the extensive legal precedent that standardized forms have established. Policy numbering, the alphanumeric codes on policy forms identifying the specific form version and edition date, such as CG 000010413, indicating the form type and April 2013 edition. Policy numbering allows tracking of which form version applies, which is critical when coverage changes occur between editions or when determining which court interpretations apply. Output policy, a comprehensive commercial policy that combines multiple coverage types, property, liability, crime, inland marine, into a single integrated contract with coordinated terms and conditions. Output policies streamline administration, eliminate gaps and overlaps between coverages, and often provide broader coverage than separate policies by reducing the potential for coverage disputes between different policies. Contract of indemnification. The fundamental principle that insurance contracts are designed to restore the insured to their approximate financial position before a loss, without allowing profit or gain from the insurance. This doctrine underlies property and liability insurance, though not life insurance, and prevents insurance from being used as a wagering contract or source of enrichment. Binder, a temporary, legally binding insurance contract that provides immediate coverage until the formal policy is issued, created through oral or written agreement between agent and applicant. Binders typically contain the basic terms of coverage, limits, deductibles, premium, and remain in effect for a specified period, 30 to 90 days, or until the permanent policy is issued or coverage is declined. Void contract, a contract that has no legal force or effect from its inception because it lacks an essential element like legal purpose, competent parties, or genuine agreement, making it unenforceable by either party. In insurance, policies obtained through fraud or ensuring illegal activities are void ab initio, as if they never existed. Voidable contract, a contract that is valid and enforceable, but can be voided at the option of one party due to circumstances like misrepresentation, undue influence, or lack of capacity at formation. In insurance, a policy might be voidable by the insurer if the insured made material misrepresentations on the application, though the insurer must act promptly upon discovering the grounds for voiding. Valid contract, a contract that meets all legal requirements including competent parties, legal purpose, offer and acceptance, and consideration, making it legally binding and enforceable by both parties. A valid insurance contract creates mutual obligations, with the insurer bound to pay covered claims and the insured bound to pay premiums and comply with conditions. Enforceable contract, a valid contract that can be upheld in court, with legal remedies available if either party breaches their obligations. While a contract may be valid, certain defenses or procedural requirements might temporarily or permanently prevent enforcement. Executed contract. A contract where all parties have fully performed their obligations and nothing remains to be done, such as when an insurer has paid a total loss claim and the policy has expired. In insurance, most contracts remain executory until losses occur and are settled, at which point that particular claim becomes executed. Executory contract, a contract where one or both parties have obligations yet to be performed in the future, which describes most insurance policies where the insurer's duty to pay claims depends on future loss events. Insurance contracts remain executory throughout the policy period as the insurer's primary obligation, paying covered claims, remains contingent on future occurrences. Parole evidence rule, a legal principle that when parties put their agreement in writing and intend it to be the complete expression of their agreement, prior oral or written negotiations cannot be used to contradict or vary the written contract terms. In insurance, this means that marketing materials, agent statements, or application discussions typically cannot override clear policy language, though exceptions exist for fraud, mistake, or ambiguity. Ambiguity, uncertainty, or lack of clarity in policy language that can reasonably be interpreted in two or more ways, triggering the doctrine of contra proferentem. Courts find ambiguity when policy terms are susceptible to multiple reasonable interpretations from the perspective of an ordinary policyholder, not an insurance professional. Reasonable person standard, the objective test for determining how policy language should be understood, asking how an ordinary person of average intelligence would reasonably interpret the terms. Courts apply this standard rather than using technical insurance industry meanings, protecting consumers from hidden or unexpected limitations in coverage. Doctrine of contra proferentem. The legal rule that ambiguous policy language must be construed strictly against the drafter, the insurer, and liberally in favor of coverage for the insured. This doctrine reflects the adhesion nature of insurance contracts, where the insurer controls policy language and the insured cannot negotiate terms, placing the burden of clear drafting on the insurer. Utmost good faith doctrine. The legal principle requiring both insurer and insured to act with complete honesty, fairness, and disclosure of all material facts when forming and performing the insurance contract. This elevated standard goes beyond ordinary contract requirements because of the unique relationship where the insured possesses knowledge about the risk that the insurer needs to properly evaluate and price coverage. Legal capacity, the legal qualification or ability to enter into a binding contract, requiring that parties be of legal age, sound mind, and not under legal disability or undue influence. Persons lacking legal capacity, minors, mentally incompetent individuals, intoxicated persons, can void contracts they enter, though they may be liable for necessities like insurance required by law. Subrogation clause, the policy provision establishing the insurer's contractual right to step into the insured's shoes and pursue recovery from responsible third parties after paying a claim. This clause creates the legal framework for subrogation as a contract term rather than just a common law principle, specifying procedures, requiring insured cooperation, and protecting the insurer's recovery rights. Severability of interests clause, a policy provision stating that insurance applies separately to each insured, with the knowledge, acts, or omissions of one insured not imputed to others when determining coverage. This ensures that innocent insureds maintain coverage even when another insured commits fraud or violates policy conditions, though all insureds still share the same policy limits. Fraudulent Acts Clause, a policy provision, primarily in fidelity and crime policies, requiring proof that dishonest employees acted with manifest intent to cause loss to the employer and obtain financial benefit, distinguishing criminal acts from negligence or mistakes. This clause establishes the level of proof required to trigger employee dishonesty coverage. Liberal construction, a judicial approach to interpreting insurance policies that favors broad coverage and resolves doubts in favor of the insured, particularly for exclusions which are strictly construed. Courts apply liberal construction, recognizing that insurance policies are adhesion contracts, where the insurer controls language and coverage should be interpreted consistently with reasonable expectations. Four Corners Rule, the principle that courts should determine contract meaning by examining only the written policy itself, without considering extrinsic evidence if the language is clear and unambiguous. This rule requires courts to find meaning within the four corners of the document, though exceptions exist for ambiguity, fraud, or when context is necessary to understand terms. Entire contract clause, a policy provision stating that the policy, application, and any attached endorsements constitute the complete agreement between parties, with no other agreements or representations binding unless endorsed on the policy. This protects both parties by establishing that the written policy is the sole evidence of the contract terms, preventing disputes over alleged oral promises or side agreements. Conformity with state statutes clause, a provision stating that policy terms automatically conform to minimum statutory requirements of the state where the policy is issued, even if policy language conflicts with state law. This ensures compliance with mandatory state insurance laws without requiring separate endorsements for each jurisdiction, automatically adjusting coverage to meet or exceed minimum legal requirements. Anti-concurrent causation clause, a provision stating that when a covered cause of loss occurs concurrently or in sequence with an excluded cause, the exclusion applies and no coverage exists, even if the covered peril contributed to the loss. This eliminates the common law concurrent causation doctrine that favored coverage when both covered and excluded perils contributed to loss. Other insurance clause, a provision addressing how coverage applies when multiple policies cover the same loss, preventing the insured from collecting more than the actual loss through duplicate insurance. The clause typically provides for pro rata contribution among insurers, excess coverage, one policy pays first, or escape, one policy doesn't apply if other valid insurance exists. Pro rata liability, a method where multiple insurers covering the same loss share the payment proportionally based on each policy's limit relative to the total of all applicable limits. For example, if two policies with limits of $100,000 and $300,000 both cover a $120,000 loss, they would pay in a 1-to-3 ratio, $30,000 and $90,000. Primary insurance, insurance that pays first when a loss occurs, up to its policy limits, before any other applicable coverage responds. Primary insurance has first dollar responsibility after deductibles and cannot refuse payment based on other insurance being available. Excess insurance, insurance that applies only after underlying or primary insurance is exhausted, providing additional layers of coverage above base policies. Excess insurance responds only when primary limits are fully paid, though some policies provide drop-down coverage for exposures not covered by underlying insurance. Escape clause, and other insurance provision stating that the policy will not apply if other valid and collectible insurance exists covering the same loss, effectively allowing the policy to escape liability. Escape clauses can create disputes when multiple policies have them, potentially leaving the insured without coverage despite paying for multiple policies. Contribution by equal shares, a method of apportioning loss payment where each policy covering the same loss pays an equal amount until one policy's limit is exhausted, then remaining policies continue paying equally. This approach differs from contribution by limits and can result in different distributions depending on loss size relative to policy limits. Contribution by limits, the most common method of apportioning loss payment where each policy contributes based on the proportion its limit bears to the total limits of all applicable policies, regardless of the actual loss amount. This ensures each insurer pays its fair share based on the coverage it provided. Severability clause, a liability policy provision stating that coverage applies separately to each insured as if separate policies were issued, with the acts or knowledge of one insured not imputed to others. This protects innocent additional insureds from being denied coverage due to the named insured's violations or fraud. Separation of insureds clause, another term for severability clause, ensuring that each insured is treated separately under the policy with their own coverage determination. This is particularly important in commercial liability policies where multiple parties, named insured, subsidiaries, additional insureds, share coverage but need independent protection. Legal action against insurer clause, a policy condition establishing requirements before the insured can sue the insurer, typically requiring full compliance with all policy provisions and filing suit within a specified period, 1 to 2 years after loss. This establishes conditions precedent to litigation and a contractual statute of limitations that may differ from general tort statutes. Duties after loss, the insured's obligations following a covered loss, including prompt notification, cooperation with investigation, protection of property from further damage, preparation of loss documentation, and submission to examination under oath. Failure to fulfill these duties can prejudice or void coverage, making them critical policy conditions. Notice of loss, the insured's required notification to the insurer that a loss has occurred or a claim has been made, which must be provided as soon as practicable or within a specified time frame. Prompt notice allows the insurer to investigate while evidence is fresh and potentially mitigate damages, with late notice potentially barring coverage if it prejudices the insurer. Proof of loss, a formal detailed statement submitted by the insured documenting the occurrence, cause, and amount of loss, typically required within a specified period, 60 to 90 days after loss. Proof of loss must include detailed inventory, valuations, supporting documentation, and sworn statements establishing the insured's claim. Inspection and audit clause, a policy provision granting the insurer the right to inspect the insured's property, operations, and records during the policy period, and to audit books and records after policy expiration to verify premium calculations. This allows insurers to assess risk, verify compliance with coverage requirements, and determine final premium for policies with adjustable premiums. Examination under oath, EUO. The insurer's right to require the insured to submit to questioning under oath regarding loss circumstances, property values, or other claim-related matters, typically conducted by an attorney with a court reporter present. EUOs are powerful investigative tools allowing insurers to obtain sworn testimony that can be used in coverage disputes or fraud investigations. Salvage rights, the insurer's legal right to take possession of and sell damaged property after paying a total loss claim, recovering some payment through salvage sales. This differs from the salvage value concept and represents the insurer's contractual and legal entitlement to abandoned property. Recovery condition. A policy provision addressing what happens if lost or stolen property is recovered after a claim is paid, typically giving the insured the option to keep recovered property and return claim payment, or let the insurer keep the recovery. This prevents unjust enrichment when property is found after settlement. Vacancy condition. A policy provision suspending or restricting coverage when buildings are vacant beyond a specified period, typically 60 days, recognizing increased exposure to vandalism, theft, and deterioration. Vacancy conditions often suspend coverage for specified perils and reduce payments by 15% for other losses while the building is vacant. Misstatement of age, a provision, more common in life insurance, addressing premium adjustments when the insured's age is misstated on the application, adjusting coverage or premium to what would have been provided at the correct age. This appears occasionally in P&C when age affects rating, but is less critical than in life insurance. Fraud condition. A policy condition stating that the entire policy is void if the insured commits fraud relating to the insurance at any time, including before or after a loss. This gives insurers the right to void the entire policy and deny all claims upon proof of fraud, not just the fraudulent claim. A mandatory endorsement. An endorsement that changes, adds to, or deletes provisions in the policy, formally amending the insurance contract. Mandatory endorsements supersede conflicting policy language and become part of the legal contract, with later endorsements controlling over earlier ones when conflicts exist. Broadening endorsement. An endorsement that expands coverage by adding perils, increasing limits, extending territory, or reducing restrictions in the base policy. Broadening endorsements are purchased to enhance protection, such as adding earthquake coverage or increasing special limits for jewelry. Restrictive endorsement. An endorsement that limits or reduces coverage by adding exclusions, reducing limits, restricting territory, or imposing additional conditions. Restrictive endorsements may be mandatory for unacceptable risks or voluntary to reduce premium, and typically cannot be added mid-term without consent. State-specific endorsement. An endorsement required by or designed for a particular state's laws and regulations, ensuring the policy complies with that state's insurance requirements. These endorsements adapt standardized national forms to meet varying state statutory requirements, mandatory coverage provisions, or regulatory language. Named peril endorsement. An endorsement that converts open peril coverage to named perils coverage or vice versa, fundamentally changing the policy's coverage structure. This differs from discussing individual named perils and refers to the policy mechanism that establishes the coverage approach. Policy modification. Any formal change to the insurance contract made by mutual agreement of insurer and insured, documented through endorsements, riders, or policy amendments. Modifications become part of the legal contract and must meet the same requirements as the original policy: consideration, mutual assent, legal purpose. Insurable contract interest. The legal doctrine requiring that parties to insurance contracts have a legitimate financial or legal interest in the subject matter being insured to prevent insurance from becoming a wagering contract. This contract law principle validates the insurance relationship and must exist both at policy inception and at time of loss in property insurance. Constructive total loss, a legal determination that property is a total loss, even though not completely destroyed, because repair or recovery costs would exceed the property's value or insured amount. Courts and insurers classify losses as constructive total losses when repair is economically impractical, triggering total loss settlement rather than actual cash value repairs. Actual total loss, complete destruction, or loss of property, where nothing of value remains or the property is irretrievably lost, as opposed to constructive total loss, where property exists but is uneconomical to repair. Actual total losses are unambiguous, total losses requiring full payment of insured value, less salvage, if any. Representation versus warranty distinction. The critical legal difference between representations, statements believed true when made, material only if they affect risk assessment, and warranties, absolute guarantees that must be true, breach voids coverage regardless of materiality. Modern insurance law has largely eliminated strict warranty enforcement in favor of the more lenient representation standard, preventing coverage denial for immaterial inaccuracies. Materiality of information. The standard for determining whether information disclosed or withheld would have influenced an insurer's decision to issue coverage or set premium, making it material to the risk. Material information affects underwriting decisions, and only material misrepresentations or concealments void coverage, protecting insureds from policy cancellation for trivial inaccuracies. Burden of proof. The obligation to prove facts in an insurance dispute, with insureds typically bearing the burden to prove coverage applies, loss occurred, amount of damage, and insurers bearing the burden to prove exclusions apply or conditions were breached. This allocation of proof responsibilities affects litigation strategy and outcomes, with ambiguities resolved against the party bearing the burden. Reservation of rights. A written notice from an insurer to an insured stating that the insurer is defending a claim or investigating a loss, but reserves the right to later deny coverage based on policy exclusions or conditions. This protects the insurer from waiving defenses while fulfilling the duty to defend, allowing continued investigation while coverage questions remain unresolved. Declaratory judgment action. A lawsuit filed, usually by the insurer, asking a court to determine the party's rights and obligations under the insurance contract before the underlying claim is fully resolved. Declaratory judgment actions resolve coverage disputes proactively, establishing whether the insurer has a duty to defend or indemnify without waiting for the underlying case to conclude. Indemnification agreement, a contractual provision where one party agrees to protect, defend, or reimburse another party for specified losses, damages, or liabilities, commonly found in construction contracts, leases, and service agreements. Insurance policies may or may not cover liability assumed through indemnification agreements, depending on whether they qualify as insured contracts under policy definitions. State Insurance Department, Commissioner, the state government agency and its chief executive responsible for regulating insurance companies, licensing producers, enforcing insurance laws, protecting consumers, and ensuring insurer solvency within that state. Each state has its own insurance commissioner, or superintendent, director, with authority to examine insurers, approve rates and forms, investigate complaints, and take enforcement actions to protect policyholders. NAIC, National Association of Insurance Commissioners. A voluntary organization of state insurance regulators that coordinates regulation across states, develops model laws and regulations, provides insurer financial data through its database, and promotes uniformity in insurance regulation. While NAIC has no direct regulatory authority, its model acts and regulations are frequently adopted by states, and its financial reporting and analysis systems are used nationwide for insurer oversight. McCarran-Ferguson Act, a 1945 federal law declaring that states, not the federal government, have primary authority to regulate the business of insurance, with federal antitrust laws applying only when state regulation is absent. This law established the state-based regulatory system that continues today, allowing states to regulate rates, forms, market conduct, and solvency, while providing a limited antitrust exemption for the insurance industry. Regulatory authority: the legal power granted to state insurance departments to supervise, examine, license, and enforce compliance with insurance laws and regulations within their jurisdiction. This authority includes approving or disapproving rates and forms, licensing insurers and producers, conducting examinations, investigating violations, and imposing penalties for non-compliance. Market conduct examination: a regulatory review of an insurance company's business practices, operations, and treatment of policyholders, examining areas like underwriting, rating, claims handling, marketing, and complaint resolution. Market conduct exams ensure insurers comply with laws and treat consumers fairly, with findings potentially leading to corrective actions, fines, or changes in business practices. Financial examination: a comprehensive regulatory audit of an insurance company's financial condition, records, and operations conducted by state insurance departments to verify solvency and compliance with financial reporting requirements. Financial exams typically occur every 3 to 5 years and review assets, liabilities, reserves, investments, and business practices to ensure the insurer can meet its obligations to policyholders. Solvency regulation: state oversight, ensuring insurance companies maintain adequate financial resources to pay claims and meet obligations to policyholders, including capital requirements, reserve standards, and investment restrictions. Solvency regulation protects policyholders from insurer insolvency through ongoing monitoring, financial examinations, risk-based capital requirements, and early intervention when financial problems emerge. Unfair trade practices: prohibited business practices in insurance, including misrepresentation, false advertising, unfair discrimination, rebating, twisting, and other deceptive or harmful activities defined by state law. State insurance codes enumerate specific unfair trade practices and provide penalties including fines, license suspension or revocation, and cease and desist orders for violations. Rebating: the illegal practice of returning part of the premium or commission to the insured as an inducement to purchase insurance, prohibited because it creates unfair discrimination between insureds paying different effective prices. Rebating undermines filed rate systems, creates unfair competition among agents, and is banned in most states, with narrow exceptions for marketing items of minimal value. Twisting: the illegal practice of inducing a policyholder to lapse, forfeit, or replace existing insurance through misrepresentation, incomplete comparison, or misleading information about policy values or benefits. Twisting harms consumers who may give up valuable coverage or face new waiting periods, contestability periods, or higher premiums, and benefits the agent through new commissions at the policyholder's expense. Defamation: making false, malicious statements about an insurer or insurance producer that harm their reputation or business standing, prohibited as an unfair trade practice. Defamation in insurance includes spreading false information about a competitor's financial condition, business practices, or products to gain competitive advantage. Tied selling: the prohibited practice of conditioning the sale of one type of insurance product on the purchase of another product, or requiring insurance purchase to obtain other services like loans. Tied selling is illegal because it restricts consumer choice, creates unfair competition, and may force consumers to buy unwanted coverage to obtain necessary products or services. Licensing requirements: the state-mandated prerequisites for obtaining an insurance producer license, typically including minimum age, usually 18, pre-licensing education courses, passing a state examination, background check, and application fees. These requirements ensure producers have basic knowledge of insurance principles, state laws, and ethical standards before selling insurance to the public. Continuing education, CE. Mandatory ongoing education that licensed insurance producers must complete during each license period, typically 24 hours every 2 years, to maintain their license, covering topics like product knowledge, ethics, and regulatory updates. CE requirements ensure producers stay current with industry changes, maintain competency, and understand their ethical and legal obligations to consumers. License renewal, the periodic process, typically every 2 years, by which insurance producers maintain their active license status by submitting renewal applications, paying fees, and certifying completion of continuing education requirements. Failure to renew on time results in license expiration, requiring producers to cease selling insurance until the license is reinstated. Reciprocity, an arrangement where one state recognizes and accepts another state's licensing requirements, allowing producers licensed in their home state to obtain licenses in other states with reduced or waived requirements. Reciprocity simplifies multi-state licensing for producers, but typically still requires producers to pass the non-resident state's laws and regulations examination. Non-resident license, a license issued to a producer who resides in another state but wishes to sell insurance in the licensing state, allowing producers to conduct business across state lines. Non-resident licenses require the producer to hold a resident license in their home state and meet the non-resident state's requirements, which are often streamlined through reciprocity agreements. Temporary license, a short-term license, typically 180 days, issued in special circumstances such as the death or disability of a producer, allowing a designated person to service existing business and maintain agency operations until permanent arrangements are made. Temporary licenses have limited scope and duration, typically not allowing the temporary licensee to solicit new business. Appointment, the formal authorization by an insurance company granting a licensed producer the authority to represent the insurer and sell its products, establishing the agency relationship between insurer and producer. Appointments must be filed with the state insurance department, and producers can only sell products for insurers with whom they hold valid appointments. Termination of appointment, the ending of the agency relationship between an insurer and producer, which must be reported to the state insurance department within a specified time frame, particularly when terminated for cause due to producer misconduct. Terminations for cause trigger regulatory scrutiny and can affect the producer's ability to obtain appointments with other insurers or maintain their license. Controlled business, insurance written by a producer on themselves, their immediate family members, or their own business interests, subject to regulatory limits, typically not exceeding a certain percentage of total business, to ensure the producer is serving the public rather than just self-insuring. Excessive controlled business suggests the producer obtained a license primarily for personal benefit rather than to serve clients, violating the purpose of producer licensing. License suspension, a temporary revocation of a producer's authority to sell insurance for a specified period, imposed as punishment for violations of insurance laws, regulations, or ethical standards. Suspended producers cannot sell insurance, earn commissions, or represent themselves as licensed during the suspension period, though they may be able to service existing business in some jurisdictions. License revocation, the permanent termination of a producer's insurance license, representing the most severe regulatory penalty for serious violations like fraud, misappropriation of funds, criminal convictions, or repeated regulatory violations. Revoked producers lose all authority to act as insurance representatives and typically face significant barriers to regaining licensure, often requiring proof of rehabilitation and complete reapplication. Administrative action, regulatory enforcement measures taken by the state insurance department against producers for violations, including fines, license suspension or revocation, cease and desist orders, restitution orders, or required corrective actions. Administrative actions are public records that can damage a producer's reputation and career and are reportable to other states and on future license applications. State Guarantee Association/Fund, a state-created organization funded by insurance companies to protect policyholders when an insurer becomes insolvent and cannot pay claims, providing a safety net similar to FDIC protection for bank deposits. Each state has its own guarantee association or fund, and when an insurer fails, the association pays covered claims up to statutory limits, ensuring policyholders don't lose protection due to insurer financial failure. Guarantee Fund Assessment. Mandatory charges levied on insurance companies operating in a state to fund the Guarantee Association's payments for insolvent insurers' claims, typically calculated as a percentage of premiums written in that state. Assessments are made after an insurer insolvency occurs and claims need to be paid, allowing insurers to recoup these costs through premium tax offsets or, in some states, policy surcharges to policyholders. Eligible claims. Claims that qualify for payment by the State Guarantee Fund, meeting requirements such as being filed against a covered policy, arising from an insured event before the insolvency, and falling within statutory coverage limits. Eligibility typically requires that the claim be filed within specified deadlines and that the claimant meet residency or policy location requirements established by state law. Covered policies. Insurance policies that receive guarantee fund protection if the issuing insurer becomes insolvent, typically including personal lines, auto, homeowners, and most commercial property casualty policies issued to residents or covering property in the state. Coverage ensures that policyholders with standard insurance products maintain protection even when their insurer fails, subject to statutory limits and conditions. Excluded policies. Types of insurance that do not receive guarantee fund protection, commonly including surplus lines coverage, policies issued by unauthorized insurers, life and health insurance, covered by separate funds, and policies held by large commercial entities above net worth thresholds. Exclusions reflect policy decisions that certain sophisticated buyers should assess insurer financial strength themselves, or that certain coverage types fall outside the property casualty guarantee system. Net worth requirements. Statutory thresholds that exclude large commercial policyholders, typically those with net worth exceeding $50 million or other specified amounts, from guarantee fund protection, based on the principle that sophisticated wealthy entities can evaluate insurer financial strength and bear their own risk. These exclusions focus guarantee fund resources on protecting individual consumers and small businesses that lack resources to research insurer solvency or absorb unpaid claims. Rate filing, the formal submission of insurance rates, rating plans, and supporting actuarial data to the state insurance department for review, required in most states before insurers can charge premiums to policyholders. Rate filings include detailed information about how premiums are calculated, loss experience data, expense factors, and actuarial justifications demonstrating the rates are adequate, not excessive, and not unfairly discriminatory. Prior approval. A rate regulatory system requiring insurers to submit proposed rates to the state insurance department and receive formal approval before implementing them, representing the most restrictive form of rate regulation. Under prior approval, insurers cannot use new rates until the regulator affirmatively approves them, which can delay rate changes but provides maximum consumer protection against excessive or inadequate rates. File and use. A rate regulatory system allowing insurers to implement new rates immediately upon filing them with the state, without waiting for prior approval, though regulators can later disapprove rates and require refunds or changes. This system balances regulatory oversight with insurers' need for timely rate adjustments, allowing quick response to market conditions while maintaining regulatory review authority. Use and file. A rate regulatory system permitting insurers to implement new rates immediately and file them with the state within a specified period after use, typically 15 to 60 days, providing maximum flexibility for insurers. This approach assumes competitive markets regulate rates effectively, with regulatory review serving as a backstop rather than prior approval mechanism. Flex rating. A rate regulatory system allowing insurers to adjust rates within a specified band or percentage range, typically plus or minus 7% or plus or minus 15%, without prior approval, while larger rate changes require filing and approval. Flex rating provides flexibility for minor rate adjustments responding to competitive conditions while maintaining regulatory oversight of significant rate increases. Open competition. A rate regulatory approach where market forces rather than regulatory approval determine rates, with minimal or no filing requirements beyond informational submissions. Open competition, also called competitive rating, assumes that competitive markets naturally produce adequate, non-excessive, and non-discriminatory rates, relegating regulators to monitoring for market failures rather than pre-approving rates. Rate adequacy, the regulatory standard requiring that insurance rates be sufficient to cover expected claims, expenses, and maintain insurer solvency without being excessive. Adequate rates protect both policyholders by ensuring insurers can pay claims and the insurance market by preventing insolvencies that trigger guarantee fund assessments, balancing consumer protection with insurer financial stability. Rate discrimination, the prohibited practice of charging different premiums to insureds with substantially similar risk characteristics and loss exposures, resulting in unfair treatment. While insurers may differentiate rates based on legitimate risk factors, age, location, claims history, rate discrimination occurs when pricing differences are not justified by actual risk differences, violating the principle that rates should be actuarially sound and equitable. Rating Bureau, an organization that collects loss data, develops rates, and creates rating plans for use by member insurance companies, providing actuarial services particularly for smaller insurers lacking individual rating expertise. Rating bureaus, like Insurance Services Office, ISO, aggregate industry data to produce advisory rates and loss costs, allowing members to benefit from collective experience while maintaining some competitive pricing flexibility. Advisory rates, rates developed by rating bureaus or statistical organizations that insurers may use as a starting point for their own rates, but are not required to adopt, allowing insurers to modify them based on their own experience and competitive strategies. Advisory rates provide actuarial guidance particularly for smaller insurers while permitting rate competition, as insurers can deviate from advisory rates to reflect their unique costs, underwriting, or market positioning. Actuarial soundness, the principle that insurance rates must be based on mathematical and statistical analysis of loss experience, expenses, and investment income, ensuring rates are neither inadequate nor excessive and reflect actual risk. Actuarially sound rates use credible data, accepted methodologies, and reasonable assumptions to produce premiums that will cover expected losses and expenses while providing a fair profit, protecting both policyholders and insurer solvency. Demutualization, the process by which a mutual insurance company, owned by policyholders, converts to a stock company, owned by shareholders, fundamentally changing the company's ownership structure and governance. Demutualization typically involves compensating policyholders for their ownership interests through cash, stock shares, or policy credits, and requires regulatory approval to ensure policyholder interests are protected during the conversion. Admitted, authorized insurer, an insurance company that has been licensed by a state's insurance department to conduct business in that state, subject to full regulatory oversight including rate and form approval, financial examinations, and contribution to state guarantee funds. Admitted insurers must comply with all state insurance laws, maintain required reserves and capital, and their policies are protected by state guarantee associations if the insurer becomes insolvent. Non-admitted, unauthorized excess and surplus lines insurer. An insurance company that has not been licensed to do business in a particular state, but may still provide coverage for hard-to-place risks through licensed surplus lines. Brokers, operating with reduced regulatory oversight. Non-admitted insurers are not subject to state rate and form approval, do not contribute to state guarantee funds, so their policies lack guarantee fund protection, and can only write business that cannot be placed in the admitted market. Diligent search requirement, the regulatory mandate that surplus lines brokers must make a thorough effort to place coverage with admitted insurers before accessing the non-admitted surplus lines market, typically requiring declinations from a specified number of admitted insurers. This requirement protects the admitted market by ensuring surplus lines are used only for genuinely hard-to-place risks rather than as a way to avoid regulatory requirements, with brokers documenting their search efforts. Export list, a state-maintained list of types of insurance or specific risks that are automatically eligible for surplus lines placement without requiring a full diligent search of the admitted market. Export lists streamline surplus lines placement for coverages known to be unavailable in the admitted market, like certain high-risk properties or specialized coverages, reducing administrative burden while still protecting the admitted market. Surplus lines, tax stamping fee, a premium tax, typically 2 to 6% of premium, charged on surplus lines policies in lieu of standard premium taxes, collected by surplus lines brokers and remitted to the state. Some states also charge a stamping fee for processing surplus lines filings, with these taxes compensating states for regulatory oversight and offsetting the lack of guarantee fund contributions by non-admitted insurers. Eligible surplus lines insurer. A non-admitted insurer that meets state requirements for financial strength and reliability, appearing on the state's approved list of insurers authorized for surplus lines business. Eligibility requirements typically include minimum capital and surplus levels, acceptable financial ratings, and willingness to submit to state jurisdiction for claims, ensuring surplus lines insurers can reliably pay claims despite lacking full licensure. Alien insurer non-admitted, an insurance company domiciled in a country outside the United States that operates on a non-admitted basis in U.S. states, accessing the market through surplus lines or risk purchasing groups. Alien insurers may offer specialized coverages unavailable domestically or competitive pricing for international risks, but policyholders lack guarantee fund protection and may face challenges pursuing claims across international borders. Risk Purchasing Group Exemption, a federal exemption under the Liability Risk Retention Act, allowing risk purchasing groups to buy liability insurance from non-admitted insurers without meeting state surplus lines requirements like diligent search. This exemption facilitates group purchasing arrangements for businesses with similar liability exposures, though it applies only to liability coverage and doesn't extend to property insurance. Retaliatory provisions, state laws imposing the same taxes, fees, and regulatory restrictions on out-of-state insurers that the foreign insurer's home state imposes on insurers from the retaliating state. For example, if State A charges State B insurers a 3% premium tax while State B only charges 2%, State B would retaliate by also charging State A insurers 3%, encouraging states to maintain competitive tax and regulatory environments. Home state. The state where an insurance company is domiciled or incorporated, which serves as the primary regulator for that insurer, with authority over licensing, financial examinations, and solvency oversight. The home state has the most comprehensive regulatory authority over an insurer, while other states where the company operates as a foreign insurer have more limited oversight focused on market conduct and policy forms. Market Assistance Plan, a voluntary program where the insurance industry helps applicants who have difficulty finding coverage in the voluntary market by referring them to insurers willing to consider the risk, stopping short of mandatory assignment. Market assistance plans provide information and connection services while maintaining voluntary placement, serving as an intermediate step before forcing risks into assigned risk plans. Voluntary market, the standard insurance marketplace where insurers freely choose which risks to accept based on underwriting criteria, as opposed to residual or assigned risk markets where insurers must accept assigned risks. The voluntary market represents normal competition, where insurers compete for desirable risks through pricing and service, with most insureds obtaining coverage through this preferred market. Admitted assets, assets recognized by state insurance regulators for purposes of determining an insurer's financial strength and meeting statutory reserve and capital requirements, excluding non-liquid or speculative assets. Admitted assets typically include bonds, stocks, mortgages, real estate, and cash that can readily be converted to pay claims, while non-admitted assets like furniture, past due premiums, or goodwill are excluded from statutory financial statements. AM Best Rating, an independent financial strength rating issued by AM Best Company, evaluating an insurer's ability to meet obligations to policyholders, ranging from A++, superior, to F, in liquidation. Best ratings analyze insurer balance sheets, operating performance, business profiles, and enterprise risk management, providing crucial information for consumers, agents, and businesses selecting insurers, with ratings of A- or better generally considered secure. ACORD forms, standardized insurance industry forms developed by the Association for Cooperative Operations Research and Development, widely used for applications, certificates of insurance, loss notices, and other insurance documents. ACORD forms facilitate efficient communication between insurers, agents, and insureds by providing uniform formats recognized throughout the industry, reducing errors and processing time. Policy forms approval. The regulatory process where state insurance departments review and approve insurance policy forms before insurers can use them, ensuring policy language complies with state laws, provides required coverages, and is clear and fair to consumers. Form approval protects consumers from unclear, misleading, or non-compliant policy language, though some states have moved toward less restrictive filing systems for certain coverage types. Gramm-Leach-Bliley Act, a 1999 federal law requiring financial institutions, including insurance companies, to protect customer privacy by limiting information sharing, providing privacy notices, and implementing security measures to protect personal financial information. The Act allows financial services integration while requiring companies to disclose privacy practices, give customers opt-out rights for certain information sharing, and safeguard sensitive data from unauthorized access. Privacy notices, required disclosures that insurance companies must provide to customers explaining how they collect, use, share, and protect personal information, along with customer rights to limit certain information sharing. Privacy notices must be provided at policy inception and annually thereafter, informing consumers about data practices and opt-out opportunities for marketing or certain third-party sharing. Anti-money laundering, AML. Regulatory requirements and procedures to detect and prevent the use of insurance products to conceal illegally obtained money, requiring insurers to verify customer identities, monitor suspicious transactions, and report certain activities to federal authorities. AML programs in insurance include customer due diligence, transaction monitoring, and reporting of suspicious activities involving large cash transactions or unusual policy patterns that might indicate money laundering. USA Patriot Act compliance, requirements under the 2001 Uniting and Strengthening America by providing appropriate tools, required to intercept and obstruct terrorism act, mandating customer identification programs, screening against terrorist watch lists, and enhanced due diligence for high-risk accounts. Insurance companies must verify customer identities, maintain records of identification information, and check customers against government lists of known or suspected terrorists as part of broader anti-terrorism efforts. Consent to rate, an agreement where the insured accepts premium rates higher than those filed with or approved by the state insurance department, typically used for large commercial risks where individual rating is appropriate. Consent to rate allows flexibility in pricing complex risks while documenting that the insured knowingly accepts non-standard rates, protecting insurers from regulatory challenges about unfiled rates. File and use certification, a statement or affidavit from the insurer certifying that filed rates comply with state rating laws. Adequate, not excessive, not unfairly discriminatory, even though the rates are used before regulatory approval. This certification places responsibility on the insurer to ensure compliance, allowing immediate implementation while providing regulators with assurance of good faith compliance and basis for later review. Cancellation notice requirements. State-mandated timeframes and procedures insurers must follow when canceling policies, typically requiring 10 to 60 days advance written notice depending on the reason for cancellation and policy type. Notice requirements protect policyholders by providing time to secure replacement coverage, with specific rules governing valid cancellation reasons, notice content, and delivery methods. Non-renewal notice requirements, state-mandated advance notice, typically 30 to 90 days before expiration, that insurers must provide when declining to renew a policy at expiration, giving policyholders sufficient time to find replacement coverage. Non-renewal is distinguished from cancellation as it occurs at policy expiration rather than mid-term, and states often require insurers to provide reasons for non-renewal to enable policyholder recourse or market corrections. Replacement regulations. State laws governing the replacement of existing insurance policies with new policies, requiring agents and insurers to ensure replacements are suitable, provide disclosures about consequences of replacement, and maintain documentation. Replacement regulations combat twisting by ensuring consumers understand implications of policy changes, including loss of benefits, new waiting periods, or higher costs, requiring comparative information and supervisory review of replacement transactions.